Okay, fine. Let's start our accounts marathon, advanced accounts marathon, and about to cover the following topics, especially in the first session. The first session will be running from 9:30 to 1:30, and in this session, we are going to cover accounting standard number 4, accounting standard number 5, 7, 9, 22, cash flow statement. And along with all these things, we are also going to cover introduction and framework. This is our target for session number 1. Is 4, 5, 7, 9, 22 and cash flow statement. This is for entire plan for the morning session. So let's try to cover. If anything is pending, we will just postpone it to the end. That is like tomorrow we are going to cover that. And of course, I would like to tell the things that I'm not going to cover actually. AS1, since it is very easy. AS2, even that is also easy. And I can't cover AS15 and AS19. And no, wait. If time is there, I'll be covering AS15 too, because there might be people who are who would like to listen the new topics actually. Would like to cover AS15, but I can't give guarantee. AS19 anyways I'm not going to cover, because the main problem with these two things are, these two are such a heavy standards, where in the meantime of covering these, we can cover 2 to 3 other topics also. That is the biggest problem with these two topics. So AS15 and AS19 will try to cover, but can't give guarantee at all. Reason being, as I said, such a heavy topic, where in the meantime we can cover the other topics too. And coming to chapters, internal reconstruction, because prima facie it's very easy. And independent branches, I'm not going to cover independent branches. And apart from all these things like dependent branches, consolidation, amalgamation, and all these standards and new standards like AS28, AS25, 23, 27, we are going to cover everything. Yes, you might get disappointed by seeing some of the things which were not covered, but since no other option, you have to take chance for one end. Only then we could be able to cover all the remaining things in the set time. The biggest problem is that time frame. You might ask me like, even AS4 and 5 are also very easy, but these things will be completed just in a span of 20 to 30 minutes. So if I have started AS19, it alone will take 1 hour easily. If you have started AS15, there might be new people also, or even people, students who have listened would like to listen it very elaborately again, which might take 1.5 hours to complete. That is the biggest problem with these two things. So keeping all these things aside, let us start. And you might question me, so why you are covering introduction and framework? Because they are actually such an easy things. No, the actual point is that again the same is getting repeated here. Introduction and framework. He is asking one question. Mandatorily he is going to test one question in your examination for sure. Because even in the model paper which was released in the recent examination, he had done the same. Tested a question from either from introduction or framework. And he had introduced case scenario based MCQs. But don't get heavy and don't feel difficult. Oh no, we have got case scenario based MCQs. Nothing great. They are actually very simple. The irony is that each and every paragraph will be dealing with each and every separate standards. And he will be clubbing it like a single question. Like he'll be starting like Rama Limited, giving the question from AS2. Again the same company, Rama Limited, giving a question from AS4. Again the same company, Rama Limited, giving a question from AS28. Again the same company, Rama Limited, giving a question from AS10. For each and every standard, different question. Simply to tell you, different paragraph. Simply to tell you, from AS2 pick one question, one paragraph. From AS4 pick one question, another paragraph. From AS28 pick one question, another paragraph. From AS10 pick one question, another paragraph. This is actually your case scenario based MCQs. Yes, I have seen it in RTPs and MTPs. Because more than this, for accounts, case scenario based MCQs are generally not possible. More than this, because practical queries on accounts is less when compared to your auditing and law. Because almost every accounting standard and Ind AS is very clear in their application. But coming to law and tax, majority of the users will be getting maximum doubts. So they will be getting problems. So amendments will come. And moreover, amendments are apparent that in every year Finance Act they will be doing the same. But coming to accounts, accounting standards will get amended. But those amendments are not like on every day they will be doing the same. Or every year they will be doing the same. Okay. So let me start. So fine. First of all, introduction to accounting standards. Going to tell you what are actually important here. So now, what is an accounting standard? As simple as such. Accounting standards are written policy documents. What are accounting standards? Everybody is supposed to respond because your participation will make more comfortable for everybody. So please, what is an accounting standards? Written policy documents. Those will be written either by government or expert bodies. Those will be written either by government or expert bodies. Likewise, government will be, I hope you know, section 133. Each and every company has to follow accounting standards or Ind AS which are released as per section 133. That will be released by central government. And the same will be recommended by NFRA. What is NFRA? National Financial Reporting Authority. Clear everybody? So yeah, even we are having the procedure, we will be dealing even with the procedure. So please tell me, accounting standards are dash written policy documents which are issued by the government and expert bodies, and they actually cover issues with which accounting standards deal. Or you might get format of accounting standards, or what does an accounting standards deal? This is an important question for 5 marks. An accounting standard is going to cover the aspects of recognition, measurement, presentation, disclosure. If it is possible, remember better like the first one, objective, scope and definition also. What is the first one? Objective, scope, definition, and what are the next 4 things? Recognition, measurement, presentation, disclosure. Objective, purpose of the standards. Scope, applicability and non-applicability. Definition will be learnt as per accounting standards. Recognition is nothing but recording. Measurement is nothing but valuation. Presentation is nothing but where the items will be appearing in financial statements. Finally, disclosure is something like given in notes to accounts. Respond clear everybody. This is an important question for 5 marks. Tell me what are the areas where an accounting standard is going to deal? Objective, scope, definition, recognition, measurement, presentation. Clear everybody? Just remember the things and better to write the meanings of the same. Next important question, benefits of an accounting standards. Again, you might get the same question for 5 marks. A pure theory question. Sir, are accounting policies one or many? Or accounting policies one or many? Those many policies have to be brought in line. So in order to bring in line, ICAI had decided to issue accounting standards, which is nothing but standardization of alternative accounting treatments. Various policies will be there, various treatments will be there. Those have to be standardized with the introduction of accounting standards. Requirements for additional disclosures. Hope you know that standards can override law or standards cannot override law. Standards cannot override law. So standards have to follow in conformity with the law. Standards has to follow the provisions in line with law. But standards can call for additional disclosures, but standards can't override law. Can standards call for additional disclosures or not? But can they override law? Since, sir, same question again. Accounting policies, one or many? Those many policies were brought into uniform. Am I correct or wrong? Whenever they were brought into uniform, automatically everybody can compare. Am I correct or wrong? So the next one is actually like comparability, which can facilitate either inter-comparison or intra-comparison. What is inter-comparison? Between the companies. Intra-comparison, within the company, like between the entities within the entity. Clear, everybody? The last and final one, reduction in the scope of creative accounting or window dressing. Window dressing is nothing but manipulating more profits. Accounts will be manipulated to show more profits. How to show more profits, sir? Either by overstating the income or by understating the expense, which is otherwise called as creative accounting also. Likewise, twisting the accounting policy so as to get a favorable result. They have twisted in such a way, company felt that we are paying more taxes, so let us reduce our profit. Clear, everybody? Or company felt that profits are actually less. They have kept some repairs and maintenance. So repairs and maintenance has to be charged or capitalized? Chappali, repairs and maintenance has to be charged or capitalized. But company has decided to capitalize the same. Company has decided to capitalize the same, reason being profits will increase so that my market share will increase. It had thought like that. Answer, is it good or bad? That's obviously bad, which is like twisting the accounting policies. You should not twist it like that. And for the reason accounting standards are introduced with which you can't think with a creative way. Understood? So tell me, what is window dressing? Manipulating the financial statement so as to show the more profits. More profits can be shown either by overstating the income or understating the expense. Creative accounting is twisting the accounting policies in order to get the favorable results. Clear? And standard setting process again important for 5 marks. Listen, very very simple. Let me give you the standard setting process in a very simplest way. First of all, standards will be released by ICAI through Accounting Standards Board. Am I correct or wrong? So now first step, ICAI will be identifying the broad area where accounting standards need is there. To tell you, my dear children, do you know that now a standard is under development? Agriculture. Accounting standard on agriculture is under development. So ICAI had thought that the broad area is nothing but agriculture. Clear, everybody? Then immediately it will be formulating study groups. Study groups is nothing but a commission or a group who will study about the agriculture, and they will prepare preliminary draft, which is nothing but accounting standard, but it is initially called as preliminary draft. Then this preliminary draft will be modified by Accounting Standards Board, which is called as modified preliminary draft. This modified preliminary draft will be sent for comments. It will be sent for comments to members of ICAI and expert bodies like ICMAI, ICSI, CAG, SEBI, Income Tax Department, even to the world's accounting bodies, etc. and etc. Clear, everybody? Again, comments will be collected by Accounting Standards Board. Now it will prepare a draft which is called as exposure draft. Again, exposure draft will be sent to comments for members of ICAI and general public. Clear, everybody? After sending it for all the people, again we will be getting some comments. These comments will be considered by Accounting Standards Board again, and it will be preparing a final draft. This final draft will be taken by ICAI and it will modify if any things are needed, and finally it will be releasing final draft as an accounting standard. Clear, everybody? This is what the entire process. Now very important, whatever the standard that was released will be directly applicable for non-corporate entities. Directly applicable for non-corporate entities. But the same is not directly applicable for corporate entity. Now corporate, for making applicable the same to the corporate entity, this accounting standard will be reviewed by NFRA, which is formed under Companies Act 2013. Now NFRA will be recommending the same to MCA, which is a part of central government, and finally it will give the approval and it will be releasing the accounting standard through section 133. Respond clear to each and everyone. This is the standard setting process, which is important for 5 marks again. Clear? So standard release can be directly applicable to? Standard release cannot be directly applicable to? To make applicable for corporate entities, who has to recommend? Who has to approve? And finally it will be released through section 133. Clear everybody? You might get this kind of raw questions. Likewise, one question for MCQ for 2 marks. So please be careful. And moving on to the next thing, straight away, applicability of accounting standards. Take care. Exclusively for the purpose of applicability of accounting standards, or your business concerns are divided into 2 types. One is corporate entity and the other is non-corporate entity. Corporate entities are again divided into SMCs and non-SMCs, and it is guided by NFRA. Previously NACAS, NACAS, National Advisory Committee on Accounting Standard. Of course, now NACAS is not there, replaced with NFRA. Non-corporate entities are guided by ICAI and classified into level 1, level 2, level 3, level 4. Non-SMC and level 1 conditions are same, and these 2 people have to follow all the accounting standards. Whereas coming to SMC and all the other levels, they are getting some exemptions. They have to follow some standards in full, they have to follow some standards in part, and some standards totally exempted. Clear everybody? And now what are non-SMCs and level 1 entities? If the entity is listed, or if the entity is in the process of listing, whether in India or outside India, it's a listed company or it's a listed entity, because non-SMC is also there kada. I mean to tell, non-corporate is also there kada. So it's a listed entity. If not, check for the other condition, like whether the entity is engaged in the business of insurance, banking, financial institution. Again same, it will become non-SMC or level 1 entity. Clear? And even if this condition is not satisfied, condition number 3. What is condition number 3? Yes, previous year turnover more than 250 crores. More than 250 crores, not more than or equal to. It's more than 250 crores. Very clear. Then it will become non-SMC or level 1 entity. If not, the next condition, previous year borrowings plus public deposits more than 50 crores. Yeah, again it will become non-SMC or level 1 entity. And last and final, holding or subsidiary. Either my holding company or my subsidiary company. Either my holding company or my, if it is non-SMC, even I will also become non-SMC. Respond everybody, pakka. That's what your level 1 and holding, level 1 and non-SMC conditions. Shall I proceed further? If any of these conditions are satisfied, it will either become non-SMC or level 1. If all the conditions are not satisfied, then it will become SMC. If all the conditions are not satisfied, it will become SMC. But biggest problem, whether is it level 2 or level 3 or level 4? That's our next thing. Listen very carefully. Listed or in the process of listing, whether in India or outside India, is applicable only for level 1. No, only for level 1. Banking, financial institution, insurance business is also applicable only for level 1 of non-corporate. Now listen very carefully. Extra conditions. Previous year turnover. Take care at the end of the year. Previous year turnover at the end of the year. More than 250 crores. If it is level 2, less than or equal to 250 crores, more than 50 crores. Less than or equal to 50 crores, more than 10 crores. Less than or equal to 10 crores, more than 2 crores. Clear everybody? Nothing, right? 5 times. 2 into 5 into 5 into 5. You will be getting all the things. Clear everybody? And moving on to the next thing. Borrowings plus public deposits of previous year or current year. Very important. At any point of time, even for 1 minute, even for 1 second, if it is exceeding 50 crores, it is level 1. And the next one, less than or equal to 50 crores, more than 10 crores. Less than or equal to 10 crores, more than 2 crores. And finally, less than or equal to 2 crores. It comes under level 4. Respond everybody, clear. This is all about borrowings plus public deposits, conditions. And last, very important, take care. If my holding or subsidiary is level 1, undoubtedly I am level 1. If my holding or subsidiary is level 2, not being level 1, ante neither of the things should become level 1 kada, then automatically I'll become level 2. Take care, listen carefully. If my holding or subsidiary is level 3, not being level 1, not being level 2, because either of my entity is level 2, I will become level 2. If either of my entity is level 1, I will become level 1. Both things are level 3 and I am level 4, not level 4. You are also under level 3. Logic clear? Sir, you are classified under level 3, but your holding company is under level 2, your subsidiary company is under level 4. What you will become? Automatically your subsidiary also will become level 2. A conclusion, all the group companies like holding and subsidiaries will be under same category, like same level or same category. Respond clear. So this is what your types of entities. And one more last and final one, which is important actually. So current year I am classified as SMC. Next year in the next year, say for example it is non-SMC. Exemptions are available. Exemptions are not available. Clear everybody? But subsequently if you are SMC, ante previously you are non-SMC, now you have become, then you will not get exemptions immediately. You have to be in the category of SMC for 2 consecutive years. Only then you are going to get exemptions in the next available year. Respond everybody, pakka. And successfully we have completed the first chapter, that is introduction. But take care, one more thing which is actually important is carve-in and carve-out. I already told you while telling the class also, from Ind AS it might not be important, but carve-in and carve-out may be important. Sir, carve-in and carve-out is a comparison with respect to Ind AS versus IFRS. Take care, not AS versus Ind AS, not AS versus IFRS. It is only Ind AS versus IFRS. What do you mean by carve? Carve is nothing but rule. Carve in ante additional explanation or detailed explanation in Ind AS provisions when compared to IFRS provisions. Where you are getting detailed explanation? Ind AS, and it is called as carve in. Now what do you mean by carve out, sir? Carve out is nothing but deviation. We have deviated the principles which are stated in IFRS, deviated in Ind AS when compared from IFRS. This is called as carve out. What do you mean by carve in? Detailed explanation or additional explanation or extra explanation. What do you mean by carve out? deviation. Clear everybody? Very important. Change in nomenclature. Change in nomenclature. Nomenclature is nothing but name. Do you know that we will call here equity share capital, but they will call their common stock. They will call their common stock. We will call here preference share capital. They will call their preferred stock. For us it is statement of profit and loss. For them it is actually statement of comprehensive income. So these are the change in nomenclatures. Did I give any extra explanation to the rule? No, not a carve-in. Did I deviate from the rule? Not a carve-out. So this is neither carve-in nor carve-out. And last, reduction or removal in options. Likewise, IFRS is giving you 10 methods to follow. But Ind AS is giving out of this method only 6 methods which actually suits to Indian environment. Do you know that there is a method called double declining depreciation method? This double declining depreciation method is not permitted in India. Hope you all people know sum of years of digits method. This method is also not permitted in India. Say for example in IFRS DDDM is permitted. Double declining depreciation method. But you have removed that option. Did you deviate any rule? No. Did you give any extra explanation? No. It is just like reduction in options. So neither carve-in nor carve-out. Clear? What is carve-in? Extra explanation. What is carve-out? Dash and dash. Neither carve-in nor carve-out. Change in nomenclature. Reduction in options. Clear everybody? And that's the end of your topic number 1, introduction. And get ready. Just 2 minutes time. We are going to start framework. Ready? Yeah, you have to get ready. And the next topic is framework. Coming to framework, components of financial statements important for 5 marks. He may ask you a direct theory question, which is nothing but also called as GPFS. General Purpose Financial Statements. Tell me what are all those things? It includes balance sheet, P&L account, cash flow statement, SOC, notes to accounts. I mean to tell statement of changes in equity, and finally notes to accounts. Clear? I'm not going to explain these things because it is very easy, but this is an important question. And next one is qualitative characteristics. Again, this is an important question for 5 marks. And the qualitative characteristics are actually CURR. Which will become a curry. Anyways, what are CURR? Comparability, understandability, relevance, reliability. What are the 4 things? Comparability, understandability, relevance. Clear everybody? Comparability. Very simple. Inter-comparison, intra-comparison. Your financial statements should facilitate all those things. And coming to understandability, your financial statements should be understood even by a layman who is having minimum knowledge in accounts. Something like to tell you, even a software engineer can invest in stock market. Correct or wrong? But how can a software engineer will be studying the financial statements? Basically, it is not possible because he is not having extravagant knowledge on the financial statements. Correct or wrong? But your financial statements should understand even to that person also. At least how much is the profit. At least he will be going through the notes to accounts. Notes to accounts he will be giving. He will be reading the accounting policies. So they must be very clear and they should not lead to ambiguity and confusion. And the next one is relevance. Relevance is like relevant information and relevant period. And very important, relevant items or those items which influences the decision making of the users. Relevance is nothing but your financial statements should consider relevant period, relevant information. Relevant items or those items which influences the decision making of the users. So logically speaking, relevant items are nothing but material items. What are relevant items? And finally, reliability. Reliability is nothing but trust, dependence. Likewise, public can happily depend on your financial statements. How can it be possible, sir? Very, very simple. It is possible when you are following all the other characteristics. Likewise, faithful representation. Under your books of accounts must be faithfully represented. Pick all the vouchers, pick all the bills, and you just prepare the financial statements. That is like faithful representation. And the next one, neutrality. Don't show bias to record the financial statements. Be very, very clear about that. And the next one is like completeness. Financial statements should not become incomplete. Likewise, you will be putting suspense account as balancing figure. Such kind of things should not be done. It must be completed. And the next one, prudence concept. Anticipate all possible future losses but not gains. That's important. And the next one, substance over form. Reality over legality. You always have to follow real kind of situations but not the legal kind of situations. Clear, everybody? So this is what your qualitative characteristics. Next, elements of financial statements are actually important for your case type of questions. Application oriented. Theory they may not ask directly here. They'll ask application oriented. Likewise, he'll give you one question. He'll test you whether is it your asset or not. He'll give you one question. He'll ask whether will it become your liability or not. Anyways, asset is an item which is a right or resource controlled by the business entity arising from the past event, generating the inflows of future economic benefits. Ultimately, it must be measured reliably. Sir, now what do you mean by a liability? Liability is an obligation. Which obligation? Present obligation. What do you mean by obligation? Duty or responsibility. So liability is a duty to settle by the business entity arising from the past event, generating the outflows of future economic benefits. Ultimately, it must be measured reliably. Clear? Now, moving on to the next thing, equity. It's very, very important. Take care. Equity is not a liability because equity is not having present obligation. But take care, preference is a liability as per framework. But as per schedule 3, preference has to be presented under the head share capital, which is treated as equity. No exaggeration, you might get a question. Is preference, share capital, an equity or a liability? 5 marks. So for that, you are supposed to write the definition of liability first and prove that company is having present obligation to repay the preference share capital because maximum redemption period is only 20 years. At any cost, there is an obligation to repay. But for the time being, for the purpose of presentation, we have to follow schedule 3, that is law. Accounting standards cannot override law. And hence, for the purpose of presentation, preference share capital can't be shown under liabilities. It has to be shown under equity, that is share capital. Respond clear? You're supposed to write like this. And the next one, coming to expense and income. With expense, economic benefits outflow. With income, economic benefits inflow. Take care. Asset is inflow of future economic benefits. Liability is outflow of future economic benefits. But outflow of economic benefit is an expense. Inflow of economic benefit is an income. Economic benefit is nothing but cash and cash equivalents. Economic benefit is nothing but cash and cash equivalents. Future, if you're going to get it in future, asset. If you have to pay cash and cash equivalents in future, liability. Clear? And moving on to the next thing, with expense. With expense, asset will increase. Asset will increase. Asset will decrease. Liability will increase. And ultimately, equity or profit will decrease. With income, asset will increase, liability will decrease, equity or profit will increase. Respond clear, huh? Sir, you will be getting a question like this. Expense is an outcome for decrease in future economic benefits. Correct or wrong? Expense is an outcome for decrease in future economic benefits. That is correct. Expense is outflow of economic benefit, but because of expense asset is decreasing. Ante future economic benefit is decreasing. Liability is increasing. Ante you have to pay that kada. Ante your future economic benefit is decreasing. Please be careful with the terminology. He may play you by posing different kinds of questions in MCQs. He may play with you, so take more care. And moving on to the next thing. Yeah, next one, measurement basis. Again, an important question for application oriented. He will not ask it for theory, actually, application oriented. There are 4 types of basis: historical cost basis, current cost basis, realizable value basis, present value basis. Historical cost basis. Historical cost is purchase price plus direct expense only. But as per you may get a question like this. What is the historical cost of the asset? And as per historical cost basis, what is the amount you have to record in the books of accounts? He'll be giving you purchase price 1 lakh, direct expenses 10,000, depreciation 40,000. Did you get my point? Question: what is the historical cost? 1 lakh 10,000. As per historical cost basis, how much asset value will be recorded in the books of accounts? As per historical cost basis, how much value will be asset is shown in books of accounts? 1 lakh 10,000 minus 40,000. Depreciation has to be deducted. Because to show in the books of accounts, you have to deduct depreciation kada. Be careful. Historical cost is purchase price plus direct expense only. But as per historical cost places, purchase price plus direct expense minus depreciation. Current cost, market value of similar asset if business concern wants to purchase the same. Realizable value, market value of same asset if business concern wants to sell the same. Present value basis, present value of inflows of future economic benefits. Might be by using the asset you might be getting some inflows in future years. Those inflows will be brought to the present value, that is at year 0, and you might need to record the same. Respond, is it clear? So that is what your present value basis actually. Understood. And moving on to the next thing, same is applicable even for liability also. Historical cost basis, gross value of a liability minus repayments. Gross value of a liability, what is the total value you have to repay, and you need to deduct repayments. That is historical cost basis. Current cost basis, you would like to raise the similar loan in the market. How much is nothing but your current cost. Settlement value basis, take care, in asset you will be calling it as realizable value, but now you have to call it as settlement value. So settlement value basis is nothing but if you would like to settle the loan immediately, how much you have to pay is nothing but settlement value basis. Last and final, present value basis, present value of outflows of future economic benefits. Clear? Last and final, capital maintenance. Take care. Capital maintenance are of actually 3 types. Financial capital maintenance at historical cost, financial capital maintenance at current cost, physical capital maintenance at current cost. What is the rule for this one, sir? Opening capital is equals to closing capital in rupees. What is the rule for these 2 things, sir? Opening capital is equal to closing capital in units. But this has to be taken at a price of average price index. This has to be taken as a price of specific price index. The index will be given in the question. Likewise, he will be giving opening index is 100, opening price is 2. Closing average index is 120. So that what is the closing price? 2 into 120 divided by 100, you will get 2.4. So opening, if you are having 10,000 units at the rate rupees 2, closing you need again 10,000 units at the rate rupees 2.4. Clear? Say if it is average. If given specific price index is 125, then 2 into 125 by 100, where you will get 2.5. Then closing capital should be 10,000 units. Units should match at 2.5. Clear? If it is financial capital maintenance at historical cost, very simple. 10,000 at the rate 2, even your closing should be also 10,000 at the rate 2. Logically speaking, not this one. 10,000 into 2, 20,000. So you need the same amount, 20,000. Clear? Last and final tagline. Your financial capital maintenance is the capacity to check monetary capacity. Physical capital maintenance is a capacity to check physical or productive capacity. Dash is monetary capacity. Dash is monetary capacity. FCM. What is FCM? Financial capital maintenance. And physical capital maintenance is dash capacity. Hey, response sir. Dash is monetary capacity. Physical capital maintenance is dash capacity. Productive capacity. Clear everybody? And that is the end of your framework. Yeah, let's start the next standard. And the next standard is accounting standard number 4. Contingencies and events which are occurring after the, it is after the balance sheet date but before the date of approval of financial statements by board of directors. What is the procedure? Listen very carefully, very carefully. There is a difference between SA 560, which is your subsequent events. SA 560 is your subsequent events, and AS4. There is a little difference between these two things. Listen, first of all, let me tell you how we will deal it in accounting standard number 4. We'll assume always that books of accounts will be prepared by general management, and after that these books of accounts will be approved by board of directors, and then these will be audited by the independent statutory auditor, and he will be preparing the auditor's report, and the same auditor's report will be given to board of directors again, and these board of directors are going to approve the same. For us, date of approval is this one. For SA 560, date of approval is this one. I hope you have got clarity. There is a difference between these two things, but as per accounting standard number 4, we will be taking the initial approval date itself. Now moving on to the next thing. Sir, year ending, which is nothing but balance sheet date. But it is quite not possible to board of directors to finalize the financial statements on the same date itself. So they will be finalizing on some other date in the next financial year, which is nothing but date of approval. So AS4 deals only with those kind of contingencies and events which are occurring after the balance sheet date but before the date of approval. Understood everybody? Now moving on to the next thing, very important, coming to contingencies. Okay, what happened with contingencies, sir? Those kind of contingencies which are dealt with by other standards, AS4 will not deal. Those contingencies which are dealt by other standards, like accounting standard number 29. Here we are not going to deal with those kind of things. Something like, sir, listen very, very carefully. If it is contingent gain, it's 29 will take care. If it is contingent loss, and if the loss is probable ante more chances of occurring the loss, immediately you have to create a provision. If the loss is possible and equal chances of occurring or less chances of occurring, disclose the same. If it is very remote or very less chances, then you can comfortably ignore the same. Clear? Now, while creating a provision, accounting standard number 7 will ask to create provision for construction contracts. AS 13 will ask you to create a provision for diminution in the value of investments. Am I correct or wrong? So like that, AS 2 will be asking you to create a provision for fall in value of inventory. So like this, there are different standards for creating the provision also. For all those standard, AS4 will not deal. For all those items, AS4 will not deal. AS4 deals with such kind of contingencies and provisions which are not dealt by the other standards. Example, impairment of receivables. Clear? Hey, take care. There is another standard AS28, impairment of assets. Impairment of assets is dealt by accounting standard number 28. There we are going to deal with tangible assets and intangible assets. But receivable in the sense he is a debtor. You are having doubt on the debtor. Debtor value is getting impaired. Debtor value is getting reduced. You are having doubt on the debtor. So immediately create a provision. That will be created as per accounting standard number 4 because no other standard is dealing with the same. Respond logic clear? So those contingencies and those provisions which are not dealt by the other standard will be dealt by AS4. Is the logic clear, everybody? That is the end of contingency actually. Quickly, contingent gain. AS29. Contingent loss which is probable. Create a provision. If it is possible, disclose. If it is remote, ignore. Probable in the sense, more chances of occurring a loss. Possible ante, equal chances. Remote in the sense, very less chances. Or you can, that is like negligible anamata. Respond clear, everybody? Those provisions which are dealt by the other standards will not be dealt by AS4. Deal with such kind of standards which are actually not dealt by other standards. Respond, everybody, pakka. That's it. And now coming to events, very, very important. Those events which occurred after the balance sheet date, but those events which occur before the date of approval of financial statements will be dealt by AS4. Take care. There is a myth here. If a question is given like this, an event occurred, say for example, as on the balance sheet date, you are having a condition, but the confirmation is you have got at this point, that is after the date of approval. Okay. Will it be dealt by AS4 or not? But students are writing it as a non-adjusting event. That is wrong. Student, did you get my point? In the question, he will be specifying an event occurred after the date of approval. How it will be treated in the financial statements of the previous year? That is a question. Students are writing that it is a non-adjusting event. You should not write it is non-adjusting event. It is not an event as per accounting standard number 4. Take care, you are having questions like this. In one question, the answer is very clear. Not an event as per AS4. But in another question, in the solution itself, he had given it as a non-adjusting event. In our material, in one question, he had given that it is not an event as per AS4. In another question, he had given that it is a non-adjusting event. Clear? But better don't write non-adjusting event. It is event occurring after balance sheet date and also after the date of approval. So dealt by AS4 or not dealt by AS4? Write the same. It's not dealt by AS4. Clear, everybody? Fine. Let me tell you the overlook of events now. What is accounting standard number 4? Contingencies and events occurring after. Already we have completed the concept of contingencies. Now started with events. Coming to events, listen very carefully. Sir, everybody will tell. If you have grip on provisions, you can answer. That is 200% correct. This is a marathon where I'll be brushing up all the provisions for you. Literally speaking, if you have listened carefully, that standard revision will be completed in this marathon itself. So that you can just happily go open the sums and you can solve it. Yes, happily you can do that. Assurance on my end, I'm going to revise each and every provision for you to the chapters that are covered here. So take more care. Anyways, let me start coming to events. Events are of two types, adjusting events and non-adjusting events. Now coming to the next thing, what are adjusting events and what are non-adjusting events? First, all-time favorite, non-adjusting events. Because those events which are not adjusting events or non-adjusting events. Now coming to adjusting events. What are adjusting events? See, it's not like that. Adjusting events, 3 conditions are there. How many conditions? Condition number 1, very, very important. There should be a condition existing on the balance sheet date. Sir, this is common for both contingency and event also. Even for contingency also, condition should be existing on the balance sheet date. Clear everybody? There is a condition or situation existing on the balance sheet date. Basing on that situation existing on the balance sheet date, you should get further evidence. That further evidence or additional evidence you should get after the balance sheet date but before the date of approval. And finally, it should be material. Because hope you all know that standards are applicable only for dash items. They are not applicable for immaterial items. Clear everybody? So all you people are like immaterial fellows. I am like material fellow. Clear everybody? So take care. Adjusting events. How many conditions are there? Cheppali, what is condition number 1? Conditions or situation existing on the balance sheet date. Basing on that situation, you should get further evidence or additional evidence confirming that situation. And finally, that must be material. Respond clear. If that is not an adjusting event, it will become. Now, moving on to the next thing. Listen very, 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 very carefully. You are negotiating as on a balance sheet date. You are negotiating as on a balance sheet date to purchase a company. Clear? And yes, you have got the confirmation after the balance sheet date but before the date of approval. After the date, before the date of approval. Is it adjusting event or non-adjusting event? Adjusting or non-adjusting? Why non-adjusting? This is obviously non-adjusting event because negotiations does not amounts to conditions. Sir, why negotiations does not amounts to conditions? Very, very simple. Negotiation in the sense it's something like bargaining. You are telling 1 crore, I am telling 80 lakhs. This is what happening as on the balance sheet date. But after the balance sheet date, I have accepted it for 75 lakhs. You have accepted it for 75 lakhs. We have accepted it for 75 lakhs, not with respect to the conditions existing on the balance sheet date. Chala mandiki enti telsa? Negotiation does not amount to condition. Okay, but why? They don't know. Because many of the students ask like, sir, the same deal is done today, right? The same deal is done today. So in such a case, negotiation is a condition kada? No, because on that day situation is different, on this day situation is different. Basing on the situation existing on the balance sheet date, you should get additional evidence. Balance sheet date situation is 70 lakhs. And if it is okay for you and okay for me, we both might have agreed the same deal. But that is not okay for us on that day. That is okay for us on the next day. Next day conditions are different. Today you have asked your father to purchase a bike. He is telling no. You have cried. He shouted. You have shouted. Everything happened. Close. Knock the door. Throw out the door. Went into the room. Slept on the bed. Okay. Next day, you both have come to a compromise. I'll purchase a cycle for you. Your father told. And being you are thinking like, I have to go from my home to study hall. So, yeah, cycle is better. Instead of having no bike, cycle is better, right? You have compromised. Because situation demands. Situation on the previous day is different. Situation on today is different. Did you get my point? The same was not continued. You have accepted because you have thought about the situations and situations were actually changed. Clear? Or today you've come to a deal for purchase of a cycle. But tomorrow your father told, yeah, I'm going to purchase a bike. Reason being you have to travel all the way for 20 kilometers. You can't travel it on cycle kada. Car, fathers have to sell their assets. Anyways, I hope you have got clarity actually. Negotiations will not amount to conditions because on that day conditions are different. On the next day conditions are actually different. Respond, is the logic clear? So negotiations will not amount to condition and hence they are actually which events? Non-adjusting events. As on the date of balance sheet, market price is 80. Okay. Your cost price is 100. You are expecting that this amount, market price will increase in future. So as expected, after the date of balance sheet, but before the date of approval, the market price has raised to 130. So now company is telling, yes, I'm having a condition existing on the balance sheet date. What is the condition? Expected that market price will increase, sir. Will that amount to condition or not a condition? Market conditions are different on different days. On that day, market condition is different. Depending on the conditions on that day, market price is 80. Depending on the conditions on today, market price is 130. So this evidence is not basing on the situation existing on the balance sheet date. This is a different situation. Respond everybody clear. And next one. So you please understand the question like, is it the situation existing on the balance sheet data, not the situation existing on the balance sheet date? Say for example, you can link both AS1 and AS4 in the following example. Likewise, negotiations were concluded as on the balance sheet date itself. Concluded. Hey, but take care. Possession was not yet transferred. Negotiations concluded, possession transferred aite, it's obviously like substance over form you can apply and that asset can be recorded in my books. But now negotiations concluded. But possession not yet transferred. But the possession was transferred after the balance sheet date, but before the date of approval. Adjusting or non-adjusting? Chepali. This is obviously adjusting because as on the negotiations that were concluded on that day, basing on that date situation, today I am handing over the key for you. It's not a new situation now. Logic clear? So this is which event? Adjusting event. Pakka. Now moving on to the next thing. Contracts entered. Which event? Contracts entered. After the balance sheet date, they have entered into some contracts, but before the date of approval. Adjusting or non-adjusting? Non-adjusting. As on the balance sheet date, I am thinking, I may issue shares in the next year. According to that, after the balance sheet date, but before the date of approval, I have issued the shares. Adjusting or non-adjusting? Non-adjusting, all these things will not amount to condition. Your thinking ability is nothing for me. Respond, is the logic clear? Pakka. Yeah. And next one, if you have remembered something like a pipeline question, they will be entering the contract here, contract entered here. Okay. They will be finding the pipeline here. I mean, they will be finding the rocky surface here. Did you remember? That rocky surface was found after the date of approval. Adjusting or non-adjusting? That is what I am telling. Don't write it as non-adjusting. It is not dealt as per AS4. That's what I am actually telling. Because this is done after the date of approve. If you want, you can write like this. This event is not dealt as per AS4 and hence it is not to be adjusted in the financial statements of the previous year. Not to be adjusted is different from non-adjusting event as per AS4, because non-adjusting event is actually the terminology. It is having one definition. It is having one treatment. Not to be adjusted is like regular language. Respond pakka. Fine. That is a concept of your rocky surface problem. And remember, if at all you have found the rocky surface on this date, adjusting or non-adjusting? Adjusting. Because conditions are existing on the balance sheet date. What is that condition, sir? Contract. And the next kind of problem is checks in hand. I'll remind the question. And the question is actually like, you have received the check after 31st March. But the date of the check is before 31st March. You are receiving the check after 31st March. On 2nd April, you have got a check. On 2nd April, you have got a check. But the check is having a date of 29th March. Respond, is it clear? Answer. Will it has to be recorded in the previous year or next year? Next year. It's as simple as such. I asked you to pay the fees today. To escape from the penalty, you are putting the check date before 1 month. Hope you have understood. Possible? Not understood with the question? Sorry. 1/1/2013 is the cutoff date. You have to pay the fees on this date. But on 1/2/2013, you are giving me a check. And you have written a date of 31/12/2012. And you are telling to me, sir, I'm paying you fees now. But the date is 31/12. So please cancel my penalty. Hope you have got my question. This is the due date for the payment. You did not pay on this date. You are giving on this date. But you kept a date 31/12. Clear? Yeah, check is actually valid for 3 months kada. So he wantedly kept the date 31/12 thinking that my penalty will be abolished. You are giving the check today to me. So which implies that payment is only today. When the check date you have kept is absolutely not needed for me. Logic clear? So don't do extravagant televitatalu, which is like absolutely wrong and you can't escape from the penalty. And my intention of giving this example is, even though you are getting a check which is dated before 31st March from a debtor, it will not become an adjusting event because you don't know anything. You have received just now. So since, sir, take care, there is a difference between transaction and event. Now this standard is actually dealing with event, not a transaction. A debtor giving check is payment, abba. Payment is a transaction. It's not an event. I hope you have got the logic. And finally, take care. Checks in hand, whatever question is there, it's obviously a non-adjusting event. Clear? And as like all-time favorite example, before 31st March, we have sold the goods. And before 31st March, debtor premises was caught by fire. After 31st March, but before the date of approval, he had declared insolvency, which is obviously which event? Adjusting event. All-time favorite question in this. Here everybody, this is an adjusting event because condition is existing on the balance sheet date. And also additional evidence is there. Condition is nothing but fire. Doubt on the debtor. Additional evidence, he had declared insolvency and ultimately your double poya. Clear everybody? And ultimately your money had gone and at the end of the day, it will become which event? adjusting event, which has to be adjusted in current year or previous year. Previous year financial statements. I mean to tell, which has to be adjusted before 31st March or after 31st March. Before 31st March. Clear everybody? But there's a problem here. I'll ask you, please be very, very careful. Year ending 31/3/2013. Here event occurred. He had declared insolvency. Adjusting and non-adjusting. Yeah, everything is same. Sold goods here, fire accident here, everything same. Insolvency here, same question, ma. Adjusting and non-adjusting. Adjusting and non-adjusting. That's an adjusting event. Clear, ah? Can I record bad debts before 31/3/2013? Since it is adjusting, can I record bad debt? No. I can create provision for bad debt because bad debt is a transaction. Bad debt insolvency declaration is a transaction. He is supposed to record that insolvency declaration only after 31/3. Clear everybody? But before 31/3 I can't create bad debt, but I can create a provision for bad debt, and I hope with this you have got clarity. And last and final thing, adjusting event has to be adjusted in the previous year financial statements, which will alter the figures of assets and liabilities. Which will alter the figures of assets and liabilities. Clear everybody? Whereas coming to the next one, non-adjusting. You are not supposed to adjust the same. Yes, you are not supposed to adjust the same. But it will be disclosed in director's report. That is like approving authorities report. It is not to be disclosed in financial statements. It has to be disclosed in approving authorities report. Respond everybody, pakka. That's it. Last but not least, with this AS4 will get closed, which is nothing but if at all going concern is affected. If at all law is asking you to adjust, even though, yes, statutory requirements, even though they are non-adjusting events, they must be adjusted. Something like on 30th, sir, a company is telling, hey, on 31st March, I thought like earthquake will come in future, abba. And accordingly, after balance sheet date, but before the date of approval, earthquake had come. So I thought condition is existing on the balance sheet date. Papa solo, get out from my class. Clear everybody? That will amount to condition or will not amount to condition? That will not amount to condition. Clear everybody? Earth situations are different on balance sheet date, and earth situations are different on the date when the earthquake occurred. So situations are different, and hence it is not a adjusting event. But because of this event, if your going concern had affected, then you have to adjust. Clear everybody? And even the same logic is applicable for declared dividend. You will be declaring the dividend in the next year after the date of approval, but you will be proposing even in the next year, that is after the date of approval, but that dividend is relating to the previous year. Correct or wrong? Proposal was done on the current year and next year. Next year. But even though the proposal was done in the next year, you can disclose the same in financial statements under note 2, reserves and surplus. Proposed dividend or declared dividend? Hey, is proposed dividend a liability or not a liability? Chepali. Dash is a liability. Declared dividend is a liability. Is proposed liability or not a liability? Is declared a liability or not a liability? Yes. Even though proposed dividend is not a liability, even though it is adjusting or non-adjusting. Non-adjusting event, it can be disclosed in note 2, reserves and surplus. Take care, my dear children. All the non-adjusting events have to be disclosed in approving authorities report, but not in the financial statements. But proposed dividend is a different. Proposed dividend, even though it is non-adjusting, it will not be disclosed in approving authorities report. It will be disclosed in financial statements, note to reserves and surplus. He'll ask you a simple question like this. Dash is a non-adjusting event which is disclosed in financial statements. ఇప్పుడు కాదు అప్పుడు రాయాలి అది. Anyways, clear everybody? That is the end of accounting standard number 4. Amma, just one more small thing would like to update in AS4. These things were actually given in the standard itself. Mergers or acquisition, investments or reconstruction, issue of shares and debentures, purchase or sale of fixed assets, changes in exchange rates, etc. after the balance sheet date are not adjusting events. In the sense they are non-adjusting events. Take care, mark to this one, because this was given directly in the standard. To tell you in your RTP, the same question is there. I mean, question was not there, but in RTP, in the paragraphs, this paragraph was inserted. Same copy paste, which is directly from the standard. So take more care. And no, it was not like that. It was not dealt as per AS4, which implies that they will be something like non-adjusting event. It was given in the standard as they are non-adjusting events itself. Maybe akkada not as per AS4 అని వచ్చి ఉండొచ్చు. అదే నేను చెప్తుంది, అక్కడ అంటే ఇక్కడ కూడా అదే మెటీరియల్ ఇక్కడ ఓపెన్ చేసింది. Logically speaking, they are not adjusting events which were given in the standard itself. Take care. And shall I continue? Sir, 2 minutes అంటున్నారు సార్, 1 minute is మరి ఫాస్ట్గా అయిపోవాలి కదా. ఫాస్ట్గా అవ్వడం కాదు, సిలబస్ కవర్ చేయడం ఇంపార్టెంట్. సో లెట్ మీ స్టార్ట్. అకౌంటింగ్ స్టాండర్డ్ నెంబర్ 5. వాట్ ఈస్ అకౌంటింగ్ స్టాండర్డ్ నెంబర్ 5? నెట్ ప్రాఫిట్ ఆర్ లాస్ ఫర్ ద పీరియడ్, prior period items and changes in accounting policies. Coming to period items are actually divided into 2 types, ordinary and extraordinary. Again, ordinary are divided into 2 types like ordinary and general, ordinary and exceptional. Take care, very important. Exceptional items classification is not given in accounting standard number 5. Ante AS5 told some items which are ordinary in general have to be disclosed separately. Ante. But those items which are ordinary and general which have to be disclosed separately are called as exceptional items as per schedule 3. The word exceptional items is nowhere used in accounting standard number 5. The word exceptional items is used as per schedule 3. Now coming to ordinary and extraordinary. If it is relating to daily activities of the business, if it is relating to the due course of business, then it will become ordinary activities. If it is not at all related to your daily activities of the business, but your business gets affected because of earthquake, because of tsunami, okay, all these things will become extraordinary items. Like all you people, fire accident occurred. Is it relating to your business or not relating to your business? Take care. Listen. Fire accident is not your business actually. Lighting the fire in each and every business concern or each and every branch. It's not your business, but your business gets affected because of that fire accident. And hence it will become an extraordinary item. If it is relating to daily activities of the business, it will become ordinary item. If it is daily activities and if it is daily occurred, it's general. It's quite common in business, but it will not occur regularly. Exceptional. Sale of asset. Is it common in business or not? Yes, but it will not occur every time. So it will become exceptional. Clear everybody? Sir, creation of provision is ordinary and general. Creation of provision is common, but nobody will think that created provision will be reversed. But even it might also happen. So it is ordinary and exceptional. Stock stolen through theft, extraordinary. Stock manipulated by the storekeeper. Stock manipulated by the storekeeper. That is ordinary but exceptional because it is quite common. Cash loss due to fire accident. Stock loss due to fire accident. Cash manipulated by the cashier. Ordinary and exceptional. Stock manipulated by the storekeeper. Ordinary and exceptional. Clear everybody? And you are supposed to disclose exceptional and extraordinary separately. Ordinary no need to disclose at all. Again take care. This is very very important. Exceptional items given in the standard itself. Writing down the inventories to NRV and reversal of such write down. Sir, valuation of inventory rule is equal to dash. Cost or NRV, whichever is. Generally what will be lower? Cost or NRV? Generally what will be lower? Cost will be lower. So generally inventory will be valued at cost price. But situations might come where the selling price is also lower. At that time you have to record it at NRV. But every time do the NRV is lower. So it's an exceptional item. And a valuation of inventory at cost is expected. But valuation of inventory at NRV in the sense your selling price is less. Logic clear? And the next one, restructuring. You are having an accounting standard number 29. Provision for restructuring, something like that. Did you remember? So restructuring whatever is there, it is dealt by AS 29 and restructuring provision is also an exceptional item. Restructuring is nothing but, now we have to shift from this class to another class. That's a restructuring activity. Something like they are doing the business under labor intensive technology, but they would like to shift it to capital intensive technology by using the machines. It's a restructuring. Reorganizing is nothing but restructuring. The next one, sale of fixed assets, exceptional item. Very important, litigation settlements. Litigation settlements. In court of law, some damages claim, etc. and etc. That also will become exceptional item. Hey, take care, it's not extraordinary. Exceptional, because it is quite common that litigation settlements you have to pay, you have to receive, that's quite common. But it will not happen on every day. And the next one, retrospective applications. Yeah, in business retrospective is quite common, but it will not happen on every day. So it becomes exceptional items. Take care. Pilferage, embezzlement of cash and stock by cashier and storekeeper are exceptional but not extraordinary. Take care. But if at all the same was lost in fire accident, that is extraordinary. Clear everybody? Yes. Moving on to the next thing, prior period items. So take care. Prior period items are nothing but items of income and expenses which are relating to the previous year, identified in the current year. Sir, why relating to previous year are identified in the current year, sir? Due to errors or omissions. Due to errors or omissions. Clear everybody? And what do you mean by omission? Reliable information available but not considered. Information is there but you did not consider. And coming to error. Error is nothing but, what is error? Wrongs done, which is like miscalculations, misinterpretations, or unaware of accounting policies. Clear everybody? All these things are actually called as prior period items. Very, very, very important. Listen. If prior period items, if prior period items are identified after the balance sheet dates but before the date of approval of financial statements, it has to be adjusted in the previous year financial statements as per AS4, because that was already happened in the previous year kada. Clear? Prior period items after balance sheet date but before the date of approval have to be adjusted in the previous year financial statements as adjusting events as per AS4. If so, those prior period items were identified after the balance sheet date, then it is not as per AS4, it will be as per AS5. You have to separately adjust and separately disclose in statement of profit and loss. Respond pakka. That is prior period items. And moving on to the last and final one, changes in accounting policies. Sir, it is changes in accounting policies, but even changes in accounting estimates are also dealt. Nothing great. Very important, listen. Sir, we have decided to provide the provision previously, but now decided not to provide the provision. It is change in accounting policy. Last year we are having provisions, but current year decided not to create provision at all. Your policy is changed and hence you are not creating the provision. Sir, last year provision there, current year also provision there, but amount is different. Estimate. I hope you have got the difference actually. Sir, decided that providing provision to not to provide the provision. Change in accounting policy. Provision is there, but amounts are different. Change in accounting estimate. Respond pakka. Very, very important, listen. If it is accounting policy, change in such item is also change in accounting policy. If it is accounting estimate, change in such item is also change in accounting estimate. Likewise, valuation of inventory from FIFO to weighted average. What is this one? Accounting policy. So this one is called as change in accounting policy. Ante kada. Valuation of fixed assets. Yes, it's an accounting policy. You have changed from cost model to revaluation model. Change in accounting policy. Provision amount estimation is accounting estimate. Amount changed from 5% to 3%. Change in accounting like that. If something is accounting policy, change in that something is change in accounting policy. If something is accounting estimate, change in that something is change in accounting estimate. But exception only for the following item: depreciation, accounting policy. But change in method of depreciation is change in accounting estimate. I hope you have got the difference why I have actually told this one. Ardhamainda? If something is policy, change is also change in policy. If something is estimate, change is also change in estimate. But this one is not like that. If something is accounting policy, like depreciation is an accounting policy, but change in method of depreciation is change in accounting estimate. Respond, is the whole logic clear? Take care, that's very important. Okay, he might ask, company had chosen the method of depreciation. It's an accounting policy. Company has decided to change the method of depreciation. Change in accounting estimate. So please get that difference. That's very important. Shall I proceed further? And nothing great to discuss with change in accounting estimate. Only one thing. If at all any estimation is changing, you have to give the prospective effect. Which effect? Now the next one. Change in accounting policy. Which effect you have to give? That effect was not dealt in AS5 at all. But if any policy is changed as per Ind AS, you have to give retrospective effect. Respond clear? A change in accounting estimate aithe prospective. Change in accounting policy aithe retrospective effect. AS5 dealt or not dealt. But as per, you can follow which effect, amma? Retrospective. Clear? Given a question like this, how the change in accounting policy is dealt? One of the options, not dealt as per AS5 is there, also retrospectively is there. What is the correct answer? not dealt as per AS5. If that option is not there, retrospective effect. I hope you have got the logic. And listen very carefully. Sir, I have chosen one policy. Do I need to follow the total policy continuously? Of course, yes, you have to follow. Ante kada, which is called as consistency, dealt as per AS1. But this can be this can be broke for. Okay, which is dealt as per AS5. Logic clear, huh? Follow the same policy. Who is telling? AS1. You can break this. Follow different policies. Even the same was dealt by AS1, but when can you follow different policies? Is dealt as per AS5. In the following three situations: when it is permitted by accounting standard, when it is permitted by statutes or law, better presentation in financial statements. Cheppandi, permitted by standards, permitted by better presentation in financial statements. Respond everybody, pakka. This is what your accounting standard number 5. Clear? So now they can change the policy provided they have to give which effect, amma? Which effect? Retrospective effect. Sir, I have changed this one, but I don't know what is this. Is this change in accounting policy or change in accounting estimate? Management is unable to decide. In such a case, you have to treat it as change in accounting estimate. Respond clear? Don't ask me example because I don't know. Searched a lot and lot for this one, but I did not get it. If management is unable to decide whether it is change in accounting policy or change in accounting estimate, it has to be considered as change in accounting estimate. Very important. The following two things are not to be considered as change in accounting policies. Number 1, introduction of a new accounting policy. Till now that policy is not there. For the first ever time you have introduced. So it is not an change in accounting policy. And the next one, you are supposed to change the accounting policy, but wantedly not, since the substance of the transactions changed, underlying transactions changed, so you are supposed to change that. You are not having other option. Likewise, VAT is changed to GST, service tax is changed to GST. You are having some policies when you used to follow service tax and VAT, but whenever it had come to GST, all your policies should change. Am I correct or wrong? So this is also not to be considered as change in accounting policy, because you are not changing it voluntarily. Since the underlying transactions have changed, I am supposed to change. Clear everybody? Previously I used to follow FIFO method, but now I am supposed to change to weighted average method. Listen. Why I am changing? Because underlying transaction, purchase of inventory is changed. Previously another type of inventory and hence FIFO. Now another type of inventory and hence weighted average. Can I tell this as change in a method of inventory? No. This is not a change in accounting policy. Sir, 1 second. This is change in method of inventory only, but this is not a change in accounting policy, because you have shifted from FIFO to weighted average, not for the same inventory, but for the different inventory. Respond everybody, pakka. Fine. So let's give a break at this point. And the next standard is accounting standard number 7. What happened? What is accounting standard number 7, Amma? Construction contracts. So coming to construction contract, first of all, you are supposed to know the scope. So construction contract is applicable only for contractors, but not for contractees. For contractees, there will be some specific standards. Those specific standards are actually applicable for contractee. Likewise, if it is a construction, then automatically, I mean to tell, if it is a construction of building, Then for contractee, accounting standard number 10 is applicable. Clear? And for all the constructions, whatever, for contractor, accounting standard number 7 is applicable. Clear? And very, very important, take care. If at all, the contractor is doing the business of purchasing and selling lands and buildings or constructions in his own account or in his own name, which is totally similar to real estate. Clear? For that thing, accounting standard number 7 is not applicable. Ante contractor himself is constructing the building, selling the buildings, constructing the buildings, sell the buildings. So for construction and sale of buildings which was undertaken by the contractor himself, then accounting standard number 7 is not applicable. Clear everybody? 7 is applicable only to those type of contractors who are rendering the service for the purpose of contractees. Understood? Now, moving on to the next thing. As simple as such, in this standard, you are supposed to learn what is a contract revenue, what is a contract cost, and what is contract profit or loss. As simple as such. Again, same. First, you just draft a contract account. And in contract account, you are going to get credit side by contract revenue, debit side to contract cost. Finally, you are going to get either profit or loss. Clear everybody? Now coming to contract revenue, how much, sir? There are two types of methods for this. Number one is completed service contract method, proportionate completion method. But completed service contract method is not permitted as per accounting standard number 7. Yes, in standard they have mentioned this method, but they have clearly told that this method is not to be followed. So you have to follow only proportionate completion method, or it is also called as percentage of completion method. There are three options for this thing again: physical proportion method, survey method, very important, cost to cost method. In almost every problem we will be solving only under cost to cost method. Sir, what do you mean by cost to cost method, sir? Cost incurred till date. Cost incurred till date. Whole divided by total estimated cost multiplied by 100. Clear everybody? Cost incurred till date divided by total estimated cost multiplied by 100, which is nothing but cost to cost method. In majority of all the problems, you have to follow only cost to cost method. You don't concentrate on physical proportion method and survey method at all. Clear everybody? That is what your contract revenue. And now contract revenue includes many components. Take care. Contract revenue includes initially agreed amount. And first of all, in contract, how much ever amount is mentioned, that is called as initially agreed amount, which is subjected to escalation clause. What do you mean by subjected to escalation clause? If price rises, automatically contract price also will increase, which is called as escalation clause. Clear everybody? And the next one, variations. Take care, variations. Variations can be proposed either by contractor or even by contractee also. Variations can be proposed either by contractor or even by contractee, and the other party has to approve the same. Likewise, initially 3 floors, but now they have increased it to 4 floors. Or initially 3 floors only, now also 3 floors, but entire interior designing is changed. Automatically some sort of variation is there. For this kind of variations, for these kind of variations, whatever, if one party is proposing, the other party has to approve. And if the variation is includes more work to be done, contract price will increase. If variation includes less work to be done, contract price will decrease. And the next one is claim. Claim will be generally proposed by contractor to contractee. Say contractee had given a wrong design. Contractor had constructed as per that design. But exactly after 1 month, contractor is telling, sir, very sorry sir, this is not my design. So contractor told okay and remodeled everything. And now he can claim the same amount from the contractee. So claim is always proposed by the contractor and it has to be approved by the contractee. But variation is different. It can be proposed either by contractor or contractee, and it has to be approved by the other party. But claim in the sense you might have incurred some extra amounts, and those extra amounts can be asked and reimbursed by the contractee. Understood? And the next one is incentive. Incentive is an additional amount which is paid for exceeding or surpassing the performance. Exceeding the performance or meeting the quality performances, standard performances. Clear, everybody? So incentives are like additional amounts for meeting the standards or for exceeding or surpassing the standards. And last but not least, penalties. If contractor had done any mistake, then automatically he will be charged with some penalty. So automatically his price will decrease. Understood? Last but not least, very important, each and everything must be measured reliably. And claims, whenever you have got something to write the claim in the provision, don't forget the word claim is negotiations which reached the conclusion stage. What are claims, Amma? Negotiations reached the conclusion stage. Maintain that word. Incentive, for meeting the standard performances or exceeding the standard performances. Penalties, for the faults done by the contractor. Variation, that is variation in plan. Clear, everybody? Escalation clause, raise in prices, raise in contract amount. Pakka. That is the end of contract revenue. Last but not least, with contract revenue. Listen very carefully. If at all the outcome of the contract is certain, if the outcome of the contract is certain, follow percentage of completion method. If the outcome of the contract is not certain, if the outcome of the contract is not certain, then you have to recognize only to the extent that is recoverable. Say your contract price is 100 lakhs, but the outcome of the contract is not certain. It might be something that I may leave the contract in half. Contractor might not fully complete, or contractee, you are having doubt on contractee, he may not release the full amount, all these kind of things. So outcome of the contract is certain or uncertain. If it is certain, follow percentage of completion method. If it is uncertain, you have to recognize only to that extent which can be recoverable. Pakka. So that is what your percentage of completion method. And when the contract is certain, when the outcome of the contract is uncertain. Understood? And that is the end of total contract revenue. Now coming to contract cost. Very, very simple. As and when incurred, you book that contract cost in the contract account. As and when incurred, you put the contract cost in the contract account. Clear? That is what all about contract cost. Now contract cost might include direct cost, allocable cost, specifically chargeable costs. What do you mean by direct cost? Which are directly attributable to a specific contract. Allocable cost ante cost incurred for more than one contract, and that cost has to be allocated to all the existing contracts. And finally, specifically chargeable contract. Initially, they are not at all relating to the contract. Okay. They are something like research and development expenses or general administration expenses. Okay. Such kind of things will be there. These will be charged as contract cost only when there is a clause of reimbursement by the contractee, which is specified in the agreement. Clear, everybody? Initially, specifically chargeable costs are not relating to the contract, but you have to specifically charge to a particular contract if you are having an agreement with the contractee that those costs will be reimbursable in nature. Understood? And moving on to the next thing, profit or loss. Sir, it's not possible to cover each and every point. In contract cost, I have still left out cost for securing the contract. Cost for securing the contract. You just read that, you'll understand. Cost for securing the contract is nothing but you have incurred some cost in order to secure the contract. In order to get a contract, you are incurring some cost. Will it be a part of contract cost or not? Will it become a contract? It will become a part of contract cost only if the outcome of the contract is certain. If you're pretty sure that you're going to get the contract, then cost incur for securing the contract has to be charged to contract account. Sir, no sir, we have incurred cost, but that contract will not get to us. Then okay, immediately take and charge it to P&L account. Clear everybody? Fine. Like that, some other elements are there. Just go through those. And the next one is profit or loss. Very, very simple. Very important also. For each and every contract, you have to prepare a separate account. You can't mix all the contracts with a single account. For each and every contract, you have to prepare a separate account. Clear everybody? And you might get profit or loss, which has to be transferred to general P&L account. You might get profit or loss which has to be transferred to general P&L account. So from contract account you will be transferring the profit or loss directly to the general P&L account. Respond pakka. So this is what your contract account. Now very important, provision for loss. Sir, you have to create provision for loss if at all contract costs are exceeding contract revenue. Contract costs are exceeding contract revenue. If contract costs are exceeding contract revenue, immediately you have to create the provision irrespective of commencement of contract. Whether you have started the work or not, I don't bother. Book the total loss. Total loss. You have to create provision for the total loss irrespective of commencement of contract, irrespective of percentage of completion, irrespective of profit from the other contracts if separable. You can't claim, sir, 10 lakhs is the loss estimated on this contract, sir. How much is the loss estimated? You can't claim something like, contract not yet started, kada, no need to recognize. No. Since already you know whether or not contract is started, you have to recognize entire provision for the 10 lakhs. Hey, my percentage of completion is only 60%, kada. Let me recognize only 10 lakhs into 60%, 6 lakhs loss. No. You have to recognize entire 10 lakhs. Also, you can't claim, sir, loss from this contract is 10 lakhs. But no worries. I'm having other contract where I can get a profit of 15 lakhs. So I don't book this one. It won't work out. Irrespective of profit from the other contracts if separable. I don't bother. You have to create a provision. Respond pakka. And last and final concept of accounting standard number 7, combining and segmenting. You have to combine only when the following conditions are satisfied. You have to segment only when the following conditions are satisfied. Combine the contracts ante you are having different agreements. Same agreement or different agreements. But different agreements can be combined and you can treat as if it is a single contract. When can I do like this, sir? When the negotiations are done on an overall basis. When the contract cost and contract revenue are not identifiable separately. And whenever you are having overall profit margin. Clear? Negotiation is done on an overall basis. Contract cost and contract revenue are not identifiable separately, which implies that work is done either simultaneously or sequentially. Simultaneously ante simultaneously every work is started. Sequentially ante one after other immediately work is started. Clear? And last, with overall profit margin. For each and every contract you can't separate. Overall profit you have negotiated. Clear? In such a case, even though the contracts are different, you can treat it as a single contract. Understood? Now coming to segmenting. Sir, segmenting is nothing but you have entered into a single contract which has to be separated into 3 to 4 different contracts. When, sir? Exactly opposite to these conditions. When it is negotiated individually. When contract cost and contract revenue can be identified separately. When profits can be identified separately. Then you are going to segment the same. Respond, is it clear? So this is what the standard. And last, disclosures. Disclosures is actually important for this standard. Now coming here, what are the disclosures that are to be done as per accounting standard number 7? Listen very, very carefully. Sir, if it is a completed contract, what is contract revenue? And what is the method of recognizing the contract revenue? Clear, everybody? That's the only thing you are supposed to do. If it is a completed contract, what is a contract revenue? What is a method of contract revenue? And if needed, you can also give some other things like profits. You can also disclose what are the profits. And very important is all about this one. Contracts which are work in progress. This is very important. Contracts which are work in progress. Listen very carefully. What is the contract revenue? What are the contract costs? What is the contract revenue? What is the percentage of completion method? And what is a method for recognizing the contract revenue? Like proportionate completion method, completed service contract method. If percentage of completion method is followed, again which method is followed? That one. Very important. How much are your advances? How much are your retentions? Clear, everybody? Last and final, gross amount due to customers or gross amount due from customers. Actually, this is not important. Completed contract. Contracts work in progress is very important. Nothing great to by heart. Think with common sense. Contract revenue recognized, contract cost recognized. Okay. Next one. Percentage of completion method. Method for recognizing the contract revenue. Next, advances, retentions. Whether did he give any advance or did he retain something? He did not release the amount. And last and final, gross amount due to customer or gross amount due from the customers. Respond pakka. Now, contract cost is nothing but work certified plus work uncertified. What is contract cost, Amma? Work certified plus work uncertified. Clear. Now, last one, gross amount due to customer or due from customer is nothing but contract cost incurred plus profit or minus loss. Hey, ultimately this is nothing but your contract revenue, Abba. But that is expressed in different style. Cost plus profit, revenue. Cost minus loss, revenue. Clear? So contract cost plus profit or contract cost minus loss is nothing but contract revenue. You have to get this much. You have to get this much. Very important. Minus. How much already you have received? How much already you have received? That is amount received. Amount received. Very important. This might include progress billings also. Progress billings in the sense billing done and released okati. Billing done but not yet released okati. Respond, everybody. Clear? Fine. Just take care. Let me go with little terminology here. Disclosures. Check out. Contract revenue. You can also write contract cost. And the next one, what is the method used? What is the percentage of completion? What is the contract in progress as on the balance sheet date? Likewise, here I told you contract cost and cheppam kadandi. So contract cost, profit, if any advance received or if any retention is done. And finally, gross amount or gross amount due to or due from customer. What is gross amount due to or due from customer? Cost incurred plus profits minus losses minus progress billings. Billing raised amount only, whether amount is received or not, minus amount already received. Clear? Cost incurred plus profit minus losses. Cost incurred plus profit minus losses. Okay, minus amount already received minus Progress billings done, but amount was not yet received. Respond everybody pakka. And this is the end of accounting standard number 7. Let me tell you one very important model of problem that is being asked here. See the question. First of all, you have to find percentage of completion. First of all, you have to find percentage of completion. Percentage of completion is nothing but cost incurred till date divided by total estimated cost multiplied by 100. After that, immediately draft contract account by contract revenue. Total contract revenue multiplied by percentage of completion. Clear? And the next one, to contract cost. Cost which was actually incurred. Understood everybody? And finally, you need to recognize profit or loss. Remember, one point is actually very, very important. If it is profit, the work was over. Problem was solved. But if it is loss, then you have to do one more step. That is nothing but to find provision for loss. How to find for provision for loss, sir? Very, very simple. You have to take total estimated contract cost minus total contract revenue. Then you are going to get total loss to be recognized. Already here you will be having one loss kada. Then balancing figure is nothing but loss. Let me give you an example. Be very, very careful. Logic clear? Immediately and quickly. Which account you have to draft? Contract account. Credit side, contract revenue. Debit side, how much contract revenue? Total. No, don't tell me the amount. Tell me the format. Total contract revenue multiplied by percentage of completion. You book the incurred cost in contract cost and find profit or loss. If profit, any problem? No. If profit, it's okay. And if it is loss, immediately you have to do one more step. Total estimated loss. Total estimated loss is equal to total estimated contract cost minus total estimated contract revenue, or total contract revenue minus total estimated contract cost. You are going to get loss. The total loss you have to book in contract account, and then you are going to get a balancing figure which is nothing but provision for loss. Respond pakka. And my dear children, that is the end of accounting standard number 7. Get ready. Again 1 to 2 minutes time. We are going to start AS 9. Yeah, actually one more thing I have forgotten in accounting standard number 7, that there will be two types of contracts. Fixed cost contract, cost plus contract. Fixed cost contracts are nothing but cost which is having, contracts which are having fixed revenue. But cost plus is something like you will be incurring some cost, along with that some percentage of profit will be reimbursed. Clear everybody? Fine. Let us start accounting standard number 9. And accounting standard number 9 is nothing but revenue recognition. So take care. Actually, this is a standard where you are going to learn applicability, non-applicability, and also exclusion. Now, listen very carefully. What is accounting standard number 9? Revenue recognition. Please participate. What is AS 9, Amma? So, first of all, you are supposed to know what is the meaning of revenue. Revenue is the gross inflow. What is the revenue, Amma? Gross inflow of cash, receivables, or other consideration which is generated in due course of business or ordinary course of business. Understood? Through sale of goods, rendering of services, use of enterprise resources by others, yielding interest, dividend, royalty. Respond clear? And now moving on to the next thing, very, very important. I'll ask you a question. Tell me whether what is a gross inflow in that, or what is the revenue. Your total sale amount is equal to 1 lakh, but you have given a trade discount 5,000. 95,000 and minus sales returns 10,000. Finally 85,000. Clear? What is revenue as per accounting standard number 9? 95 or 1 lakh? 95. Trade discount is nowhere considered in the books of accounts at all. Clear? So gross inflow is 95,000, not 1 lakh. Take care. Don't forget. You may get a case question like this only. He'll give you the whole data. He'll also add output GST. And he will be asking you what is the gross inflow as per AS9. Clear? What is revenue as per AS9, Amma? 95,000. What is the gross inflow, Amma? 95,000. Clear? Fine. Very important. But for agents. For agent, revenue is not gross inflow. It is only net inflow. That is, it will be limited only to commission. Understood? Net inflow in the sense it is limited only up to commission. Is the whole logic clear, everybody? So that is what your definition of revenue. And moving on to the next thing, scope. Take care, applicability. It is applicable only for sale of goods, rendering of services, use of enterprise resources by others yielding interest, dividend, royalty. Understood? Moving on to the next thing, very important, non-applicability. Simple also. Something like 7 plus 12 is equal to 19. Revenue arising from construction contracts, AS7 is applicable. Revenue arising from government grant, AS12 is applicable. Revenue arising from leases, AS19 is applicable. But not AS7, AS9 in these three cases. And last and final, IRDA is applicable for insurance companies. Revenue generated to insurance companies, which is nothing but premium. Ante kada. How to account for premium is given in IRDA regulations. Respond everybody, pakka. So that is the non-applicability. And next one, exclusion. But the biggest doubt that you need to understand is what is the difference between non-applicability and exclusion. Non-applicability is given under scope. Exclusion will be given under definition. Hey, any of the things standard is not applicable. But it is given under two names. Exclusion in the sense it is excluded from the definition. Non-applicability in the sense entire standard is not applicable. Is it clear? Now coming to the thing, something like exclusion. Listen very, very carefully. I'll just explain in a very simple way by taking a balance sheet. Current asset, non-current asset, liabilities. Realized gain on current asset, AS9 is applicable. Because realized gain on current asset is nothing but example stock. If you sell the stock, some revenue will be generated. Am I correct or wrong? For that, AS9 is absolutely applicable. Whereas unrealized gain on stock and a closing stock at selling price, is AS9 applicable or AS2 applicable? So AS9 is not applicable. First exclusion. Clear. Next one, non-current asset, something like PPE. Both realized gain, unrealized gain. Who will take care, sir? AS10. Liability, same. Both realized gain, unrealized gain. Who will take care, sir? IGAAPs. Indian Generally Accepted Accounting Principles. Both realized gain and unrealized gains from foreign currency transactions, foreign currency operations. Who will be applicable, sir? AS11. Clear, everybody? So take care, my dear children. Quickly answer me. Current assets, realized gain, what is applicable? So AS9 revenue had excluded the following things. Unrealized gains from current assets, both. Realized and unrealized gains from non-current assets, both. Realized and unrealized gains from liability, both. Realized and unrealized gains from foreign currency transactions, foreign currency operations. And last and final exclusion, natural increase in herds and livestock. Clear? Something like renewable resources like agricultural products, forestry products, sericulture, pisciculture, livestock, Herds is nothing but group of animals. Herds is nothing but group of animals. For all these things, accounting standard number 9 is excluded. What are applicable, sir? Industrial norms. What are applicable, Amma? Industrial norms. Understood, everybody? That's it. And moving on to the next thing. Very important. When can revenue be recognized under sale of goods? When ownership is transferred. What do you mean by ownership is transferred, sir? Significant and related risk and rewards is transferred and no effective control to the seller. If ownership is transferred, there is no control to the seller. Obviously, control will be in the hands of buyer. Clear? And second condition, there should be no uncertainty in collection, which implies that ultimate collection is established. Understood? Tell me what are all the 4 conditions. Number 1, significant and related risk and rewards must be transferred. No effective control to the seller. No uncertainty in collection. Ultimate collection must be established. Respond, everybody. Clear? Now, coming to sale of goods, there will be some special cases. You just go through that special cases. Okay? You just go through that special cases. But I'll be telling what are important, only those things. Okay? Now, coming to the next one, rendering of services. Very simple. When the service is rendered and when there is no uncertainty in collection and when ultimate collection is established. Respond clear? Again, the next one, very important, effect of uncertainty of revenue. Listen very carefully. Sir, if initially at the time of sale of goods or rendering of services, if at all revenue generation is uncertain, recognize or don't recognize? Chepali, don't recognize. You have to postpone till the certainty is established or till the amount is received. If at all initially certain and subsequently uncertain. Initially certain, subsequently. If initially certain and subsequently it is uncertain, you should not reverse, but you have to create a. Sir, initially uncertain, what to do? Don't recognize, you have to postpone. If subsequently uncertain, what to do? Don't reverse, you have to create the provision. Respond pakka. And the next one, use of enterprise resources by others, yielding interest, dividend, royalty. Let's understand what are each and everything. Interest is the reward that was earned or return that was earned since your resources are used by other people in the form of a loan. Okay, clear? Interest is return that was earned by your business concern since your resources are used by others in the form of a loan. If your resources are used by others in the form of investment in equity shares, then you are going to get dividend. And last and final is royalty. Sir, listen very carefully. What is the difference between royalty, lease and rent? Rent is nothing but operating lease. What is rent, Amma? Lease is nothing but finance lease. These two things will be dealt in accounting standard number 19. And the entire lease, operating lease, rent, finance lease, etc. is applicable for tangible assets. Applicable for, if it is intangible assets, like use of know-how, use of trademark, use of, what is it called, copyrights, that is nothing, patents, etc. That is nothing but royalty. You have to pay some return kada. That is nothing but royalty. Also, you will be getting royalty on extraction of mines and minerals. Okay, extraction of mines and minerals. You have to pay royalty to the government or the land owner, mine owner. Respond, everybody, clear? Fine, this is what your, no, appude yes naina. Use of enterprise resources by others. Now, very important, if there is uncertainty, what to do? Initial uncertain, what to do? You should not recognize, you have to postpone. Subsequent uncertain. Here it is reverse, take care. Normally for sale of goods and rendering of services, you should not reverse, you have to create a provision. But here you have to reverse. Did you ever see provision for interest? Did you ever see provision for royalty? Did you ever see provision for dividend? No. For these things, provision will not be created. You have to reverse. How, sir? Sir, if interest is receivable, what is a journal entry? Interest receivable account debtor to interest account. You have written this journal entry since you thought of it is certain. But subsequently it had become uncertain. Cancel by reversing the same. Not for creating provision. You should not create provision. You have to reverse. Interest account debtor to interest receivable account. Say for example, in the meantime, already interest is closed and transferred to P&L account. Interest account debtor to P&L account. Clear? In such a case, when reversing, interest will not be debited. What will be debited? P&L will be debited. Respond clear? Because already interest closed kada. So ultimately, P&L account debtor to interest receivable account. Respond pakka. So this is what your use of enterprise resources. And strictly speaking, entire AS9 is completed. But I promised you I'll deal with some important things at least. In that first one, yes, continuously you will be getting this one in your problems. Delivery delayed at buyer's request. Title was passed on to the buyer, which is also called as bill on hold sales. This is called as bill on hold sales because billing was done, title is transferred, ownership is transferred, but delivery was pending, delivery was held out. In such a case, you have to recognize only when the stock is in hand, identified, packed, ready for delivery. 4 conditions should satisfy. Stock in hand, identified, packed, ready for delivery. And next one, this is easy. So, sale on approval return basis. That is easy. Yeah, when approval is received. And approval might be either expressed or implied also. Consignment sales is easy. Cash on delivery is easy. Guaranteed sales. Coming to guaranteed sales. Something like I have given you guarantee for 1 year. So do I need to recognize immediately or after 1 year? I have to recognize immediately. But during that guarantee period, I have to create a provision, like provision for warranty or provision for guarantee. But I have to recognize the sale immediately. This thing I'll tell you later. Subscription for publication, very simple. Something like Swati magazine or your CA, the Students Journal magazine. You have to pay the magazine amount or publication subscription for the entire year. Correct or wrong? So if one year is completed or one month is completed, some portion will be transferred, like proportionate completion. Respond clear. Now, as I told you, installment sales. Listen very carefully. There are 2 things actually. Number 1, hire purchase. Number 2, installment sales. Number 3, advance payments in installments, but good will be delivered at last. Under hire purchase, what happens, sir? Sale will be done immediately. Listen carefully. Under hire purchase, sale is done immediately. Under installment sale, sale is done immediately. But under advance payments, sale is done after the last installment is paid. So when do the ownership transferred? After the last installment is paid. But under installment sale, immediately ownership is transferred. Under advance payments, sale last installment is paid. So ownership is also transferred only after the payment of last installment and only when the good is actually delivered. Clear? This is the difference. Sir, payment is installment in all the 3 things. Payment is installments in all the 3 things. Hire purchase, sale is done immediately. Ante kada. Ownership is transferred at last. Payment is in installments. Under installment sales, sale is done immediately, ownership transferred immediately, payment is done in installments. Under third case, payment is done in installments. After payment of last installment, I will do the sale. Best example, all your gold schemes. Kajana, GRT, Lalita, they will be asking you to pay 10,000 per month, 1,000 per month. After the completion of entire period, they will deliver the good to you. Is the whole logic clear? So, installment sale, yes, same. You have to recognize the sale immediately. Provided if needed, you can recognize some provision. Understood? And here, you have to recognize sale only when the last installment is paid and only when the good is delivered. Respond understood. That's it. And last and final, rendering of services. Same like you are having two methods here, completed service contract method, proportionate completion method. If you are having only one service, recognize the revenue after the completion of that service, which is called as completed service contract method. If you are having more than one services, after the completion of one service, you can recognize proportionately, which is nothing but proportionate completion method. Clear? And some of the important things, installation fees easy. Advertisement, please don't forget the terminology when the advertisement appears before public. This is easy. Admission fees, tuition fees, entrance fees, these are common. Membership fees. I mean, rendering of service is actually very, very easy. Only when the service is rendered. Membership fees, subscription. After providing the subscription or after providing the membership. If your membership is exclusively covering only membership, record it as your revenue. If your membership fees is also covering Zim services, shuttle code services, lodging and boarding services, then automatically you need to apportion. Clear? Like that, actually everything is easy under rendering of services. Just if you read, you'll understand. Respond understood. That is the end of accounting standard number 9. Okay. One last and final thing like disclosure. Listen, no need to disclose if subsequent uncertainty is there. Because for subsequent uncertainty, you are creating a provision. So no need to disclose this one. But initial uncertainty, where it will be recorded? Initially, it is uncertain. Where will it be recorded? And as of now, recorded or not recorded? So nobody knows that. So you have to disclose this one. That we are having sale. But since it is initially uncertain, we did not record the same. We are expecting on so and so date, we might get it back. Certainty will be established and we will be recognizing as on that date. Like this, you are supposed to clarify. Respond everybody, pakka. Yeah, that is the end of accounting standard number 9. Just get ready. We are going to start accounting standard number 22. And anyways, shall I start now? Sir, a standard which is like nightmare to the people, accounting standard number 22. But it is actually very, very easy. I will tell you some rules, I will tell you some regulations. Try to follow in the same lines, which will become very easy for you. Sir, accounting standard number 22, accounting for taxes on income. Accounting standard number 22, accounting for taxes on income. Listen very carefully. Before starting this standard, first of all, you are supposed to know some terminology. Accounting profit. Profit report as per statement of profit and loss account. Taxable profit or loss. Profit or loss as you have completed in your previous marathon, PGBP. Or whatever capital gains. So taxable profit, profit which is reported as per Income Tax Act. And the next one, tax expense. Tax expense is the tax that is computed as per accounting profits or accounting incomes. Next, current tax. Tax which is computed as per taxable profits. current tax in our usable language, it is called as provision for tax. Current tax in our usable language, it is called as provision for tax. Tax expense will not appear directly in P&L account, remember. Tax expense will not appear directly in P&L account. Tax expense will be in the form of CT and DT. Current tax and deferred tax. Deferred tax is the tax difference between CT and TE. That is current tax and tax expense. Clear everybody? So now this deferred tax can be either deferred tax asset, deferred tax liability. Simple shortcut to remember is that if in accounting records, if expense is more and if the difference is new difference, then immediately you create DTA. Remember this rule? Nijanga, I mean frankly I'm telling, half of accounting standard number 22 is gone away. You can try it with the same lines. As per accounting records, if expense is more and if the difference is new, you have to create DTA. Sir, this is okay. If the difference is old, what to do, sir? Creation of DTA is similar to reversal of DTL. So if the difference is new, creation of DTA. If the difference is old, reversal of DTL. Clear everybody? Okay, remember this rule. With this, you can solve the entire accounting standard number 22. How to solve? I will give you an example. Otherwise, it is not possible to you to apparent with that. Anyways, let me proceed for the next thing. Something like, yes. So, if it is your statement of profit and loss account, then listen very carefully. First of all, you have to find net profit. Then you have to create current tax or provision for tax. Say net profit as per P&L account is 1 lakh. But you have to create current tax as per taxable records. Taxable records, if the profit is 90,000, it will be something like 90,000 into tax rate 30%, which comes to 27,000. Clear everybody? Then very simple, difference between 1 lakh and 90,000 into tax rate, which is nothing but, biggest doubt, is it DTA or DTL? Very simple. I told you one rule. What is that rule? Accounting records expense is more aithe DTA. Am I correct or wrong? Accounting records income is more. Hey, if expense is more, DTA. If income is more, DT. So simply 2 DTL 3000. Is it clear? And very important, DTL will be at debit side itself. DTA will be at credit side itself. Creation. Reversal aithe absolutely reverse. Is it clear? Now very important, TE. Tax expense is equal to CT plus DTL or CT minus DTA. Clear? Either CT plus DTL or CT minus DTA, which is nothing but tax expense. So now check out. So tax expense, logically speaking, tax which is computed as per accounting profits. So what is accounting profit? 1 lakh into 30% comes to 30,000. So TE is equal to CT plus DTL kada, 27 plus 3000, which is nothing but, that's it. But the biggest point you need to understand, tax expense will not appear directly in statement of profit and loss. It will be in the form of CT and DT. Clear? So let me give you one more example. Likewise given like this. Depreciation as per accounting records 1 lakh. Depreciation as per taxable records 1,45,000. Okay. Now you need to check out. So depreciation is an expense. As per accounting records, depreciation ante expense is less. If expense is more, I asked you to create a DTA. But if expense is less, you have to create DTL. Clear? And very important, check out in the question. If nothing is mentioned, it is DTL only. But given in the question that there is some old depreciation also. In such a case, it is reversal. Ante instead of creation of DTL, you have to reverse the DTA. Respond clear. So now for creation of DTA, the journal entry will be DTA account debtor to P&L account. Because DTA ante asset kada. Next, creation of DTL, P&L account debtor to reversal will become DTL to P&L, P&L to DTA. Respond clear. With this rule, actually you can solve. With this rule, you can solve. Remember that one. Just wait. చెప్పలేని అకౌంట్స్ అది. Listen. If you observe here, already you were provided with some data of DTA and DTL and given that following transactions were reported during the year. Depreciation as per books given, as per tax given. There were no additions to fixed asset during the year. Ante is it old difference or new difference? Old. No difference కాదమ్మా, old అనే అన్నారా? That is old difference only. See here, no additions during the year, but there is a difference like 70 minus 42. So everything is old difference. Let us apply the rule. Sir, strictly speaking, accounting records depreciation is an expense is more. If expense is more, you have to create DTA. But is it old difference or new difference? So you have to reverse the DTL. Understood? Reversal of DTL. I hope you have got the logic. I'm telling you frankly, with this rule you can solve entire AS22. Now check out the next one. Expenses disallowed in 1920 but allowed for tax purpose in 2021. You are in the year 2021 only. Is it clear? Point number 1, old difference or new difference? Old difference, remember that one. Sir, tax purpose expense is 14 lakhs in the current year. Accounts purpose it is actually 0. Ante kada? Because what happened? Expense disallowed in 1920. So expense was booked in accounts in the last year 1920. In the current year there is no accounting expense. So accounts expense 0. Tax expense 14 lakhs. In accounting records, expense is less. If expense is less, you have to create DTL. But is it old difference or new difference? So automatically reversal of DTA. I hope you have got the logic. I'm not speaking about the numbers. I'm speaking about the concept only. Many of the people will be complaining that AS22 is difficult and we did not understand. But with this simple rule, you can solve more than half of accounting standard 22. And moving on to the next thing, like that, you can just go here. Check out, I'll tell this one now. Repairs incurred during the year. And is it a new difference or old difference? New difference. And it is 140 lakhs and as per tax records. Books in the sense books of accounts amma. Books of accounts it was equally spread ante year 1 year 2 equally spread ante 140 by 2 70 lakhs. So in taxable records 140 lakhs, in accounting records 70 lakhs. Accounting records expense is less. If expense is more, DTA. If expense is less, creation of DT. A new difference or old difference? New or old? So increase of DTL or creation of DTL. If it is old difference, reversal of DTA. That's it. Is it clear, everybody? That's it. With this you can solve CRD 1 part A, part B. Even you can solve CRD number 2. CRD 3 is easy. You can, it's depending upon the provision section 43B anukunta. Yes. Actual payment basis. You will be getting tax, cess, duties, interest, professional fees, directors fees, etc. and etc. You will be getting deduction only on actual payment basis as per your income tax. Okay, so take care. You can solve CRD number 4 also. Same DTL, DTA. You can solve even that, but it is a bit different. If you see it, you'll understand. CRD 5 is totally different. You have to draft P&L account here. I have told you the format of P&L account, don't forget. P&L account by net profit. If not, to net loss. If it is DTA, by DTA. If it is DTL, to DTL. If it is reversal, it will come like this. Clear? And finally, you will be getting again net loss or net profit. We told something like tax expense. Did you remember? Tax expense. Expense or tax as per accounting profit. It is exactly opposite like tax savings. If it is on loss. Clear everybody? Ardhamainda? If it is profit, tax expense. If it is loss, tax savings. Because if loss is there, you can set off this loss in future, so that your income tax will decrease kada. So it's a kind of tax savings. Understood? Fine. So this is what your statement of profit and loss. Okay. Yeah. So let me go with some of the details of accounting standard number 22. There are actually two differences. And the two differences are timing difference and you all people know these things. Majority of the people will be having doubt. Creation of DTA, DTLR, reversal, it's very confusion. And hence I have actually started from that point. But now let me go with some of the detailing things. Timing difference and permanent difference. Sir, accounting rules and taxable rules, same or different? Same or different? Of course different. And very important. If difference arised in 1 year and capable of reversing in the next year, it is called as timing difference. If difference arised in 1 year and not capable of being reversed in the next year, it is called as permanent difference. Logic clear? Pakka. So now, not capable of being reversed ante, it is booked only in either of the books. Capable of being reversed ante, it is booked in both the books. Respond understood. You have to create DT only for timing difference. For permanent difference, no DT at all. Remember. Clear? Expense disallowed in tax. Which difference? Expenses disallowed in tax records. Permanent difference. It was totally disallowed. See, there is this point in one of your problems where people confuse it's a timing difference. Because they thought like disallowed in the current year. But it is totally expenses disallowed as per taxable records. Not for current year. Forever it is disallowed only. Clear? So get that minute differences while reading the question. In your examination, what is far more important is reading the question. Take care. You are going to write a challenging question paper. Because if you have seen the recent MTP, preparation of financial statements question is given along with balance sheet. Amalgamation question is given along with balance sheet. Consolidation question is given along with balance sheet. Internal reconstruction question is also given along with balance sheet. Think how well you have to manage time to write that paper. Take care. Each and every question is catering for 14 marks. Don't think that whatsoever, sir. 20 marks, he'll ask these many adjustments. 14 marks, adjustments will be reduced. Not even a single adjustment was reduced. Don't think that he will reduce the magnitude of the question. As it is question, upon a time he used to ask it for 20 marks or 16 marks. Now he is asking it for 14 marks. For MCQs, you have to complete it in 30 minutes at any cost. And then you are supposed to write 5 questions into 14 marks, 70. You will be provided with 6 questions, of which question number 1 is mandatory. And in the remaining any 5 questions, you have to answer 4 questions. And question number 1, as usual, accounting standards. 3 questions he will be giving. 2 into 5 marks plus 1 question of 4 marks. Or he may change 3 into 4 marks and 1 question of 2 marks. So be prepared for everything. Be careful. Time is very important for you. Sir, not only in the at the time when you're writing exam, but also at the time of revision. Luckiest part is that for advanced accounting being the first exam, you may plan it for 2 days actually, or 2.5 days. Adi ganaka, like other examination, if it is in between, seriously to tell you that 1.5 days is difficult to complete. Because syllabus is increased a lot and lot. Prima facie it is appearing, everything is standard. Biggest problem, everything is standard. So take more care and let me come back. That is a meaning on difference between timing and permanent difference. Now, very important, tax holiday. Remember, I'll tell you a simple rule. Sir, to create DTA, there should be reasonable certainty that in future you should get some profits. But to create DTA in case of loss or unabsorbed depreciation, then you need virtual certainty. What is difference, sir? Reasonable certainty, maximum chances. Virtual certainty, 100% proof. Clear. Current year you got capital loss. Can I create DTA? Check whether there is virtual certainty or not. Long-term capital loss can be set off against only long-term capital gain, and it can be carried forward only for the future 8 years. So now you prove that in the next 8 years, I'm going to sell one long-term capital asset and I'm going to get some profit. Prove with all these things. Then you can create DTA. Otherwise, you can't create DTA. Respond, is the logic clear? So, cheppandi DTA. What is DTA? Deferred tax asset has to be created only when there is, generally, DTA will be created only when there is reasonable certainty that they are going to get profits in future. But in case of loss or unabsorbed depreciation, you need virtual certainty. Clear? And one more thing, DT is always to be created with present tax rates or future tax rates. Future tax rate. Reason I'll tell you. Sir, you will create DTA or DTL now. But will it reverse in future or present? So future in the sense you have to use future tax rate if it is known. If it is known to you. If it is not known, what can you do? Use the present tax rate only. Clear, everybody? So if the future tax rate is known, for creation of DT and DTL, you have to use future tax rate. If future tax rate is not available, use only present tax rate. Clear? Now come to tax holiday. Tax holiday in the sense, Sunday is not a holiday. Tax holiday in the sense, listen very, very carefully. In future, up to some X number of years, no need to pay the tax. That is called as tax holiday. So listen very, very carefully. Say for example, year 1 to year 5 is tax holiday. From year 6 again you have to pay the tax. So now very important, listen. Timing difference erased and reversed during the tax holiday period. No need to create DT. Timing difference erased during the holiday period and reversed after the holiday period. DT is required. Sir, why here no DT is required if erased and reversed during holiday period? Because during holiday period tax rate is 0% kada. If you know the future tax rate, you have to create DT only with future tax rate. For the next 5 years, I know my tax is 0. So no need to create. Logic clear? Let me give you an example. Year 1, year 2, year 3, year 4, year 5. Timing difference. Erased 100, erased 80. Reversing 10, 10, 10. And all the remaining is reversed from year 6, which is after the tax holiday period. Question number 1. What is the total timing difference erased? 180. What is the timing difference reversed during the holiday period? 30. Out of 180, if is 30 is reversed during the holiday period, 180 minus 30, 150 will be reversed after the holiday period. Logic clear? Now very important. Need to create DT for those differences which arise during holiday period and reversed after holiday period. Clear? Provision clear? How much is erased and reversed during holiday period? 30. How much is erased and reversed after holiday period? Which is nothing but totally 150 plus 30, 180. Ante kada? Erased 180. Erased 180. Reversed during the holiday 30. Reversed after the holiday 150. Difference arising and reversing during holiday period, no DT. Arising during holiday period, reversed after holiday period, DT. But how much, sir? First in, first out. Ante first arised should reverse first. How much arised first? How much arised reversed first? So this 10 had to be deducted from this 100. Not from this 80. First arised should reverse first. Minus 10. Minus 10. Minus 10. How much? In the sense, in first year you have to create DT on 70. Second year you have to create DT on 80. What is 70 plus 80? That is this 150. Entire logic clear? Difference arised during holiday period, reversed during holiday period. No DT. Reversed during holiday period. Sorry, arised during holiday period, reversed after holiday period. DT is required. Respond pakka. Sir, even though it is clear now, if you want to revise once more, just okkasari meeku marathon availability untundi kabatti, if you listen once, you will get everything. Shall I proceed further? And moving on to the next thing, last and final, MAT. Sir, minimum alternate tax. Sir, normally answer me, tax expense is equal to current tax plus DTL or current tax minus DTA plus excess of tax paid over normal tax. The excess of tax paid under normal provisions. Excess of tax paid as per MAT provisions when compared to the normal provisions will be added to get tax expense in case of MAT. Clear? Normally tax expense is equal to current tax CT minus DTA or CT plus DTL. But tax expense in case of MAT is equal to CT minus DTA plus excess of tax paid as per MAT provisions. CT plus DTL plus excess of tax paid as per MAT provisions. Respond clear? So now let me show you this example. It will be clear for you. Accounting profit 6 lakhs into tax rate 20%. So tax expense is equal to 1,20,000. MAT 3,50,000 into MAT rate 7.5%. And the MAT tax 26,250. Income tax 60,000. Tax rate 20%. 12,000. Clear? Now take care. I got three things. Tax accounts. MAT tax 26,250. Normal provisions tax 12,000. And next tax expense 1,20,000. Am I correct or wrong? Very important. Listen carefully. Sir, listen. How much is accounting profit? 6 lakh. How much is tax profit? 60,000. Apply the same rule first. Accounting profit is more. Income is more. If expense is more, DT DTA. If income is more, DTL. Clear? Now you have to create DTL. How much DTL, sir? Difference between these two things, which is nothing but 1,20,000 minus 12,000. Because DT is the difference between current tax and tax expense, which comes to 1,08,000. Hold on this. Shall I continue? Now, tax expense under the case of MAT is equal to DTL or DTA? DT. What is the rule? CT plus DTL plus excess of tax paid. How much is CT? 12,000. How much is DTL? Plus excess of tax paid. Sir, as per Income Tax Act, do you need to pay 12,000 or 26,000? 26,000. Whichever is higher kada. Hey, this is as per your income tax. This is not in accounts. It's 12,000 or 26,000, whichever is higher. How much is that? 26,000. So excess, how much you have to pay? 14,000. So on a whole, it comes to 1,34,000. That is the end of your answer. 134,250. I hope you have got clarity. And that is the exact ending for accounting standard number 22. Get ready. Within the next 3 minutes, we are going to start cash flow statements, AS3. 10 minutes spare. Ante late aite avvachu. We'll try to cover within this 20 minutes, but spare for another 5 to 10 minutes. Okay. Ante if it is something like unamortized expense as per a record kavali. Tax record. Ante as per tax records, it was not amortized. Ante as per accounting record, it was amortized and written off. Ante this is appear in P&L account. Which implies that in P&L account, expense is amortized. In tax records, expense is not amortized. So expense in tax records is 0. Expense in accounts records is something. Since expense is more in accounting records, you need to create DTA. If it is old, you have to reverse DTL. Okay. Unamortized ante not written off. Not written off as per tax record ante written off as per accounting record. Ante it is appearing in accounting records. It is not appearing in tax records. Okay. Cash flow statement, which is as per accounting standard number 3. So as like normal, but majority of the cash flow statements you are having problematic. So take more care. There is chance even to ask a question for 14 marks from cash flow statement. Ante, I mean like such a magnitude questions are also there for you actually. The last 2 questions. 7 and 8 something, which are actually very big questions. But since this is something like revision of concepts, I can't deal with a problem. Because if I deal with one problem of cash flow statement, it might take half an hour or 1 hour and entire cash flow statement. Thank you, class completed. Huh? Bye, Amma. So, okay. So, I can't deal it actually with the problem. So I can deal only with the concept and I'll brush everything. I'll try to revise everything. So please concentrate. Cash flow statement, accounting standard number 3 is a statement which reconciles the opening and closing cash and cash equivalents by dividing it into 3 activities: operating, investing and financing. If it is relating to capital, then it is nothing but financing activity like capital and borrowings. If it is relating to fixed assets like tangible or even intangible assets and also some investments, it is nothing but investing activity. And coming to operating, all the items which are related or incidental to the due course of business or ordinary course of business like purchase and sale is nothing but operating activity. Respond everybody, pakka. Biggest thing that you need to understand is that if it is neither operating, nor investing, nor financing, then again it will have to be treated as operating activity. Best example, residuary items like donations paid. Which activity is donation? It's not relating to daily activities of the business. It's not relating to assets. It's not relating to capital and borrowings. So it comes under operating activity. Lottery tickets purchased. Lottery tickets purchased. Yeah, operating, because it is neither of the three things, residuary items. Grant is having a purpose actually. Grant is always given along with a purpose. As per accounting standard number 12, you will be having two types of grants. Grants of revenue nature and grants of capital nature. So it is generally always having purpose. But if the purpose is not giving, better to consider grant as a financing activity. If the purpose is not given, better to consider grant as a financing activity. Clear? And remember, very important, as like one of your friends said, grant. Grant is always attached with some purpose. Okay, grant is always attached with some purpose. So as per that purpose, the activity will be classified. Grant received for the purpose of purchase of asset, then that will become investing activity. But he did not give anything, just grant received. Then it is a financing activity. Clear? In one of your problems, you are having that controversy also actually. In RTP, he will be giving it as a financing activity. In study material, he will be giving it as an investment activity. We have mentioned a note for the same. So conclusion, follow the study material first and capital grants received. That was the actual word. And it will become investment activity. But if the purpose is not mentioned, it will become financing activity. Understood? Yeah, let's go back. Three kinds of activities or those things. And very important thing is all about two methods. Number one, direct method. Number two, indirect method. People will be feeling that direct method is easy and indirect method is difficult. But even in direct method, he can lock you. Even in direct method, yes, he can lock you. Because you will feel that direct method is easy when cash book is given. But he had given P&L account and balance sheet and asked you to prepare under direct method. If actually choice, if P&L account and balance sheet is given, it is quite easy for us to go with indirect method. But if we asked under direct method, again it calls for a difficulty thing. So please be careful. What are the two methods you are having? Direct method. What are the three activities you are having? Operating, investing, financing. My dear children, investing and financing under both the activities will be the same. The deciding factor is only operating activity. Operating activity under direct method will be prepared from cash book. Operating activities under indirect method has to be prepared from P&L account and balance sheet. Clear? But when cash book is not given, he had given P&L account and balance sheet and he is asking you to prepare cash flow statement under direct method. In such a case, you have to convert each and every item into cash and then you have to prepare direct method. Likewise, in the problems of CRD 2 and 3, you will be converting each and every item into cash. You will be drafting debtors account. And you will be getting by cash or bank as balancing figure. Receipts from debtors. Creditors account. You will be getting to cash or bank. Payments to creditors. Clear everybody? Like this. Cash purchases, cash payments, cash receipts, etc. and etc. So take care. What is the difference between direct and indirect method? Difference is only for operating activities. For investing and financing, it's common. Listen very, very carefully. Sir, very simple. Cash flows from operating activities. all the inflows will be added, all the outflows will be deducted. Cash flows from investing activities, inflows will be added, outflows will be deducted. Cash flows from financing activities, inflows will be added, outflows will be deducted. This is quite common, nothing great in this. Clear? Take care, last and final, tax has to be disclosed separately. So cash flows from operations before tax minus tax paid, cash flows from operations after tax. Shall I proceed further? Now listen very carefully. Indirect method operating activities. Under indirect method, coming to operating activities, how it will be, sir? Take net profit before tax. In the sense, already you have added provision for tax, already you have added dividend declared. Ante kada? Yeah, I mean to tell all other appropriations like transfer to general reserve, even all those things. And then, very important, add non-cash expenses have to be added. No, I'm speaking about non-cash, like depreciation, discount on issue of debentures. Non-cash incomes have to be deducted, like appreciation and capital grant amortized. And now you said non-operating. Ante I don't actually speak it like non-operating. I'll tell you more simply. Investing income will be deducted. Financing expense will be added. Because in investing items, you will be having only income in P&L account. In financing activities, you will be having only expense in P&L account. Is it clear? Profit on sale of asset, investing, interest, financing. Clear everybody? So, yeah, even if you take discount on issue of debentures, strictly speaking, it is non-cash. Non-cash. Anyways, whatever, simply these four things. Or in your logic, non-operating incomes will be deducted, non-operating expense will be added back. Clear everybody? And then you are going to get cash flows from operating activities before working capital change. Coming to working capital change, you are having four things again. Increase in current assets. Sir, very simple. Remember, no need to buy hat every time or no need to remember. Current assets cash, inverse relation. Current liabilities cash, direct relation. అంటే ఇది గుర్తు పెట్టుకోవాలి కదా సార్, అవసరం లేదు. బ్యాలెన్స్ షీట్, క్యాష్ విల్ బి ఎట్ అసెట్ సైడ్, కరెంట్ లయబిలిటీస్ విల్ ఎట్ liabilities side. These two things will move equally because ultimately your balance sheet should tally kada. So if cash increases, current liability increase. If current liability decrease, cash decreases. I hope you have got the logic to remember also. Now if you take balance sheet with current assets and cash, if current assets increase, cash will decrease because balance sheet should tally ultimately. If another asset is decreasing, another asset should increase. So current asset and cash is having, current liabilities and cash is having direct. Clear? So increase in current assets minus ఒక్కటి గుర్తుపెట్టుకుంటే అన్నీ వచ్చేస్తాయి కదా. Decrease in current assets, add decrease in current liabilities, decrease in current liabilities minus, or else you can simply even remember like this: increase in current assets, decrease in current assets. I told inverse kada, plus minus. Increase in current liabilities, decrease in current liabilities, minus plus. Very simple. Sir, it's all counts how easily you are actually grabbing the topic. Anyways, clear everybody? After adjusting all these things, you will be getting cash flows from operating activities before tax minus tax paid. You are going to get cash flows from operating activities. This is the finality. And similarly, find cash flows from investing and financing. After that, you have to do the reconciliation. Cash balance ante opening balance of cash and cash equivalents, add or minus net cash flows during the year, and finally you will get closing balance of cash and cash equivalents. Is it clear? And one more thing. What do you mean by cash equivalent, sir? Cash equivalents. Cash a form of cash. As per accounting standard number 3, cash includes only cash in hand, cash at bank. Yes, cash at bank is also cash only. But cash equivalents are in the form of investments. Cash equivalents are in the form of investments which are held for short term period. Actually short term until 12 months, but as per AS3 it is less than or equal to 3 months. And very important, negligible risk, easily convertible into cash. Insignificant risk or negligible risk and easily convertible into cash. So tell me, cash equivalents are in the form of investments, holding period is less than or equal to, and it is having risk, negligible or insignificant, and ultimately easily convertible into cash. Respond everybody, pakka. That is what your cash equivalence is all about. Hey, is it clear? So that is the end of cash flow statement. Topic is completed. Okay. But I am going to deal each and every problem. And in problems you will be having some typicalities. So I'll be dealing with those typicalities actually. Clear? So shall I start? మీకు ఆకలేస్తుంది వెళ్తామంటే లంచ్ ఆర్ తర్వాత స్టార్ట్ చేస్తా. If you are comfortable, I'll start now itself. I am always comfortable. I'm anything to do for you. Shall I continue? అంటే ఎట్టే స్ట్రెచ్లో అయిపోతుంది, ఇంకో చాప్టర్ అవుతుంది అని. సో లిజన్. సరే, అటు కాదు ఇటు కాదు, 15 minutesలో ఎంత అయితే అంత చేసి వెళ్ళిపోదాం. ఓకేనా? లిజన్. సరే, 1 second. ఎవరికైనా వెళ్ళాలనిపిస్తే హ్యాపీగా వెళ్ళిపోండి. Listen, sir, in this problem, important thing that you have to take care is all about advance tax and tax provision. Remember very, very carefully and listen very, very carefully. Sir, last year advance tax is 180, provision for tax is 180, which implies that I have to pay 180, already paid 180. Current year I have to pay 200, but I have paid only 195. So ultimately what is tax paid in the current year? 195. Only that will be deducted. But if it is something like last year I have paid only 170. Did you get my point? How much I have to pay? 180. But how much I have paid? That shortage 10 rupees will be paid in the current year along with current year advance tax. And on a whole, how much is the tax paid in the current year? That will be shown as a deduction. Logic clear? Pakka. If excess is there, it is a refund. You have to book it as tax refund and it will be given in the question. Whether refunded or not refunded, the excess data will be given in the question. Respond, is this point clear? That is the end. And one more thing, sir, in this question, you actually no need to use stock adjustment under direct method. In indirect method, you have to use it because change in current asset. Clear? But take care. Instead of purchases, if cost of goods sold is given in the question, even under direct method also, you need stock adjustment. Because instead of purchases, if cost of goods sold is given, you don't know how much is the purchases. So from cost of goods sold, you have to find it. Cost of goods sold is equal to opening stock plus purchases minus closing stock. Cost of goods sold is there, opening stock is there, closing stock is there. Then you have to find the purchases. And a single word had changed the entire question. Instead of purchase, he puts cost of goods sold. Everything gone. Anyways, clear everybody? So be careful. And very important, last and final, if at all given in the question like outstanding interest, opening balance, closing balance. Okay. Outstanding interest payable anukundam. Opening balance and closing balance. Tell me, can I take it under change in current assets? Change in current liabilities? Question clear? Something like outstanding wages. Of course, change in working capital. Outstanding expense, change in working capital. Like that, outstanding interest payable. Very important. This is not to be taken under working capital because interest is a finance item. So you have to do this under financing activity. Clear everybody? Interest expense he will give. Outstanding interest is there. From this you have to find interest paid. Ante interest paid add current year outstanding minus last year outstanding. Finally, interest charged to P&L account. This one is there. Clear? This are available and this will become balancing figure. Logic clear? Huh? Wait. You are having similar kind of thing here. This one. Interest expenditure actually debited 24,000. Interest actually paid 26,084. Whatever it is, some outstanding is there. Am I correct or wrong? Ante, this is the procedure. Luckily in this question he had given two things. This one is given, this one is given. But if only these things are given, this will become balancing figure. Hope you have got my logic. That is the end of your CRD number 1. Let me go for CRD number 2. Yeah. So coming to CRD number 2, people will be thinking actually that no need to prepare trading account. No need to prepare trading account because sales is there which is sold for cash only. And GP is given. GP ratio is 30% of sales. Opening inventory was lesser than closing inventory. These 3 items and wages paid during the year. These 4 items are relating to trading account. Clear? But strictly speaking, no need to prepare trading account here. Reason being, given here that trade payables on one day exceed the balance of closing by 25,000 and amount paid to trade payables is 4,60,000. Many people will be ignoring trading account, but never do that in your exam. Why, sir? If you prepare trading account, you will get balancing figure purchases. Will you accept or not? Because sales is there, GP is there, opening stock there, closing stock there, wages is there. You will get balancing figure purchases. Trade payables, opening balance is there, closing balance is there, amount paid to trade payables is also there. And even in creditors account also, you will be getting a balancing figure purchases. Then what point is there, sir? Very important thing is here itself. Given that sales are done for cash, but purchase cash or creditor? That was not given. So you have to crack that. You can't tell it is credit. How to crack that, sir? Very, very simple. From trading account, you will get balancing figure purchases, which is representing total purchases, both cash plus credit. From creditors account, you will be getting a balancing figure purchases. This is only credit purchases. Difference between these two things is nothing but cash purchase. He may lock you just by changing the amounts. And finally, you will hold your head at the end when your cash flow statement did not tally. But the real logic is this one. Is the concept clear? Huh? I hope you have drafted trading account while solving the problem. No, I'm not speaking about indirect method, whether direct or indirect. That's very important. Take more care. Anyways, clear everybody with CRD number 2? That's it. That's the only point I have to discuss. And next. CRD number 5. So very important thing. Very important, listen. Check out point number D. Preference shares were redeemed at premium. Preference shares were redeemed at premium. What is the journal entry? Preference share capital, premium on redemption of debentures to cash or bank account. Close and transfer to journal entry. P&L account debtor to premium on redemption of debentures. Premium on redemption of debentures. Which activity? Financing activity, because it is relating to capital. Correct or wrong? And also it is debited to P&L account. So it has to be added back. Financing expense. To find cash flows from operating activities. Logic clear? But in this question you are not supposed to do that. In this question you are not supposed to do that, because net profit is computed only after taking these 5 items. This item is not there. Logic clear? But there will be another problem. Gurtunda? Yeah, either 7 or 8 something. You will be having ide anukunta. Preference shares were redeemed at 5% premium. In this problem, premium on redemption of debentures has to be added back as finance expense while computing cash flows from operating activities. In that problem, it is not to be computed. Why? Not adjusted, very clearly given. But in the new problem that I showed you, you have to consider. Clear? So these are actually the minute differences where students are seriously unable to identify while solving the problem. Because you will solve this problem by looking the solution of this problem. You will solve that problem by looking at the solution of that problem. So you won't get that doubt. But you will get this doubt when you are solving this question in the examination. So take more care. And also here you will be having profit or loss on exchange of the plant. Either profit or loss. Okay. But even this is also not to be adjusted. Because only these following 5 items were actually adjusted. Clear? The next thing. Take care. Company decided to value the inventory at cost. How illogical is this point? I'll tell you. Company has decided to value the inventory at cost. Previously, our practice is to value at cost plus 10%. Previously, ante opening stock or closing stock? Opening stock. But he will give you that opening stock was correctly valued, closing stock was wrongly valued. While telling, teachers will cover up something. But logically to tell you, this adjustment is wrong. But never judge the question. This is an examination question. Don't judge that question. Always in the examination, even though there are some illogical things in the question, you don't apply logic for finding the answers. Apply the mechanical solving aspect to get the answer. Ante. So now you need to understand that. Strike off this point. Closing stock was wrongly valued, opening stock was correctly valued. And one more thing, Amma. Inventory according to the books in the sense it is wrongly valued. Because their practice is to value at cost less 10%. Clear? Cost less 10%, 90% of stock. In the sense it was wrongly valued. What is wrongly valued, sir? Closing stock is wrongly valued. So you have to make the closing stock proper. And then automatically if closing stock increases, profit will increase. That difference has to be adjusted. You may ask me, sir, why this illogical point is given in the question? Wait. This problem was there in study material. This problem was there in study material. See this point. Company has decided to value the inventory at cost. Previously, the practice is to value at cost less 10%. Previously, ante opening or closing. So, closing stock was correctly valued. Opening stock was wrongly valued. Logic clear? Study material, the problem is given logically. But examination, that was illogical because he wanted to stress on the point according to books. If you observe, in neither of the questions, he told wrongly valued. He did not tell that, but he is using the word books. In the sense, their practice is to record in books at cost less 10%, which is wrong. You have to cut off that practice and you have to make it proper. Okay, respond everybody clear. That's it. Okay. And moving on to the next thing. So CRD number 6. Yeah, already I told you this point. Nothing great. In this one thing, capital grant amortized to P&L account. This is a non-cash income. Here there will be one more point, capital grant received. Grant received for capital project. This is investing activity. The note that I told you, this was treated as financing in May 19 RTP, but as per the expert advisory committee, it has to be treated as investing activity but not financing, and the same was correctly done in ICAI SM. And hence, if this is not there, grant received, that's the logic, and for that purpose he is wantedly giving it in RTP as a wrong point. Shall I proceed further? What is the journal entry for capital grant received? Cash or bank account debtor to government grant account 36. Very important. Government grant account debtor to P&L account. This 20. So capital grant received was amortized to P&L account, and hence this is actually a non-cash income. Logic clear? Next. CRD number 7. It's like normal. It's actually very, very easy. Everything is given in the question only. Next. CRD number 8. I have told you the two different points, whatever are there here. Clear everybody? Of course, still here and there will be one or two other items where I can't cover due to some time constraint, and you are supposed to go with those things. Be very, very careful. If you observe in this problem, the land was revalued and capital reserve, it was transferred to capital reserve. If it was transferred to P&L account, you will adjust. If it was transferred to P&L account, we don't adjust, right? That's it. Remember the last and final part. Provision for tax account. Opening balance, closing balance. If nothing is mentioned, opening is paid in the current year, closing is created in the current year. So this is called as tax paid. This is called as by P&L account creation. If nothing is mentioned, opening is paid, closing is created. If this is given, this will become balancing figure. If this is given, this will become balancing figure. The same logic is applicable even for declared dividend also. Okay. What is that applicable, sir? Opening, closing. Dividend paid. Logic clear? Dividend paid. And here, dividend declared. Everybody, is the whole concept clear? If nothing is mentioned, opening is paid, closing is declared. But if something is mentioned, this is given, this will become balancing figure. This is given, this will become balancing figure. Remember, if it is interim dividend, very simple. By P&L account to cash or bank. Interim dividend. Ante. If it is interim dividend, opening, closing, nothing will be there. Current year a creation, current year a payment. Respond, is the whole logic clear to each and every one? So, I guess to the best extent I have covered cash flow statement. ఇంతకు మించి ఒక 1 hour లో హాఫ్ అన్ అవర్లో క్యాష్ ఫ్లో స్టేట్మెంట్ కవర్ చేయడానికి పాసిబిలిటీ అయితే లేదు. But to the maximum extent I have tried to cover. And one more last thing, if provision for bad debts is there, don't do all the sort of adjustment. In your ACSP problem category 4, there will be one problem relating to provision for bad debt. He will be adjusting bad debt by adding back again to the debtors. That's trash. You ignore that. Take provision for bad debts simply as change in working capital. There itself your problem will be solved. Similar to current liability hai ga? If increase in provision, just add it. If decrease in provision, just deduct that. Solve with this line, your problem will be easily solved. He will be adding closing provision, bad debt to back, and that is all nonsense. Last and final, drawings. Which activity? Financing activity, because it is relating to capital. Again, ACSP category 4, you are having one problem called Zen's capital. Mr. Jen and Chapesi, one problem you will be having. So if you solve that problem, you will be getting drawing as your balancing figure. Because opening capital will be 10 lakhs. Closing capital will be 12 lakh 24,000. But current year profit is 3 lakh 16,000. Then closing should be 13 lakh 60 kada. But it's only 12 lakh 24. So difference between these two things is nothing but drawings, which is a financing activity. Clear everybody? Fine. That's the end for marathon session number 1, which was successfully completed. And afternoon at what time you will come? Okay, let's meet by 3:15. Hey, I have given you 1.5 hours actually. 1:45 to 2:45 and 3:15. Sorry, will you come at 3:30 itself? Yeah, I don't have objection. Sorry, let's meet by 3. Investment property is something like land and building which are given for rentals. For those things, accounting standard number 13 is applicable. AS 10 is also applicable, but 10 is limited only to cost model. Revaluation model is not applicable. Is it clear? For investment property, what is applicable? Only cost model. What is not applicable? Revaluation model. Clear everybody? And the next thing is all about scope. Very simple. Accounting standard number 10 does not applicable to. In the sense, here we are going to see only the non-applicability. This one and this one. I mean to tell like it is not applicable for biological assets. Biological assets are also nothing but renewable resources. And the next one, wasting assets. Wasting assets are nothing but non-renewable resources like mineral ores, mines, oils, gases, etc. and etc. And coming to biological assets, very important, living animal or living plant. What is biological asset? Living animal or living plant. But again very important, it is applicable for bearer plants, it is not applicable for biological assets. Hey, one more very important thing. Biological assets related to agricultural activity. In the sense, if there is biological assets relating to construction activity or business activity, yes, accounting standard number 10 is applicable, provided if it had satisfied the definition of PPE, and provided, as I said in the morning session, new accounting standard agriculture is released till the new accounting standard is released. If biological asset is satisfying the definition of PPE, then automatically accounting standard number 10 is applicable. Likewise, to tell you, there is one of the concept questions, if you have remembered, bulls question. A company had purchased bulls for 1,50,000. The life period of the bulls is 5 years. The company has decided to charge the depreciation under SLM method over these 5 years. So 1,50,000 divided by 5 years. Possible or not possible? Answer. You have to check out. Are these bulls used for agricultural activity or not? If yes, it is not at all possible. In this question, these bulls were actually used for the purpose of construction activity. And hence conclusion. Yes, this is applicable. Provided if that bulls had satisfied the definition of PPE. Clear? While telling the class, we told that it was not applicable straight away, but extra explanations are being given now. Take care. General rule for livestock, accounting standard number 10 is not applicable. Exception. If biological asset or livestock is used for the purpose of activity which is other than agriculture, accounting standard number 10 is applicable, provided this livestock has to satisfy the definition of PPE. Clear? And also till accounting standards on agriculture is released. Once accounting standard on agriculture is released, automatically this PPE is guided by that respective standard, but not as per accounting standard number 10. Respond, is the whole logic clear? That is what your answer for that question of bulls. Accordingly, here bulls are used for the purpose of construction activity which is other than agriculture, and since the life period is more than 1 year, and since it is used for the administration purpose, it is treated as PPE. Understood? In the class straight away we have told that it's not applicable. Yes, prima facie that is correct, but exception, this much rule is there. Respond, is the concept clear? Fine. Next, coming to the next one, bearer plant. What is a bearer plant? Remember, for bearer plant, accounting standard number 10 is applicable. Clear? For bearer plant, accounting standard number 10 is applicable. Now, what do you mean by bearer plant, sir? Same. There are 3 conditions, take care. Point number 1, as I said, same. Life period is more than 12 months. And bearer plant should use it to produce or supply some agricultural produce like fruits, flowers, seeds, or leaves, etc. and etc. Clear, everybody? Very important thing. But plant itself should not be the produce. From plant you should get the produce, but plant itself should not be the produce. Is it clear? From plant you should get some produce, but plant itself should not become the produce. That's very, very important. And last and final thing, bearer plant has remote likelihood. Remote likelihood in the sense, very, very less chances. Remote likelihood to sell the plant as a whole except as a part of scrap sale. What do you mean by this, sir? Point number 1, plant can't be sold as a plant. General rule, plant cannot be sold as a plant. Exception, yes, it can be sold. Likewise, during scrap, it can be sold. See, I can't sell the plant, coconut tree. From coconut tree, I am getting coconuts, agriculture produce. I have to sell that agricultural produce only. Take tree. What is the agricultural produce? Tree itself is the agricultural produce. So I have to deroot the tree and I have to sell it. In such a case, it is not a bearer plant. But take care. Coconut plant, say for example, in an entire plantation of 100 coconut trees, 3 trees got an infection. And hence you have decided to cut down the trees and you have to sell it as a scrap. Can you do it or not? Yes. And it is having very less chances to sell the plant as a whole. What are the less chances, sir? I have given you the example. Like it had got infection, or it was planted at the wrong place, or it was planted in some other's area. And hence you have decided to cut it down. Logic clear? So it is having very less chances to sell the plant as a whole, except scrap sale. If you want, you can sell it as scrap. I don't have objection. Clear? What is the life period of a bearer plant? More than 12 months. Take care. There are people who are thinking that cropping pattern should be more than 12 months. Not cropping pattern. Life should be more than 12 months. Logic clear? Say for example, if you take mango tree, cropping itself will take more than 12 months. Tea plantation, tea leaves, tea plantation, hardly within 3 months you can, what is that called? You can cut down the leaves and you can sell the leaves. People are thinking that tea plantation is not a bearer plant. No, tea plantation is also a bearer plant because the cropping pattern is completed within 12 months. But the life of tea plant is more than 12 months. You need to see the life, but not the cropping pattern. Seasoning pattern kadu. You have to check out the life. Understood, everybody? So life should be more than 12 months and it should supply or produce some agricultural produce, but plant itself should not be the produce. Clear? Plant itself should not be the produce. From plant you should get some agricultural produce. And can you sell the plant as a whole? Can you sell the plant as a whole? No, except as a part of scrap sales. But also you can sell the plant as a whole in some exceptional situations. Respond everybody, pakka. Conclusion. Bearer plant is a property, plant and equipment. In the sense, bearer plant will be dealt as per accounting standard number 10. Is the logic clear? And next one. Coming to recognition and measurement. Please listen very carefully. In a simplest form, would like to complete this one, which will take time actually, but try to concentrate more. There are two kinds of recognitions and measurement. Initial recognition, subsequent recognition. Initial recognition depends on modes of acquisition. Subsequent recognition is done at the end of the year and it is depending on the models. Initial recognition is done at the time of purchase. What are the modes of acquisition, sir? Cash or credit. You can purchase a PPE for cash or credit, or even you can purchase a PPE, exchange of asset, issue of securities, and finally self-construction. Coming to subsequent recognition. Subsequent recognition, it might be either cost model or it might be either revaluation model. Either cost model or revaluation model. The first one. Asset is acquired for cash or credit. Very simple. It has to be recorded at cost price, which is nothing but purchase price plus direct expenses. Purchase price is a price which is stated in the invoice. What are the elements that are stated in the invoice? Three elements will be there. Number one, quoted price. Number two, taxes. Like non-refundable taxes and duties have to be added if they are not included. Refundable taxes and duties like input tax credit has to be deducted if they are included. And finally, discounts. It can be either trade discount, volume rebate, or quantity discount. Clear everybody? And now coming to the next one, direct expenses. Coming to direct expenses, you are having expenses which are directly relating to the acquisition or installation of PPE. Likewise, all the carrying costs. Carrying cost okati, and the next one, loading and unloading charges okati, site preparation cost okati, employee cost okati, installation cost okati, assembling cost okati, professional fees okati. All these things will be added. And very important thing, if any government grant is received, it has to be deducted. Borrowing cost, it has to be added only when the asset definition, asset had satisfied the definition of qualifying asset. Then borrowing cost will be added. Respond, is it clear? The following items have to be ignored actually. What are the following items? Take care. First, borrowing cost which did not satisfy the asset of qualifying asset as per accounting standard number 16. And the next one, general administration expenses have to be ignored. But my dear children, those administration expenses which are actually incurred exclusively for the purpose of installation of PPE or acquisition of PPE have to be included, capitalized. But general administration charges have to be excluded. Understood? And next one, selling and distribution expenses, financing and accounting expenses, okay, and initial operating losses, inauguration expenses, repairs and maintenance, advertisement and promotional activities, research and development activities, all these things must be excluded. Very important, don't forget. Number one, costs of relocation or redeploying. Cost of relocation or redeploying. You are just moving your asset from one place to another place. It will not generally increase any future economic benefit and hence it has to be charged. Take care, moving from one place to another place. Say for example, you are operating at Brodipet. From Brodipet, you would like to move on your factory to Arundel Pet. Pushpa to Ravi, Ravi to Pushpa. Will it increase any future economic benefits? It resulted in decrease in students. Here everybody. Anyways, which is absolutely nothing but cost of relocation, but it will not increase any future economic benefits, and ultimately it has to be charged. And one more important thing at consideration side, testing costs. Hope you have remembered. Testing cost. Testing in the sense you are actually testing whether it is suitable for your business concern or not. In the process of testing, you might get some sample output also. You can sell that sample output and you can make some revenue. Hey, is this revenue in the normal due course of business in the process of testing? In the process of testing. And hence ultimately this testing cost has to be considered to the net extent. Net in the sense testing cost minus testing revenue. That net has to be considered. Respond, is it clear? Now, very important thing. Decommissioning and restoration expenses. What do you mean by decommissioning, sir? Decommissioning is nothing but dismantling. Restoration is nothing but bringing back to original position. So an asset is dismantled and something is brought back to its original position. And for that purpose exclusively you have incurred with some cost price. You have incurred with some cost price. When you are supposed to incur cost price, sir? You are supposed to incur cost price at the time of dismantling and at the time of reinstating. Say for example, in year 1 you have installed the asset and you are supposed to dismantle and restore in year 10. So you have to incur this expense at the end of year 10. Say it is 1 lakh. Bring it to the present value. One and only provision which can be discounted is this provision only. Provision for decommissioning and restoration expense. Provision for decommissioning and restoration expense, which has to be brought to the present value, and it has to be capitalized. Clear? So your journal entry will be machinery account debtor to cash or bank account to provision for decommissioning and restoration expenses account. The total will be capitalized. Respond logic clear? Now very important. If that machinery is used for the purpose of producing the goods, then it has to be added to the cost of production as per accounting standard number 2, which is nothing but inventory. Is it clear? Conclusion. Sir, what to do with provision for decommissioning and restoration expense? Point number 1, bring it to the present value. Point number 2, check whether is the machine used for production of goods other purposes like administration purpose, like rental purpose, rendering of services. Clear everybody? If it is exclusively for the purpose of production of goods, then immediately you have to add it to the cost of production as per accounting standard number 2. If it is used for any other purpose, it has to be capitalized along with the value of PPE as per accounting standard number 10. Clear? Next, sir, I have created provision. Now what to do with provision? Because I have created provision in year 1, but I have to utilize this provision in year 10. From year 1 till year 10, how to unwind the provision, sir? That will be discussed as per accounting standard number 29. Respond, is it clear? This is what your entire provision for decommissioning and restoration expense. Clear everybody? And that is the end of asset acquired for cash or credit. And the next one, self-construction. As simple as such. If an asset is self-constructed, then cost to price is equal to, what is the cost price? Cost of material plus construction cost. Ante kada. Cost of material plus construction cost is nothing but direct labor, direct expenses and other overheads. Very important thing. Consider all the normal losses. Don't consider abnormal losses. please eliminate all the internal profits. All the internal profits have to be eliminated. What is the meaning of internal profit, sir? You are constructing your asset by yourself, kada. At that time, you can use your goods. At the time of using your goods, you have to consider the cost price, but not the selling price. Say, for example, you are constructing the building by yourself, and you are actually using some cement bags, and cost price of cement bags is 500. Selling price of cement bag is 700. How much you have to consider? Not the 700. If you have taken 700, you are inflating the value of the building. But really, it was not having that much price, because your good, you have taken it from purchases, you have supplied it for building. You took it from purchases, you used it for building. Logic understood? So if you're taking 700, you are considering this 200 profit also. Realized or unrealized? Because it is used by yourself only, it is unrealized. So internal profit. And all these kind of internal profits have to be eliminated. Understood? Now, very, 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 very important. Important from concept wise, not from examination point of view. Exchange of assets. You are giving old asset, you are getting new asset. What is a journal entry? As simple as such, new asset account debtor to old asset account, and also write to cash or bank account. People even will confuse for this one, but it is very, very simple. Check out how I am unfolding. Always remember, old asset has to be credited with book value of old asset, and check out whether you are getting cash or you are paying cash. Very, very simple. Cash value will never change, kada. You put it like that only. Clear? The total assets acquired should be the fair value of old asset given up. Fair value of old asset given up. Next one. If this is not there, fair value of new assets acquired. Even if it is not there, book value of old asset given up. Why this order? You don't ask me the logic now, because the logic itself will take around 5 to 10 minutes to explain. So that's waste of time at this point, but you just remember how to unfold it. And the balancing figure is nothing but profit or loss. Clear? Pakka. Take care. New asset to old asset. Fill cash. That will never change. This is always book value of asset given up. This one you know, this one you know. This total should become fair value of old asset given up. If it is not there, fair value of new asset acquired. Even if it is not there, book value of old asset given up. And balancing figure will become profit or loss. One more important thing. This entire thing will be worked out only when commercial substance is there. Again, simple to remember. What is commercial substance? If the exchange is different between different assets, commercial substance is there. Exchange is between the same assets, no commercial substance. Clear? Likewise, to tell you, and a technical meaning if you want, timing, extent, nature, cash flows. Nature, timing, extent, cash flows of old asset should significantly differ from the new asset. And he will be having one more word also, that is, what is that called? No. One word he will be using. Yeah, that's okay. Okay, word untundamma marchipayanu. Post tax cash flows అని చెప్తాం కదా. Enterprise specific value of portion of operations. Commercial substance, he will be telling two things. Number one, nature, timing, extent, cash flows. And the next one, enterprise specific value of portion of operations from the asset given up with the asset acquired should significantly differ. Here enterprise specific value of portion of operations is nothing but post tax cash flows. Should significantly differ from old asset and new asset. Clear? In such a case, you will be telling that there is a commercial substance. Simply to remember, if the exchange is between the same assets, no commercial substance. If the exchange is between the different assets, commercial substance exists. Clear? But in some questions you will be seeing machinery to machinery, furniture to furniture. He will be telling that commercial substance is there. Sir, just now you told if the exchange is between the same assets, commercial substance is not there. అదే కదా చెప్పింది. But here it is contradicting kada. No. What kind of machinery is exchanged for what kind of machinery we don't. Computer is also a machinery, projector is also a machinery. Hope you are getting my point. So what kind of machinery is exchanged for what kind of machinery we don't know kada. What kind of furniture is exchanged for what kind of furniture we don't know. And hence, if it is common noun like furniture, machinery, we will be considering that there is a commercial substance. If it is car to car, no commercial substance. Benches to benches, no commercial substance. Computer to computer, no commercial substance. Land and building for an aeroplane, there's a commercial substance. Different assets. Hope you have got clarity. Furniture is exchanged for machinery. There will be commercial substance. Is the logic clear? That's it. Let me show you how to answer that. I told you rule, but if I show you the application, it will become very easy for you. Let me show that. See this one? Pluto Limited owns land and building, which is carried out in balance sheet at 10 million. Fair value of land and building is 15 lakhs. It exchanged land and building for a private jet, whose fair value is 20 million and pays additional cash 3 million. So now how to write the entry, sir? Very simple. What is the asset you have got? Private jet. What is the asset you have given up? Land and building. Okay. And what is given in the question? Pay the cash or receive the cash? Pay the cash. Pay the cash in the sense to cash or bank. This is 3. This is always to be credited with the book value. What is the book value? Carrying amount 10 million, which is something like 10. Now very important. This has to be recorded with fair value of old asset given up. What is the fair value of land and building given up? No. Fair value is given in the question that it is 15. Clear? Fair value of land and building is 15 plus what is the fair value of cash? 3. It will not change kada. 3. Hey, logic clear? Very simple. Fair value of old assets given up. Cash value will never change. That 3 will be the same. But this 10 will become 15. And finally you will be getting 2 P&L account 5. This is the entire entry. And ultimately private jet has to be recorded at 80. That was such a simple thing. Clear everybody? Hey, say if it is reverse. Ante not cash paid, if it is cash received. Then how it will change? Yes. Let me show you the same. Now, this is 10 only. You are getting cash. Cash value will never change. This total should become fair value of asset given up. That is 15. Clear? Out of 15, this cash value will never change. Balance how much is there? That's it. And finally 2 P&L account 5. Ante. So if you follow this rule, you're going to get it very easily. Hey, this all is correct only when commercial substance is there. Sir, if commercial substance is not there, what to do, sir? Very simple. New asset has to be recorded at fair value, sorry, book value of asset given up. That's it. Book value of asset given up. Nothing great. Nothing else is needed at all. Clear, everybody? Okay, respond. Is the logic clear? Fine. Next. And the next one. Listen very carefully. Initial expenditure is always to be capitalized. I did not speak about issue of securities. It's very, very simple. Issue of securities asset has to be recorded at fair value of securities given up, not the face value, fair value. Ante. Now, initial expenditure is always to be capitalized. Okay. Subsequent expenditure. What do you mean by subsequent expenditure, sir? After the initial expenditure, you have to put the subsequent expenditure. That is after the purchase of asset. Listen very, very carefully. After purchase of asset, till it is ready for use. Till it is ready for use. Whatever expense you incur is initial expenditure. Machine purchased. Ready for use ante, first of all, it has to be installed. So all the expenditure is initial expenditure. Once the asset is ready for use, but you took time for usage, actual usage. So expenditure incurred between the period ready for use and actual usage. Clear? Ready for use and actual usage. In that period, you have to incur expenditure to maintain the asset, and hence it has to be charged. After actual usage, your expenditure, you have to check out whether is it increasing the future economic benefit, is it maintaining the future economic benefit. If it is increasing the future economic benefit, capitalize. If it is maintaining the future economic benefit, it has to be charged. Let me give you an example. My machine capacity is 10,000 units, but it is capable, it is producing only 6,000 units now. So immediately you have done some repairs wherein my capacity had increased from 6,000 units to 10,000 units. Clear? What is my machine capacity? Somehow we don't know, it is producing only 6,000, but you have done some repairs and it had increased to 10,000 units. Expenditure on this has to be charged or capitalized? Charge or capitalize? Of course charge. Don't think that 6,000 to 10 is increase. It is maintained. It is only up to 10,000. More than 10,000 anko, it has to be capitalized. Clear? Very important. Year 1, the capacity is 10,000. Year 3, the capacity, since you are using, automatically asset diminishes. Now the capacity has decreased to 6,000 units. Now you are putting some repairs and it is increased up to 10,000 units. What it has to be done? Charge a capitalizer. Charge a capitalizer. Capitalize. Don't think wrong. This situation is different. This situation is different. Here I told, as of now, our machine capacity is 10,000 only. But due to some faults, it is producing only 6,000. Repairs had increased it up to 6,000. But here, my machine capacity reduced after 2 years to 6,000. Now your repairs is increasing again to the 10,000. In the sense, future economic benefits are increased and hence this has to be capitalized. Respond everybody, pakka. That's it. And yeah, very important. One of the subsequent expenditures is major inspection. Major inspection. Major inspection is not minor inspection. It is like inspecting the entire PPE. Remember, whether asset life period increased, decreased, or whether future economic benefit increased, decreased. Major inspection cost is always to be capitalized. Remember. Clear? And next one, revaluation model. Of course, there are some other things like a replacement of asset, re-major inspection. Those are very easy. You can just go through that. But the next one is revaluation model. Remember, as per accounting standard number 10, asset can be upward revalued or even downward revalued also. Asset can be either upward revalued or asset can be either downward revalued. And revaluation amount cannot be more than fair value. Revaluation amount cannot be more than fair value, provided you also need to consider impairment of loss in case of revaluation, and this will be discussed in accounting standard number 28 in the tomorrow's session. Now moving on to the next thing. When can I revalue, sir? It's your wish. Every year if you want to revalue, you can revalue, but as per standard, it had given you a clue that for every 3 to 5 years, it is recommended you to check first. Check first for every 3 to 5 years. If there is a significant difference, material difference between the book value and fair value, immediately you can do the revaluation. Otherwise, don't revalue. Clear? So you have to check out the difference first, especially every year. If not, at least once in 3 to 5 years. If significant difference is there, do the revaluation. Otherwise, no revaluation. A very important thing. While doing the revaluation, no need to revalue all the assets. All the assets revaluation is not required. But remember, a single asset can't be revalued. A single asset can't be revalued. Single building, no, it's not possible. It is possible to revalue entire class of asset. No need to revalue all the assets. You cannot revalue a single asset. If you want to revalue, you have to revalue the entire class of assets. Respond, everybody clear? That's it with revaluation. And what do you mean by class of assets, sir? Class of assets is all the similar items should belong to one group. Similar items should belong to one group. Likewise, vehicles is one class. Machinery is one class. Buildings is one class. Land is one class. Motor vehicles is another class. Furniture and fittings. Clear, everybody? All these things are nothing but classes. Remember, my dear children, even you can have subclass very clearly. Industrial buildings is different from office buildings. Administration equipment is different from production equipment. You can treat these things as separate classes also. Administration equipment separate class, production equipment separate class, industrial building separate class, office building separate class. Respond, everybody, pakka. This is what? Revaluation. And the last and final thing, depreciation. Coming to depreciation, yes, it is very, very simple. You just need to provide the depreciation. Very, very important. In the morning session, I already told you. Choosing the method of depreciation is accounting policy. But change in method of depreciation is change in accounting estimate. And which method of depreciation is permitted as per accounting standard number 10, sir? Any method. Any method, provided it should match the pattern of generation of future economic benefits. Only when it had matched the pattern of generation of future economic benefits, you choose such kind of method. What do you mean by this one, sir? You are using an asset. check out how the future economic benefits from that asset will be yielded to the enterprise. If equal yielding is there, SLM. If the yielding decreases, WDV. If the yielding depends on units, production units method. If the yielding depends on hours, machine hours method. Like that, you have to choose the method. But take care, there is no point and no pattern and no basis to choose sum of years of digits method and double declining depreciation method. These are not permitted. And also sinking fund method is not permitted. So logically, these are the 4 methods that were permitted. But if you can prove that any other base is there, you can also take on that base also. Clear everybody? That's it. Now next important thing in AS10 itself, component method of depreciation. An asset might be appearing as if it is a single asset, but it is having many components. Say for example, building. Building is having many components. Like land is a separate component, roof is a separate component, lifts separate component, furniture and fixtures separate component, remaining building is a separate component. Cinema theater, furniture separate, projector separate, building separate, screen separate. But all together this is called as a cinema theater. Clear everybody? So component method of depreciation will be provided for different components. Clear everybody? So for one component you can use SLM, for another component you can use WDV, for another component also there is no depreciation at all. Each and every component is one separate asset. Ante. Each and every component is one separate asset. Last and final, very important. What is the entry for depreciation? Asset account. Now, how to close this depreciation? If it is used for production of goods or rendering of services, then it has to be transferred to cost of production. If it is used for administration purpose or rentals, it has to be charged to P&L account. If it is used for self-construction asset accounted or to depreciation. If that asset is used for the purpose of producing intangible asset accounted or to depreciation. Respond everybody, clear? Pakka. Sir, since I am covering accounting standard number 10, even though I did not cover AS 26, it is almost same. Because majority is same. Only the things that I have to cover from AS 26 is all about amalgamation. Ante amalgamation in the nature of merger or purchase. Sometimes AS 14 is applicable. What is that? Or that's the only thing I need to cover. Amortization pattern, same. Exchange for assets, same. Cash or credit, same. Everything is copy paste. Clear everybody? Anyways, this is what something like depreciation. Now, ante where depreciation has to be charged. Next question. So, asset purchased, asset used. Last and final, asset was sold, sir. If asset was sold, very simple. If asset was sold, what to do? Profit or loss you have to find out and transfer it to P&L account. And if any connected revaluation surplus is there, that has to be closed and transferred to general reserve. Understood? Now, next one. Asset is held for sale but not yet sold, which is called as asset is retired from active use. Asset is retired from active use, not yet sold, but you are about to sell the asset. Clear? In such a case, asset has to be recorded with book value or fair value, whichever is lower. Or in another words, carrying amount or net selling price. Because held for sale kada, you are about to sell it. Net selling price or carrying amount, whichever is lower. Respond everybody, clear? This is all about accounting standard number 10. Special elements of accounting standard number 26. First of all, to become an intangible asset, it must be separable from self-generated goodwill. That's very important. To become an intangible asset, it must be separated from self-generated goodwill. If it is not separated from self-generated goodwill, you can't treat it as intangible asset as per accounting standard number 26. Is it clear? The next one, very important. Likewise, for consolidation, intangible assets arising from consolidation, you follow accounting standard number 21. Intangible assets arising from amalgamation, follow accounting standard number 14. But take care, if it is amalgamation in the nature of purchase and all the assets and liabilities are taken over by the transferee company which are relating to transferor company at fair value, take care, amalgamation in the nature of purchase, assets and liabilities are taken over at fair value, and that company's brand image or goodwill is having active market. If having active market, follow accounting standard number 26. If no active market, again same, follow accounting standard number 14. If no active market, AS 14. If active market is there, AS 26. Sir, what do you mean by if no active market is there? Very simple. You are paying excess PC. You just compare it with net assets. If PC is greater than net assets, then it will automatically represent a loss, which is capital loss. Transfer it to goodwill. Follow AS 14. But if your brand image is having separate name, separate active market, if your goodwill is having separate active market, then I will bargain separately for purchasing that brand name or goodwill. In such a case, accounting standard number 26 is applicable. Sir, if AS 14 is applicable, you have to amortize goodwill in 5 years. If AS 26 is applicable, you have to amortize goodwill in 10 years. Respond everybody, clear? So this is your intangible asset first part. Okay. And the next one, amortization is copy paste, nothing great at all. Okay. Now very important, intangible asset always needs a support of tangible item. Intangible asset cannot exist without a physical substance. Likewise, Picasso art, Picasso painting, tangible asset or intangible asset? Intangible asset. But even though he is Picasso, he has to draft it on a paper. He has to draft it on a cardboard sheet, where cardboard sheet is nothing but tangible asset. Logic clear? So now, intangible items always needs a support of tangible items. Then what will it become? Will it become AS 26 or will it become AS 10? Listen, separable, inseparable, you have to check out. If it is separable, for tangible items AS 10, for intangible items AS 26. If inseparable, check out the predominant element. If the predominant element is tangible, all the asset is treated as per AS 10. If the predominant is intangible, all the asset including both tangible and intangible, AS 26. Listen, I'll give you some examples. If you take a computer and you can log in with your Gmail account, and I hope you know now, if the storage is full, you can pay some extra amount also. Am I correct or wrong? Or antivirus, you can install in this computer or also you can install in another computer. Clear everybody? Or Windows OS. Whenever this system is switched on, you will get Windows kada. That Windows OS. It will be having one lock also. If you want to install, you can install in this computer. If you want to install, you can install in another computer, which is at Ravi 5th floor. Clear? So now my question is very simple. Can you separate computer and Windows OS or not? You have purchased Windows OS by paying 10,000 rupees. If you want, you can install in this computer. Or if you want, you can install in another computer. Can you separate or not? Separate ante I am not asking you to pick. It can be separately used either in this system or another system. So for tangible item like computer, accounting standard number 10 is applicable. For intangible items like Windows OS, is 26. Clear? Now the next one. Predominant element, check out this one. Say for example, you have purchased this computer. Along with computer, you will get Windows OS also. Hey, take care. You are not purchasing Windows OS separately. Along with computer, you will get Windows OS. Can you separate that OS and can you separately install in another computer? No. If you separately purchase OS, you can do like this. But if you are purchasing along with a computer, you cannot do like that. Separable or inseparable? What is predominant element? Computer or Windows OS? Computer. So for both things, AS10 is applicable. Antivirus, you will be getting in CDs or pen drives. Separable or inseparable? It is not separable. Clear everybody? Antivirus cannot be separated from CD. I'm not speaking about system here. You will get antivirus in a CD. Can you separate CD? No. Do you know you after running a CD, you can't delete antivirus from that and you can't load whatever you want. That's not possible. Clear? Anyways, CD and antivirus, separable or inseparable? But what is the predominant element there? CD is hardly 10 rupees. You are purchasing antivirus software for 1000 rupees. Answer, antivirus. So for both CD and antivirus, AS26 is applicable. I hope you have got clarity. And the next of accounting standard number 26, research and development. Again the same logic. Check out first, separable or inseparable. If it is separable, for research phase, always to be charged. If it is inseparable, both research and development will be treated as research phase itself and again it has to be charged. If it is separable and if you have got development phase, now the real work will be started. Check out the following conditions. If all the following conditions are satisfied, it has to be capitalized as intangible assets. Otherwise, it has to be charged to P&L account. Now, what are the conditions, sir? Number 1, the development should be, technical feasibility should be there. And you should have enough resources, economic resources must be there. And ultimately, it must create its market itself. Ante, it should generate some future economic benefits. That future economic benefits can be generated either in the form of production of goods, rendering of services, or if you want, you can also sell that. And ultimately, it must be measured reliably. Clear everybody? So if all these things are satisfied, development phase can be capitalized. Technical feasibility and COVID medicine. Technically, will it possible or not? They need to check out. Technically, whether they are having financial resources or not, they have to check out. And also they have to check out whether they are having intention to complete or not. If you are having intention to complete, technically it should be possible and enough resources should be there. If all these three things are there, then you can recognize it as intangible asset, provided it should generate future economic benefit. That can be generated either through usage or through sale. And ultimately it must be measured reliably. If all these 6 conditions are satisfied, development phase has to be capitalized. Otherwise it has to be charged. Last but not least, what is the amortization period, sir? Amortization period, there is some rebuttable presumptions, and the rebuttable presumptions are method should be SLM, life should be 10 years. If otherwise can be proven, follow that method, follow that life period. Otherwise, follow SLM, follow 10 years. Respond pakka. Last and final. If there are any legal rights, purchased, generally consider the agreement period. Say the agreement period is 5 years, then take only 5 years. But in the agreement itself, if you want, you can renew just by paying a nominal fees. And if you so feel that renewal is virtually certain, then you need to consider for another renewal period of 5 years also. Take care. legal rights. It was clearly mentioned in the agreement that you have got a right for 5 years. For how many years you can amortize? 5 years. In the agreement they are mentioning, if you want you can renew it just by paying a nominal fees. License is purchased by 1 lakh. Just you pay 5,000 and get it renew for another 3 years. Clear? Originally how many years? Amortization for 5 years. But in the agreement it was given that just by paying a nominal fees of 1,000 you can renew it for another 3 years. Now entity is virtually certain that it wants the right for another 3 years also. So now what is the life period it has to take? 5 years or 8 years? 8 years. Provided if the renewal is virtually certain. Just now I told you, in the morning session, virtual certain ante 100% chances. If business is expecting that I have initially paid 1 lakh for 5 years. If I pay 1,000, I'll be getting it for another 3 years. Yeah, I'm ready to pay. Virtual certainty. So this 1 lakh is not just for that 5 years, but also for 3 years until totally 8 years. Respond clear? You are having this kind of question in your book. Something like liquor question will be there. License is offered for 4 years. But for another 4 years, company can want to renew the license. And the renewal is virtually certain. So 4 plus 4, totally 8 years you have to amortize. Anyways, clear everybody? That is the end of accounting standard number 10 and accounting standard number 26. Next standard, accounting standard number 11. The effect of changes in foreign exchange rates. Biggest point is that people will forget the name of this standard actually. Forex or foreign exchange. But in examination you are supposed to write the name properly, including the effect of changes in foreign exchange rates. Very simple. This standard is totally divided into 3 parts. Foreign currency transactions, foreign currency operations, forward exchange contracts. If you have done with these 3 things, this standard is over. And coming to non-applicability, yes, to the extent of foreign currency which is dealt as per accounting standard number 3, it will be dealt as per AS3. To such extent of foreign currency which is dealt as per AS16, it is dealt as per AS16. So we will be covering this one in AS16. This is over, but this was not covered. That's very small thing you will be having. In one of the questions you will be having this one. Find the cash and cash equivalents from the following data. And he will be giving cash in hand, cash at bank, cash at foreign currency account, something like $1,000. Foreign exchange rate as on the date of deposit 60, as at the year ending 65. Whatever, say for example $1,000 are there in your hand. Okay, as on the date of deposit it is 60, year ending it is 65. But since you are in India, you have to convert everything into rupees. So how much amount you have to do now? 65 or 60? Year ending, it will be $1,000 into year ending rate only 65. Like that, some small things will be there in accounting standard number 3. So keeping that aside and coming to AS11, to such extent which is dealt as per cash flow statement is dealt as per AS3. To such extent which is dealt as per borrowing cost is dealt as per AS16. And the next one, very important, this standard is helping you to convert foreign currency to Indian currency, but not the vice versa. It is not helping you to convert Indian currency to foreign currency. That is wrong. It's only like foreign currency to Indian currency. Next one. This standard is not going to deal. This standard is not going to deal with what currency you have to prepare your books of accounts. If you want to prepare in rupees, dollars, pounds, that's your choice. This standard is not going to give you any data. But remember, you have to disclose if you are not preparing in Indian currency. As per this standard only. That's the irony. Point number 1, this standard is not asking you to prepare the books of accounts in a specified currency. It's not giving any rule for the same. But if you are not preparing in rupees, you are supposed to disclose the same as per this standard itself. Clear? Let me start with the first one, foreign currency transaction. What is foreign currency transaction, sir? Transactions which requires settlement in foreign currency. Settlement might be either receipt or payment. If the receipt or payment is there in foreign currency, only then FCT you will call and AS11 is applicable. Say for example, you sold to Mr. Ramachandra who is at America for $10,000. The sale value is $10,000. You have very clearly agreed in the agreement that you pay rupees 9 lakhs, that's okay. Pay rupees 9 lakhs. This is given in the agreement. Can we call it as foreign currency transaction or not? Sale is done for $10,000 credit. Settlement has to be done in rupees 9 lakhs. Will it become a foreign currency transaction or not? No. Because FCT is something which needs the settlement to be in foreign currency. It might be either receipt or payment. But the settlement is in which currency? Indian currency. So it is not an FCT. Respond everybody, clear? Fine. That is what accounting standard number 11 with respect to FCT. And very important thing, recognition and measurement. Initial recognition will be always done at spot rate on date of transaction. Subsequent recognition depends on monetary item or non-monetary item. Monetary item in the sense it's cash and cash equivalents. If not, you have to check out whether is it asset or not. If asset, receipt is there or not. If receipt, is it there in cash or not? Money. And finally, is it fixed or not? Liability, payment, money, fixed. Asset, receipt, money, fixed. Sale of fixed asset. Asset, receipt. If you sell, you will get money, but not fixed. Ante kada? So it is a non-monetary item. Clear? Inventory, asset, if you sell you will get money, receipt, fixed. Inventory fixed? No, to one person you will be selling it at one price kada. And moreover, you will be getting money or not also you don't know. You might give it for samples or discounts, etc. and etc. And hence even inventory also non-monetary. Debtor, asset, receipt, money, fixed. You know how much he has to give exactly. And hence it is a monetary item. Clear? You need to check out like that. Whether is it asset or not. If asset, receipt is there or not. Receipt in money or not. Finally, is it fixed or not? Liability, payment, money, fixed. If all these are satisfied, it will become a monetary item. Clear? Subsequent recognition depends on classification, whether monetary or non-monetary. If it is monetary item, it has to be recorded at closing rate. Closing rate and rate on date of balance sheet. Again, non-monetary recorded at historical cost aithe it has to be recorded at spot rate. Non-monetary recorded at fair value or net realizable value aithe it has to be recorded at closing rate. Initial recognition at which rate? Spot rate. Subsequent recognition depends on classification. If monetary, closing. If non-monetary, if historical cost, spot rate. non-monetary at fair value or NRV, closing rate. So ultimately there is some difference between spot rate to closing rate. Am I correct or wrong? This difference is nothing but exchange difference which has to be transferred to P&L account. Clear everybody? This difference is nothing but exchange difference which has to be transferred to P&L account. Something like at the time of sale, say $1,000 sold. At the time of sale 60, year end 62, later on 61. At the time of settlement. Yeah, one more thing, listen. If the transaction and settlement in the same year, exchange difference will be initial recognition to settlement date. But if the transaction is in current year, but the settlement falls in the next year, in between these two things, year end will also come kada. In such a case, exchange difference will be two things. Initial recognition to subsequent recognition to settlement date. Respond, is it clear? So now whatever the differences are there, those differences has to be comfortably transferred to P&L account as if there is a profit or as if there is a loss. Understood? Okay. Listen. Say for example, at the time of sale it is 60, year end it is 63, and as on the date of settlement it is 62. So how to write the entries? Very simple. Debtors account, debtor to sales account. Say you have done the sale of $1,000. So 1,000 into 60, which comes to 60,000. From 60 to 63, the rate is actually increased. Profit, because it is a receipt. From debtors, you have to get the money. So profit has to be credited to P&L account, which is nothing but $1,000 into 63 minus 60, which comes to 3,000. And ultimately, who has to be debited again? Debtor, which comes to 3,000. At the time of settlement, take care, okay? Decreased. Profit or loss? Loss. Check out. Cash or bank. How much I have to get? $1,000 into 62, which comes to 62,000. Ante kada. Profit or loss? Loss. Loss will be debited to P&L. $1,000 into 63 minus 62. 1,000. And finally, two debtors, which comes to 63,000. Check out. Initially 60, later on 3. Totally 63 debited, 63 credited, and hence closed. Understood? This is what your FCT normally completed. Now FCT is having a special case. Paragraph number 46A. Paragraph number 46A is applicable only for companies. Once chosen, it can't be withdrawn. Mandatory, they have to follow this one. And this is optional but not mandatory. Once chosen, mandatory, they have to follow. Clear? Paragraph number 46A is applicable only for companies. Optional or mandatory? Optional. But once chosen, it becomes mandatory. Like withdrawing is not possible. What to do, sir? As per paragraph number 46A, they have created a new item called LTFCMI. Long term foreign currency monetary item. Already you know monetary item. Either cash or cash equivalents, and asset, receipt, money fixed. Liability, payment, money fixed. And it should be denominated in foreign currency. And it is long term. What do you mean by long term? More than 12 months. From the date of balance sheet kadu, date of transaction. That is important here. If that LTFCMI is relating to depreciable asset, then that has to be debited or credited to asset account. And instead of debiting and crediting to P&L account, you have to debit or credit to asset account. If that is other than depreciable asset, like any other thing, okay, it has to be debited or credited to FCMITD. Foreign currency, monetary item, translation difference account. It has to be debited or credited to this account. And later on, FCMITD has to be amortized to P&L account as per the contract period. Respond clear. And after charging to asset value will either increase or decrease kada. And you have to provide depreciation on the revised value of the asset. Understood? That is your LTFCMI. It's applicable only for companies. So in the question, he may not give you, follow paragraph number 46A. You have to check out whether if it is satisfying LTFCMI, then you write on both the answers also. Clear? That's it. And that is the end of FCP. And the next one, FCO, foreign currency operation. There are two kinds of foreign currency operations, integral and non-integral. Integral is purely similar to head office. Non-integral is like extension to head office. This is totally dependent on head office and this is totally independent. Clear? Remember, in foreign currency transactions, there are recognitions. Initial recognition, subsequent recognition, settlement date, from that rate to this rate, difference has to be transferred to P&L account like that. But here you will not be having such kind of thing. Here you will be having translation. Because operation is nothing but, take care, an FCO can be in the form of a branch, warehouse, joint venture, subsidiary, office, etc. And it is operating from the foreign country, having headquarters at India. Foreign currency operation is an operation which is operating from the foreign country, having headquarters at India. And that operation might be in the form of subsidiary, associate, joint venture, warehouse, branches, offices, etc. So who is doing the business? Foreign currency? No, I'm asking who is doing the business now? Head office is doing the business, operation is also doing the business. Question is not clear. I'm asking like, we are speaking about FCO, foreign currency operation. Okay. Foreign currency operation is established in which country? India or foreign country? Is it doing the business or not? So who will record the transaction? Operations, until like for our better convenience, let us speak about branch. Foreign branch transactions will be recorded at branch, head office, both. Question clear? Hey, now is the question clear? Who is going to record the transactions occurred at the foreign branch? Foreign branch, head office, both. It's only by the foreign branch. Its transactions, how the head office will be knowing, will be recorded by Sepale will be recorded by foreign branch. Periodically, they will send the books of accounts to head office, which is in India. Now your work will start. Their books of accounts is in foreign currency. You have to translate it to Indian rupees. If it is non-monetary, translation, everything is at closing rate only. Whether monetary or non-monetary, everything is closing rate. If at all, take care, if it is integral. I'm sorry, I've confused you. It's non-integral. Just wait. Who is recording the transactions for foreign currency operation? Foreign branches itself. Foreign branches will be sending books of accounts to head office periodically. Now it is the point of head office to convert foreign currency to Indian currency. In the process of conversion, first of all decide what kind of operation is that, integral or non-integral. If it is non-integral, whether monetary items or non-monetary items, you have to record it at closing rate. If it is integral, it is very very simple. If it is monetary item, at closing rate. Non-monetary recorded at historical cost aithe spot rate, non-monetary recorded at fair value or net realizable value aithe closing rate. Very important, exchange difference. Exchange difference has to be transferred to non-integral, FCTR, foreign currency translation reserve. If it is integral, exchange difference has to be transferred to P&L account, and FCTR will get closed only when the entire foreign currency operation is either sold or liquidated. FCTR will get closed only when the operation is sold or liquidated. Respond everybody, clear? Yeah, of course, disposal. Simply to tell you, FCO must be closed. FCO must be closed. If FCO is closed, then automatically FCTR will get closed. Otherwise, FCTR will continue. Respond, clear? This is concept. But for doing the problems, take care. Integral, non-integral. Opening assets and opening liabilities. Opening rates. Closing assets and closing liabilities. Closing rates. Expenses and incomes. Average rates. Contingent assets and contingent liabilities, if any, closing rate. Clear everybody? Very important. Fixed assets and depreciation. Here spot rate, here closing rate. Spot rate is nothing but rate on date of transaction, that is date of purchase. Here it is year ending rate. And finally, exchange difference will be transferred to P&L account. Exchange difference will be transferred to FCTR. Transactions between foreign operation and head office, actuals, you should not convert. Likewise, goods sent to head office, goods received from head office, goods received from branch, goods sent to branch, all those things will be actual. Respond everybody, clear? And last and final part, forward exchange contracts. Forward exchange contracts are divided into two types, speculation and hedging. You have to read the question very carefully to identify whether is it hedging or speculation. Hedging ante need for foreign currency will be there, but speculation ante need for foreign currency will not be there. Is it clear? Sir, need for foreign currency will not be there in speculation, even though he will trade. He will enter into a contract only when there is a need for foreign currency. How to identify in the question, sir? Very very simple. He will be telling Raj Limited purchased the plant and hence entered into a contract. Raj Limited had purchased a plant and hence entered into a contract. Is the need is there or not? Yes, because purchase the plant from foreign country, you have to pay it to them. So need arises and hence you have entered, which is nothing but hedging. Nothing will be there. Straight away the company is having a contract. Nothing data will be there. Straight away you will be having the company is having a contract. In such a case it is speculation. Be careful. Page 11 it పోయిన check out here. Raw Limited purchased a plant for $1 lakh on some date which is payable after 3 months. Payable after 3 months, and hence company entered into a forward contract. Hedging or speculation? Hedging or speculation? Hedging. Now check out this question. Mr. A bought a forward contract. No need is there, but even though he bought a contract, which is called as speculation. Understood, everybody? So you need to check out whether the need is there or not. So first of all, what do you mean by a forward exchange contract, sir? Very, very simple. Contract entered now to exchange the foreign currency in future at a predetermined rate. Clear? Now very important rules. I'll tell you rule. It's very, very simple actually. If it is speculation, forget about spot rate, okay? If it is speculation, you forget about spot rate. You have to concentrate only on forward rates. Initial recognition to subsequent recognition to sale dates or settlement dates. Profit or loss has to be transferred to P&L account. Ante. Clear? Forget about dash rate, spot rate. But in this question, CRD number 8, he will not give what is the forward rate at the year ending. In this question, CRD number 8, he will not give what is the forward rate at the year ending. And hence he will be putting entire 8,000 profit for the 1 year only. See here, the current market value of the forward contract has not been given in the question, and hence no profit or no loss is recognized. Total profit is recognized in the year of sale only. But if given mandatory, you have to do like this. Hey, which rates you have to play with? Which rate is not to be considered? For speculation, yes, don't like, yes. Speculation, don't like, spot rate. Speculation, spot rate. No, don't consider. Consider only which rates, Amma? Forward rates. Is it clear? Now very, very important, hedging. Premium or discount between spot rate and forward rate has to be amortized over the contract period. This is the only rule. Enough. Clear, everybody? Premium or discount between spot rate and forward rate. You have to compare spot to forward, okay? Sir, spot 42. Forward contract entered 43. Increase or decrease? Increase. And a premium or discount? Premium. If decrease, that is nothing but discount. So compare dash and dash. Spot rate and forward rate. And find whether it is premium or discount. A very important thing. That spot rate and forward rate should be on the date of transaction. Premium or discount between spot rate and forward rate as on the date of transaction has to be amortized over the contract period. If forward is more, premium. If forward is less, discount. Hey, I'm not telling profit or loss. I'm speaking premium or discount. Premium ante increase, discount ante decrease. Sir, then why can't I tell premium is profit? It might be either payable also. If it is payable, increase is loss. If it is receivable, increase is profit. That's the reason I can't tell premium is profit, discount is loss. Premium is profit when receipt. Premium is loss when pay. Clear, everybody? So that has to be amortized over the contract period. Say if the contract period is for 4 months. Total amount has to be amortized for 4 months. That's it. Clear, everybody? And that is the end of accounting standard number 11. The entries for receipts, then refunds will be exactly reverse. Let us start. Government grant relating to monetary assets, non-monetary. First, let us speak about non-monetary. Work koncham taraga ayipotundi. So coming to non-monetary. Ante, sir, in accounting standard number 11, monetary and non-monetary is different. There monetary ante cash and cash equivalent, asset, receipt, fixed money. Even liability, payment, money, fixed. But here such a kind of thing is not there. Monetary ante cash, non-monetary ante not cash, but it is measurable in cash. Ante. Clear? Simply to tell you, non-monetary is nothing but kind. Monetary is nothing but cash. You will be commonly called as cash or kind kada. So non-monetary is nothing but kind and not. Now, government grants relating to non-monetary assets. Very simple. Again, you have to check out whether is the kind. Here kind is nothing but asset. Is the asset received at free of cost, or is the asset received at concessional price? If the asset is received at free of cost, super. Record it just at a nominal value. 1 rupee or 10 rupees or 100 or 10,000, that is your choice. But remember, you can't tell that, hey, since I have received it free of cost and 10 rupees immaterial, I don't record it at all. No. Standard itself is asking you to record it with an immaterial amount. That is like nominal value. You have to record it with some immaterial value. You can't claim that since nominal amount is immaterial, I don't record it at all. No. Such kind of thing is not there. Understood? So, if non-monetary is received at free of cost, asset is received at free of cost, it has to be recorded with nominal value and of course no depreciation at all. And the journal entry will be very, very simple. Asset account debtor to P&L account, since it is received at free of cost. And the next one, if it is received at concessional price, very simple. 10 lakhs asset you have got at 6 lakhs only. So what is a journal entry, sir? Asset account debtor to cash or bank account, and you have got it only for 6 lakhs. So pay only 6 lakhs instead of paying 10 lakhs. Clear everybody? This is what your concessional price. Understood? Pakka. Now refunds. Let me speak about refunds here itself. Now asset which was given by government at free of cost is asking the asset back. Very simple. Reverse the entry. Is there any need to record the same? Absolutely no need. If needed, you can write the reverse entry, like if it is debited and credited with 100, again P&L account debtor to asset account 100. But this time government is telling, I want the asset back. So you are ready to give. Government had examined the asset. Government found that that asset was trashed like anything. In the sense, you did not use it with due diligence. You did not use it with proper care. So government is asking you to pay the money. Clear? In such a case, asset account debtor to cash or bank account. Understood? Because it is asking you to pay the money instead of refunding the asset back. Now moving on to the next thing. Second slot. Government had given a grant of 4 lakhs. But in future government is asking you to refund the same. In the sense, can I give my asset back? If I give my asset back, government has to give some money to me. Clear? Because I have paid 6 lakhs. So government won't ask asset in this case at any cost. Government asks you to pay the difference. So how much is the difference you are having? The same will be asked by the government, where the entry will become asset account debtor to cash or bank account 4 lakhs. Respond everybody, clear? And after once the refund is done, you will be getting asset value with the revised figure kada. Provide depreciation only on the revised figure. Say initially it was 6 lakhs. 2 years completed. You have charged a depreciation of 2 lakhs. Balance 4 lakhs is there. Clear? At this time you have refunded to the government by payment of additional price of 4 lakhs. So existing 4 plus 4. So totally 8 lakhs. From this year you have to provide depreciation on 8 lakhs. Respond clear. That is the end of non-monetary assets. Now moving on to the next one. Monetary. The government is giving you some cash. Is the cash given for depreciable assets other than depreciable assets? If it is given for depreciable asset, again you are having two options to record the same. Asset reduction method, DGG method, or asset liability method. What is this one, sir? Listen first. I'm purchasing an asset. Asset account debtor to cash or bank account 10 lakhs. This time government had given cash to you 4 lakhs. Cash account debtor to government grant 4 lakhs. Is it clear? Hey, in this example, government given asset at a discounted price. But here I have purchased the asset already. Government had given the cash. Clear. Now what to do with this government grant, sir? You are having two options. If you want, you can deduct this government grant from the asset, where your entry will become government grant account debtor to asset account, which will become 4 lakhs. So that your asset will be shown at 10 lakhs minus 4 lakh, 6 lakhs. Start providing depreciation only on 6 lakhs. Say for example, 2 years completed and 2 lakhs is your depreciation. Balance is like 4 lakhs. At this stage, government is asking you to refund. Very simple. Here it had given money, ante kada, and asset account is credited. So now the reverse entry. What could be the reverse entry? Asset account debtor to cash or bank account, where it is asking to refund 4 lakhs. So again my asset value will increase to the extent of 4 lakhs. Now revised depreciation will be on 8 lakhs. Clear? Pakka? Now listen carefully. Sir, I have already purchased an asset 10 lakhs. Government had given the grant, but I am crediting separately to an account called deferred government grant, and which is absolutely nothing but 4 lakhs. 2 years completed. Listen very, very carefully. 2 years completed. Say for example, minus yearly 2 lakhs annukunte ante 5 years. Let me take 4 years as the life period for better clarity. Say 1 year completed. How much is the depreciation? 2.5 lakh. Clear? Here also 1 year completed. 4 lakh divided by 4 years. How much is reduced? 1 lakh. Clear? Now balance of DGG is equal to 3 lakhs. Balance of asset is equal to 7.5 lakh. At this stage, government is asking its money, entire 4 lakhs. What is the entry, sir? This will not change. This will not change. Because in this method, asset is not affected, kada. In this method, I have credited the asset, and hence asset value decreased, increased happened. But here grant itself is separately maintained. So asset account will not affect, and it will continue like 2.5 lakh depreciation. Now what happens? Listen to the entry, okay? DGG account debtor, balance is only 3 lakhs. But to cash or bank, government is asking entire 4 lakh. So remaining 1 lakh has to be debited to P&L account. Logic clear? To the extent of balance exists, DGG will be debited, total refund, and remaining will be transferred to P&L. Sir, say for example, government is asking you to refund only 2 lakhs. Then it will become 2 lakhs. Balance of DGG will become 1 lakh, which has to be amortized over remaining 3 years. Logic clear? Huh? This is what your government grant, monetary asset, depreciable asset. Now monetary other than depreciable. Now if it is something like other than depreciable asset, if it is other than depreciable asset, you have to check out whether the grant is relating to establishment or grant is attached with some conditions. If the grant is relating to establishment, it is called as capital approach. If the grant is attached with some conditions, it is called as revenue approach. Government had given the grant. It did not set anything. Even then you have to follow capital approach. Clear everybody? For capital approach, cash or bank account debtor to government grant account debtor to capital reserve account. So if government is asking you to refund the money, very simple, capital reserve account debtor to cash or bank account. If a grant is always attached with some conditions, then you have to follow revenue approach. Check out whether the grant is for less than or equal to 1 year or more than 1 year. If it is less than or equal to 1 year, cash or bank account debtor to GG account and government grant account debtor to P&L account. If it is more than 1 year, cash or bank account debtor to DGG account, deferred government grant, and next deferred government grant account debtor to P&L account. But not total amount, only the proportionate amount will be transferred. And if government is asking you to refund the money, DGG account debtor to the extent of balance exists and you have to pay the cash, and remaining if any is there, it has to be transferred to P&L. Respond, is it clear? So that is what your government grant. But wait, you're having one more thing here. Likewise, sir, receipt of grant, which item? Exceptional item. But refund of grant, which item? Extraordinary item, as per accounting standard number 5. If you receive any grant, yeah, it's quite common that government will assist your business. But it is not expected that every time it will assist you. And hence it is exceptional item. Once after giving the grant, who will expect that it will take back? Ante kada. So it is extraordinary item. Respond, is it clear? Now very important thing. Receipt of grant is exceptional only, but in the following two situations, it has to be treated as extraordinary. What are the two situations? Situation number 1. In the entire industry, your firm alone had got the grant. In the entire industry, in the entire petroleum industry, only what is it called? New company like Shell had got some grant from the government. In such a case, it has to be treated as an extraordinary item. This is point number 1. Clear? Point number 2. Sir, we have received the grant in the current year, but we did not recognize that at all. Why you did not recognize? Because I am not having certainty on the government that it will give the cash. Government grant. I got a letter that you are going to get government grant in the next year. But I did not record the same because I am having uncertainty. Okay. In the future year, surprisingly, I have got the grant. And hence I have to record this grant in the current year, but not in the previous year, even though it is relating to the previous year. Then can I treat it as prior period item? No, because I had left in the previous year, not due to error, not due to omission. I have left due to uncertainty. And hence in the current year, it has to be treated as extraordinary item and it has to be disclosed separately. Logic clear? In the entire industry, if only one firm is receiving, it is to be treated as extraordinary item. Generally, receipt of government grant is an item. And received grant in the current year, but which is relating to the previous year. In the previous year, we did not record due to uncertainty. In such a case, it has to be treated as extraordinary item. Respond, everybody, clear? That is the end exactly of accounting standard number 12. Fine. Let me continue. investment accounts, which is including accounting standard number 13. What is an investment? Of course, investment is an asset which is held for earning some income or for capital appreciation or for some other benefits. Income can be either dividend, interest and rentals. Clear? Now listen very, very carefully. Sir, as I said, exclusion and non-applicability. Did you remember? Non-applicability ante? It will be given its scope for the entire accounting standard. Am I correct or wrong? And coming to exclusion, it is excluded from the definition. So even AS 13 is having an exclusion, which is like stock in trade with respect to investments in securities. Investment in securities held as stock in trade. This is excluded from the definition of investment. Understood? Investments are assets which are used for earning income or capital appreciation or others, except investment in securities held as stock in trade. In the sense, the company itself is an investment company. Purchasing investment, selling investment, purchasing investment, selling investment. All such kind of investments are actually excluded from the definition of investment. Shall I proceed further? And take more care, my dear children. Forms of investments, types of investments. Actually, there is no word called types of investments as per AS 13. As per AS 13, the forms and the next is classification of investment. These are the wordings. But classification is commonly called as types. What do you mean by forms of investment, sir? Investments in securities, investments in bullion, investment in property. This is called as form. Now coming to types or classification, current investments, long-term investments. What do you mean by investment in securities? Debentures, bonds, shares, etc. and etc. Investment in bullion, gold, silver, likewise all the precious items will come. And finally, investment in property, very important, take care. We have also covered the same in accounting standard number 10, afternoon first part. Likewise, investment property, if anything investment property is there, accounting standard number 13 is applicable, but AS 10 is limited only up to cost model. Revaluation model is not applicable. Remember, the same thing, accounting standard number 13 with respect to investment property. Very important. Coming to investment property, it is applicable only for land and building held for rental purpose. If land and building held for administration purpose, then that is not dealt as per AS 13. It is totally dealt as per AS 10. But if land and building held for rental purpose as per AS 13, that is called actually as investment property. Respond everybody, clear? Now, moving on to the next thing, classification. Current investment, long-term investment. Listen, current investments, two conditions should satisfy. What's the first one? Less than 12 months and it should be readily realizable. Antena? What is long-term investment? More than 12 months, not readily realizable. Huh? No, listen, I'll tell you. Long-term investments, current investments. Okay. Take care, my dear children. Current investments are the investments which are held for a period less than or equal to 12 months and it is readily realizable. If these two conditions are satisfied, you can tell it as a current investment. Long-term investments or investments which are other than current investments. Let me show you exactly the definition. Two point. No. Yeah. Yes. Current investments readily realizable and intended to be held for not more than 1 year. Not more than 1 year in the sense less than or equal to 1 year. Clear everybody? That is called as current investment. Other than current investments, whatever is there, it is called as long-term investments. Very important. Two conditions should satisfy. It should be readily realizable, less than or equal to 12 months. That's the reason one of the concept question you will be having. A company purchased the land and building at an undeveloped area. Its intention to hold is less than or equal to 12 months. Can this be classified as current investment? No. Because if it is in undeveloped area, it is not readily realizable and hence it can't be classified as a current investment. So anyways, current investment period should be less than or equal to 12 months and it must be readily realizable. And very important, valuation. Current investment has to be valued at cost or fair value, whichever is lower. Long-term investment has to be valued at cost price. Temporary fluctuations will be ignored. Permanent fluctuations, permanent increase will be ignored if there is a decrease in value which is other than temporary. Ante permanent decline will be considered and you have to record it at fair value. Clear? A long-term investments have to be recorded at dash price, cost price. Temporary fluctuations will be ignored. Permanent increase will be ignored. Permanent decrease will be considered. And it has to be recorded at fair value. Very important. After permanent decrease, again you can consider permanent increase. Provided that increase is limited only up to cost price, not more than that. Clear? Provided after decrease, increase can be considered and that permanent increase should be limited only up to cost price. Logic clear? Say for example 100 or 80. If it is current investment, it has to be valued at cost or fair value, whichever is lower. Cost price, fair value 80. Current investments 100 and 130. 100. Clear? 180. Permanent decrease 80. 100 and 130. Permanent increase 100. We don't bother for current investments at all. It's like permanent, temporary, we don't bother. Cost or fair value, whichever is lower. Now take care. If it is long-term investment, cost price ante 100. Long-term investment 100. Long-term investment permanent decrease. Long-term investment permanent increase. Clear? Because we will consider only permanent decrease. Clear? Very important. After permanent decrease, now we are at the next year, 80. Listen carefully, okay? 80, 75. This is long-term investment. Okay? Now revised book value or revised cost price is at 80. Fair value is 75. At what price it has to be recorded? 80. Take care. You can't record at 100. Sir, you said investment has to be recorded at cost price kada. Ante 100 kada. No. Out of 100 already 20 is permanent fall kada. So you have to record it at the revised figure, that is 80. Clear? 80 and 90. 80. 80 and 75 permanent decrease. 80 and 90 permanent increase. 90. Because after decrease, permanent decrease can be considered only up to cost price. 80 and 100.5 permanent increase. 100. You can consider permanent increase after permanent decrease, but that is limited only up to cost price. Don't forget. Hey, is it clear? Anyways, this is the valuation. Moving on to the next thing. Revaluation or reclassification. Very important. Sir, current investment has to be valued at cost or fair value, whichever is lower. Long-term investment has to be valued at cost price. Permanent fluctuations, ignore. Permanent increase, ignore. Permanent decrease, consider and record it at fair value. After permanent decrease, permanent increase can be considered, but that is limited only up to cost price. Clear? This is what all the thing that you have learned for valuation. Now reclassification. Once again you need to classify. So initially you thought of like holding it for more than 12 months and classified it as long-term investment. But your decision changed. Now you are about to sell that. So long-term is changed to current investment. Or initially you thought of like current, but your intention changed to long-term investment. Now, as on the date of reclassification, long-term to current has to be recorded at cost price or book value, whichever is lower. If it is current to long-term, cost price or fair value, whichever is lower. Clear? Hey, no need to buy heart this one. Current to long-term kada, rule of current will be applicable. Long-term to current kada, rule of long-term is cost price. But sometimes your book value can be lower than the cost price. So cost price or book value, whichever is lower. Respond everybody, clear? Take care. Here cost price ante pakka cost price. What are you telling, sir? I mean to tell, here I have told you, long-term investment has to be valued at cost price. In the first year it is 100, but 80, permanent decline. So it was recorded at 80. In the next year, you have to start the valuation from 80. 80 or 75. You have to check out temporary fluctuations, ignore. Long-term investment has to be valued at cost price. It doesn't mean that you have to write it at 100 here. Because already out of 120 rupees is permanent decline. So you have to take the revised figure, that is 80. Clear? But here cost price in the sense pakka cost price. Not like revised figure of 80. Here it is 100 in the sense 100. I hope you have got the difference. What I actually mean to tell you. At the time of revaluation in the next year, or at the time of revaluation in the next year, you have to consider the revised cost price or book value as the base for comparison. But for reclassification, it is not like that. Cost price in the sense original cost price has to be considered. Respond, is the logic clear? Fine. And last but not least, if any differences encountered either at the time of valuation or revaluation in the next year or reclassification, the differences has to be transferred to P&L account. Now valuation will be done at the end of the year. Revaluation will be done at the subsequent year ends. Ante first year ending valuation. Second year ending valuation is nothing but revaluation. Third year ending valuation is nothing but revaluation. But reclassification can be done at any point of time. As on the date of, as on the date of reclassification, you have to apply these rules. Not at the end of the year. Respond, logic clear? But whatever the differences are there, those differences have to be transferred to P&L account. This is the end of standard related part. And now let me go with some problematic parts. Coming to problematic parts, your total investment accounts are to be divided into two parts. Fixed income bearing securities, variable income bearing securities. Coming to fixed income bearing securities, your income is always fixed, which is nothing but interest. It can be either bonds, debentures. Clear everybody? Or it can be either government securities. Whereas coming to variable income bearing securities, equity shares, and the income is nothing but dividend. Take care, preference shares are not considered as per AS 13. Until strictly speaking, preference shares will also be there. But we don't do the problems relating to preference shares because practically preference shares are not actively traded. Clear? Now coming to fixed income bearing securities. The only problem with fixed income bearing securities is interest. Interest will be paid by the company to that shareholder, to that debenture holder or to that person whose name is entered in the record date. I hope you know what is record date. Yes or no? In law you are going to get record date. Ledu. Simply like as on cutoff date. Company will be putting one cutoff date. As on that cutoff date, whose name is entered, that person, to that person company is going to pay the interest. Say A sold it to B, B sold it to C sold it to D. Clear? As on the cutoff date, A sold to B and also B sold to C. But after cutoff date, C sold to D. Now, who is eligible to receive the interest? C is eligible to receive the interest. Is it clear? Now C is eligible to receive the interest. That is okay. How many months interest? 6 months interest. Until like it's not like 6 months exactly for the total period annually. But in all our problems we will be getting interest payment for every 6 months. And hence he will be receiving interest for the entire 6 months. Clear everybody? And there are two things which are called as X interest price, cum interest price. The only difference between X and cum is nothing but interest. So generally I will be telling in this notation X interest price plus interest is equals to cum interest price. But if you are habituated to do X interest price add interest, you will be having direct expenses like brokerage and then add interest and then you are going to get cum interest price. Ledu, you will be taking cum interest price, again add direct expense like brokerage minus interest and then you are going to get X interest price. This is what your study material followed and some of the teachers will tell in the same style. But generally I will be teaching in a single line, that is X interest price plus interest is equals to cum interest price. This is actually the very easiest approach. Reason being, check out the question. Given X, comma, find that. If X quote is given, right here. And this will become balancing figure. If cum quote is given, you write here. And this will become balancing figure. And one more thing. Direct expense like brokerage is there. Very simple. Add direct expense if the quote is X. Add direct expense if the quote is cum. You already know interest. Interest is always to be computed for breakup period. What do you mean by breakup period, sir? Last date of interest to date of transaction. What is breakup period, Amma? Last date of interest to date of transaction. So you check out what is the date of transaction first. Say your date of transaction is 1/1/2014. Two dates of interest given, 39 okati, 31 3 okati. Your date of transaction is this one kada. Before this date, what is the last date of interest? 39. So difference between this, which is like 3 months, is nothing but your breakup period. Respond, is it clear? So that is a single thing. One more thing. If it is purchase, direct expenses have to be added. If it is sale, direct expense have to be deducted. Rest of the procedure lies the same. Clear? So X interest price plus interest is equals to cum interest price. Interest is computed for dash period. Breakup period. Breakup period is last date of interest to date of transaction. If cum quote is given, put at cum quote, X quote will become balancing figure. If X is given, write at X, cum will become balancing figure. And if it is purchase, direct expense will be added. If it is sale, direct expense will be deducted. Clear? Biggest point. If it is sale, again you will be having profit or loss. Profit or loss is equal to selling price minus cost price. Clear everybody? Selling price minus cost price. And you are going to get either profit or loss. Shall I proceed further? Selling price will be readily available. Problem is with this cost price only. Cost price can be computed either by following FIFO method or weighted average method. Understood? And what is selling price, sir? X interest price, cum interest price. Always X interest price. Cum interest price always includes interest. So you should not consider interest for finding selling prices and cost price. Clear? Even while drafting in investment account also, you will be writing like number or face value, interest and amount. This amount is always X column, X interest column. Clear everybody? And while going with the problem, please go with chronological order. And some of the students will be actually going with timeline. They will be drafting the timelines. But in examination, you can comfortably avoid this one, or you can do it in a rough basis. Clear? But what you can do in order to save the time is, see the question. 99.9% question. Instead of drafting the timeline, if you observe, to the maximum extent, your question will be given in chronological order only. But you have to put the interest dates in between. You have to actually play only with the interest dates. So please be very, very careful while picking the chronological order. Don't forget interest. Interest is very, very important. Shall I proceed further? Now, listen very carefully, everybody. There is a problem which is given in your RTP, if I was not wrong. Date of interest is equal to date of transaction. Okay. But he had taken the breakup period for the entire 6 months. Hope you have got my statement. This was given in the recent RTP problem. Likewise, your date of interest is equal to date of transaction. But it took the breakup period for entire 6 months. But remember and listen. 39 is the date of interest, and that itself is date of transaction. Then X interest price plus interest for 6 months is equals to cum interest price. But if the question is given exactly after the date of interest, and the date of interest is this one, your date of transaction is 110. In this case, he had taken, there is no breakup period. And in this case, this is not there. So automatically X interest price is equals to cum interest price. It is no more called as X interest or cum interest. It is like selling price or cost price. Understood? Take care. If your date of transaction is equal to date of interest, he had given entire 6 months as breakup period. If the date of transaction is the date exactly after the interest date, then there is no breakup period. This is a new observation. Take care while solving the problem. Clear? Next. All about investments in equity shares. Coming to investment in equity shares, there are 3 parts actually. Number 1 is bonus. Number 2 is rights. Number 3 is dividend. Coming to bonus, as simple as such. Bonus will be recorded in investment account debit side only in number column or face value column. It will not be recorded as a journal entry, and it will never be recorded in amount column. Respond, is it clear? Why? Because there is no flow of resources. To get bonus, I did not pay anything, kada. and hence it will not be recorded in amount column. It has to be recorded only in number column or face value column. That is bonus issue. Coming to rights issue. A shareholder is actually having three options: subscribe, renounce, ignore. If he ignore, you also ignore. And next, if subscribed, it will be recorded in investment account, debit side, number column or amount column. Because you are subscribing in the sense you have to pay cash kada. Investment in equity shares account or to cash or bank account. Clear? That is for this one. Hey, for bonus there is no journal entry at all. Simply like in investment account debit side you will be writing two bonus issue in number column. Nothing in dividend and amount column. Whereas coming to rights issue, it's not like that. You will be writing to cash or bank. You will be writing in number column. You will be writing in amount column. Dividend column, nothing. Clear? If at all you have renounced, renounce is nothing but sale of rights to the outsiders. If you have renounced, it is like profit for you. And hence it has to be transferred to P&L account. Cash or bank account debtor to sale of rights account. Sale of rights account debtor to P&L account. Respond clear? Very, very important. Special condition. You have purchased shares on cum rights basis and these shares had become X rights. When the price will be more, cum rights or X rights? Cum rights, because including a right kada. Under X rights basis, share price will decrease. Then automatically it is representing a loss. And in this case, if you have subscribed a share, absolutely there is no problem. Because this loss is covered with a new share. You have got your wealth back. But if you renounce it to some other people, you did not get your share. You are having some profit. This profit can be set off against this loss. Shares are to be purchased on cum rights basis and after becoming X rights, price will fall and it is representing loss. And if subscribed, there is no problem. If renounced, you will get some profit. This profit has to be set off with this loss. Ante it has to be transferred to investment account credit side by sale of rights account. Clear everybody? In amount column you have to write that. Normally sale of rights has to be transferred to P&L account. But if shares are purchased on cum rights basis after becoming X right, if share price fell down, then it will represent loss. In such a case, renouncing amount has to be recorded in investment account credit side. Okay, respond, is it clear? You're having a problem in ACSP actually. I'll show it to you for better application of this concept. Check out this one. Shyam waived 100% in favor of Mr. Rahul. In the sense, Shyam is renouncing or selling its rights to Mr. Rahul at a price of 20 rupees each. And he is actually having 200 cum rights share and the company had announced a rights of 1:6 ratio. 200 into 1/6. No, wait. Originally he is having 1000. Okay. Plus newly purchased 200. Total it will become 1200 into rights ratio 1/6. And he will be getting 200 right shares. Each and every right is sold for 20. So 200 into 20, he had got 4000 sale of rights. Okay, normally sale of rights has to be transferred to P&L account. Undoubtedly it has to be transferred to P&L account. But listen very carefully. All the shares held by Shyam had been acquired on cum rights basis and the X right of all these shares after the declaration of rights had got reduced by 3400. reduced by 3,400. So 3,400 is my loss. And how much profit I have got? 4,000. Ante kada. So in investment account, credit side, you put only 3,000. Hey, set off this profit with this loss, abba. How much is your loss? 3,400. How much is your profit? So set off 3,400 in investment account, credit side. Balance how much is there? 600. Transfer it to P&L account. Logic clear? Take care. If all the shares held by Shyam had been reduced by 4,500, how much profit you are having? 4,000. How much loss you are having? What can you do? You can't do anything. So set off only 4,000 and leave the rest. Don't take a dare to transfer it to P&L account. Conclusion. Check out carefully. If your profit from sale of rights is 4,000 and they got reduced up to 4,000 or less than 4,000, like 3,500, set off 3,500 by transferring it to investment account, credit side. Balance how much is there? 500. P&L account, credit side. Clear? If your loss is more than 4,000, don't do anything. Transfer 4,000 directly to investment account, credit side and close the issue. Understood? If the loss is more than 4,000, you cannot do anything. If the loss is less than 4,000, set off to that extent and balancing figure will be transferred to P&L account. If the loss is exactly 4,000, yeah, profit, loss, set off. And leave the rest. Respond clear. That's it. And yeah, that is the end of rights. And moving on to the next one, dividend. Sir, take care. Let me give you some tips with respect to dividend. Point number 1. Don't find the reasons. Just understand the concept and remember. Interim dividend is always post. If the dividend is received for holding period, it is post. If the dividend is received for non-holding period, it is pre. You understand like that. Interim dividend is always received for holding period, and hence it is post. Take care. Final dividend. Final dividend. Ante last year dividend will be declared in the current year dividend will be declared in the next year dividend will be declared in the later year. Interim dividend, current year dividend in current year, last year dividend in last year, next year dividend in next year. So interim dividend is always post. Final dividend on opening balance, post. On current year purchases, pre. Because you are purchasing in the current year but receiving dividend for the last year. Purchase dividend in the current year. Purchase dividend in the current year but receiving dividend for the last year. Clear? And hence on current year purchases final dividend is pre. On opening balance final dividend is post. Sir, what problem is there if it is like pre or post? Post will be transferred to P&L account, credit side. But initially it will be transferred to investment account, credit side, dividend column. Thereby it will be closed and transferred to P&L account. If it is pre, it will be transferred to investment account, credit side, amount column. Understood? One more important thing. Take more care, my dear children. Final dividend will not be given on current year bonus and current year rights. Because these shares are there only in the current year. But final dividend is given for the last year. In the last year, these shares are not there, kada. Shares are issued only in the current year. Logic clear? But take care. Interim dividend will be given on every share. Interim dividend is given on every share. Interim dividend is given on bonus, rights, everything. But final is given only on existing number of shares, but not on current year bonus and current year rights. Respond, is the logic clear? Now, how to find weighted average cost? Weighted average cost under debentures is equal to total cost of debentures divided by total number. But weighted average cost under shares is equal to total cost of debentures minus pre-acquisition dividend. Because pre-acquisition dividend is transferred to investment account credit side minus rights issue special case. Because normally rights issue will be transferred to P&L account credit side. Under special case it is transferred to investment account credit side amount column. Clear? Whole divided by total number of shares including bonus. Respond, everybody clear? That is the end of your investment accounts. Okay. And one more last point I've forgotten. Some debentures will be converted into equity shares. Then the journal entry will be investment in equity shares account debtor to investment in debentures account. This is pretty fine, sir. But at what price it has to be recorded? Remember, cost price of convertible debentures is equal to cost price of convertible equity shares. Under 10,000 debentures are costing 1 lakh. 2,000 debentures are converted. Take care. 10,000 debentures are costing for 1 lakh. 2,000 debentures are converted into equity shares. Find the cost of 2,000 debentures. What is the cost of 2,000 debentures? You can't tell like that. Check out whether it is FIFO method or weighted average method. If it is weighted average, 1 lakh by 10,000 into 2,000. As you said, it is 20,000. But it is FIFO, you have to check out first in, first out. Respond, clear? So cost price of convertible debentures is equal to cost price of converted equity shares. Respond, pakka. That is the end of your investment accounts, including accounting standard number 13. Okay. Just wait. Would like to tell AS10 one point. AS10 one problem will be there, which is actually very typical. If I was not wrong, 2 problems are there very typical, but one of the problems is like component. Listen very carefully. Asset is purchased along with a component. Component value not separately ascertainable, and hence he will be providing depreciation on total. So on a specified date you will be getting book value of asset along with a component. Now you would like to replace the component, and component is having a fair value in the market now. But to replace the component, first of all you have to take off the old component. Kada? Physically it is easy. Take off the component, throw away, new component, fix it. But in books of accounts, since component is taken, some part of cost should be taken. Kada? Some part of cost should be taken. How much is that part, sir? For that purpose, this fair value has to be worked back to find the present value. And then you have to provide depreciation. You will get one new value. This value has to be deducted from this book value. And then the fair value will be added. You are having one problem. You remember the procedure and try to solve the problem. If you read the problem, now you may understand in a better way. Asset along with component. Component value not ascertainable. And hence you have provided total depreciation. On a specified day you are having book value along with asset and component. But now you would replace the component. Physically taking off component, purchasing a new component, attach. But in books of accounts, some portion of component value has to be deducted. How much has to be deducted, sir? If you know here separately, you will separately depreciate. But since you don't know, and now you are having little fair value, that fair value has to be worked back to find the present value. And from that value, you need to deduct the depreciation. You will get the book value. That has to be deducted and new value has to be added. Clear? This is relating to AS10. I've forgotten there to tell. అప్పుడే చెప్దాం అనుకున్నా మర్చిపోయా. Anyways, that is the end of your accounting standard number 13 along with investment accounts. So get ready. We are going to start with accounting standard number. Let us go with 16, 18, 20 and then 17 and 24. This was at last. So let me go with 16 actually. Okay. Just 2 to 3 minutes time. Accounting standard number 16. Accounting standard number 16, borrowing costs. Very, very simple standard, nothing great at all. First of all, you're supposed to know what is a borrowing cost. Remember, borrowing cost includes interest. And borrowing cost also includes commitment charges. Interest will be charged on released portion of loan. Commitment charges will be charged on unreleased portion of loan. First of all, what do you mean by this one? Release portion, unreleased portion. You have applied a loan for 10 lakhs. You know, sometimes bank will not give entire 10 lakhs in your hand immediately. First of all, it will give 6 lakhs. And later on, it will tell, start the work. I will see the work and I'll be releasing the next slot of amount 4 lakhs. Clear? So now, out of 10 lakhs sanctioned, 6 lakhs released, on which you have to pay interest. Still unreleased is how much amount? Bank will charge commitment charges on that. What is commitment charges, sir? Since I have given commitment to you that I will release that 4 lakhs if you have done the work properly. So on that 4 lakhs, I'm going to charge some commitment charges. No, sir, I don't pay. Then you don't get the loan. Simple. Clear, everybody? So commitment charges is also a part of borrowing cost. Understood? Now, the next one, discount on issue of debentures. Discount on issue of debentures is also, or in another words, loss on issue of debentures is also a part of borrowing cost. And to such extent which is dealt as per AS3 and to such extent which is dealt as per AS11. And AS11 linked to AS16, AS3 linked to AS16. Even that also will be treated as a borrowing cost. But on a simple note, you can think that interest is borrowing cost. On a simple note while solving the problems. But you're having one more thing also, something like cost incurred for acquisition or amortization of cost incurred for acquisition of a loan. Ancillary cost antadu vadu. He'll be using the word like ancillary cost. Yes, for arrangement of a loan or amortization of ancillary cost. See here, commitment charges, amortization of discounts or premium, ancillary cost for arrangement of borrowings or amortization of ancillary cost, exchange difference which is linked to accounting standard number 11. And did you remember leases? In leases, lease rent will be separated into interest and principal. And that interest is nothing but borrowing cost. Clear, everybody? That interest is nothing but borrowing cost. And this concept is applicable only for finance lease. That finance lease charges is nothing but interest. Under assets which are acquired under finance lease, everything will be included in borrowing cost. But for solving the problem, on a simple note, borrowing cost is nothing but interest. Clear? Now, the next one, prepayment penalty. Prepayment penalty. If you would like to repay the loan immediately before the expiry of the time period, say banker had told 10 years time period. 10 years. 10 years is the loan time period, but you have decided to pay within 3 years itself. Who is losing interest? And hence banker will be charging some extra penalty. That penalty is nothing but prepayment penalty. Now next question, is prepayment penalty a borrowing cost or not a borrowing cost? It's not a borrowing cost. Cost incurred for acquisition of borrowings is borrowing cost, not cost incurred with settlement of borrowings. Logic clear? Prepayment penalty is incurred for settlement or acquisition. Settlement. So it is not a part of borrowing cost. So simply to tell you, borrowing cost includes interest, commitment charges, discount on issue of debentures or loss on issue of debentures. Clear everybody? And to the extent of exchange differences, which are dealt as per AS 11. Inka? Yeah, ancillary costs. Clear everybody? All these things will be included in borrowing cost. Now the next problem, qualifying asset. Sir, an asset which takes substantial period of time either for usage or for sale. Sale is nothing but inventory. Usage is nothing but tangible asset or intangible asset. The word sale is used for the purpose of inventory. The word usage is used for the purpose of tangible asset and intangible asset. So qualifying asset is the asset which takes substantial period of time either for usage or for sale. Clear? So now borrowing cost has to be capitalized only for qualifying assets, and borrowing cost has to be charged for those assets which are not satisfying qualifying asset. And what do you mean by substantial period of time, sir? More than or equal to 12 months. But in majority of the cases, even it can be less than 12 months also. So decided by the management through professional judgment. Understood everybody? So even 3 months can be considered as substantial period. 4 months can be considered as substantial period. But in general, 12 months. Even less than 12 months is also considered as a substantial period. Understood? Next one. 3 things are there. Commencement of borrowing cost, cessation of borrowing cost, suspension of borrowing cost. What do you mean by commencement of borrowing cost, sir? Very simple. When can you start capitalizing? Point number 1. Asset should satisfy the definition of qualifying asset. Point number 2. There should be a loan. There should be a borrowing cost. Point number 3. There should be a qualifying asset. 3 things. Loan should be there. Borrowing cost should be there. Qualifying asset should be there. Very important. Qualifying asset activities must be work in progress. Those activities might be either physical activities or even administration or technical work also. Clear everybody? Listen, you have purchased the land. You are having you have purchased the land for 50 lakhs. You have borrowed some amount for the same. Monthly you are paying an interest of 6 lakhs. Yearly you are paying an interest of 6 lakhs. Your intention is to construct a building on the same. Question number 1. Is there loan or not? Chapali. Is there borrowing cost or not? Is there a qualifying asset or not? Yes, building is a qualifying asset. Or the activities work in progress? Or the activities work in progress? No, I did not tell anything. We are having an intention to construct the building. But still the activities are not yet started. And hence in this case, this has to be charged. We are having intention. So we are trying for approval. We are trying for approval to get from the municipal department. Are the activities started or not? Yes. Activities ante not physical activities only. Even trying for approvals, technical aspects, administration aspects, also called as activities. In such a case, this has to be capitalized. Is the logic clear? That's all. Commencement of borrowing cost. Okay. There are teachers who is telling it in another way also. But whatever I told is absolutely correct. Even administration activities, technical activities are also treated as activities which are work in progress, and hence borrowing cost has to be capitalized. Shall I proceed further? And the next one, cessation of borrowing cost. Very simple. When can you stop? When the qualifying asset is ready for use or ready for sale. Amma, not actual usage or not actual selling. Your actual point is not needed for me at all. Ready to use, ready to sell. In such a case, you can stop. If qualifying asset can be completed in parts, likewise building, construction of 4 floors. 1 floor is absolutely completed and ready to use. 3 floors are still under construction. So to the extent of 1 floor, since the floor is ready to use, you can cessate the borrowing cost and you can charge the same to P&L account. But proportionate borrowing cost relating to 3 floors, since it is under construction, you have to continue capitalization. Clear? You are paying 10 lakhs borrowing cost for 4 floors. Since 1 floor is ready, 10 lakhs into 1 by 4, 2.5 lakhs can be charged to P&L account. Remaining 7.5 lakh, continue capitalization, add it to building. Respond pakka. Next one, suspension. When can you suspend? Suspend is nothing but temporary cessation. Suspension of capitalization of borrowing cost. If the qualifying asset activities are stopped, if the qualifying asset activities are stopped, then check out why they have stopped. Is the stoppage really necessary for further course of production? Is the stoppage really not needed for further course of action? Likewise, construction of a slab. After, what is it called? After slab was laid down, at least for 21 days, you have to stop the work. You can't do the work at all. That stoppage is very much needed for further construction of a building. And hence, it has to be continue for capitalization. You are preparing some hybrid seeds. You have to wait for the germination of hybrid seeds for a respective period. Something like, hope you know that originally apple can be cultivated only at Kashmir. But nowadays apple can be cultivated anywhere, because they have manufactured some hybrid seeds. They will be providing some specific sort of environment conditions and they will be checking whether the seed is germinating or not. How much capacity will be there to that seed. So that alone may take up to 3 to 4 months. So is it a qualifying asset or not? Yes or no? Yeah, generally 12 months, but even less than 12 months is qualifying asset. So even 4 months, yes, it is a qualifying asset. During the process of germination, you can't do the work at all. It should germinate automatically. And the process of germination, you can't do anything. So that stoppage is really necessary for further course of action, and hence you have to continue capitalization. Clear, everybody? Something like you are constructing a bridge. All of a sudden rain had come. Water levels increased. You have to stop that work. You can't tell, no, I will continue the work. Then bridge will fall like anything. Clear, everybody? So that stoppage is very much needed for further course of action, and hence continue capitalization. COVID-19. Because of COVID-19, you have stopped the work. But is that stoppage of work is needed for further construction? No. Yes, it has to be stopped because of to break the chain link of COVID-19, not to break the construction activity. And hence activities of work in progress or activities of qualifying asset are not work in progress, and hence they have to be charged. Understood everybody? That is what your temporary cessation, suspension. If at all the stoppage of work is very much needed for further course of action, continue capitalization. Stoppage of work is not needed for further action, you have to suspend and charge it to P&L account. Understood everybody? Now take care. If you observe in CRD number 5, the period will be less than or equal to 12 months. Here he will be telling that it is a qualifying asset and you can capitalize only up to that period. Until only up to 9 months or something like that. But if you have seen the concept question which was given here, concept question number 2, he will be telling something like, if it is taking less than 12 months, can you classify it as a capitalization? I mean, qualifying asset. For this one, he is telling the answer is no. Now what to write in the exam? Remember, you just read the question properly. If he is clearly asking, it is less than 12 months. It is less than 12 months and hence can you capitalize? Now your solution should be substantial period is generally 12 months. Since it is less than 12 months, don't capitalize. Charge it to P&L account. Provided if the management so decides that 11 months is a substantial period and then start capitalization only up to 11 months. Right, like this. If the question is asking how much amount has to be capitalized, compute up to 11 months and put the capitalization amount. Hope you have got the difference between questioning pattern. If the question is asking like this, although it has taken less than 12 months, can you capitalize? Answer, no, because substantial period is generally 12 months. If the question is like, how much amount has to be capitalized in these situations? Then write directly, 11 months interest has to be capitalized. Did you understand? Check out how the questioning pattern is and you decide like that. And what is most important in accounting standard number 16 in the sense, these kind of models are actually very important. He'll be giving the total interest. And out of total interest, some part will be used for qualifying asset. Some parts will not be used for qualifying asset. You have to separate by proportion. And some portion has to be capitalized. Some portion has to be charged. So that bifurcation is very much needed. So take care. This is actually an important model. And next one. If there is any temporary income, you have taken borrowings. Your interest is 9 lakh. But there are some idle funds. So you have invested in fixed deposit for 6 months. You have got an income of 1 lakh. So from this borrowing cost 9 lakhs, deduct this 1 lakh and net borrowing cost 8 lakhs will be considered for the purpose of your problems. Temporary income from idle funds has to be deducted from the borrowing cost. Remember that one. And next model of problems which are very important is this one, Amma. Hope you have remembered this one. Take care, listen carefully how to do. I'll tell you in a simple steps. Just follow those. Step number 1. For all such kind of problems, first of all, you have to find the rate of interest. Check out specific borrowings, general borrowings. If it is specific borrowings, rate of interest will be given. If it is general borrowings, you have to find weighted average rate of borrowings. Weighted average rate of borrowings is nothing but total borrowing cost divided by total borrowings multiplied by 100. Clear everybody? You will be getting a weighted average rate of borrowing. Next, step number 2. Average expenditure on qualifying asset. I'll tell you one simple thing. Check out this question. You have indulged in a construction. You got a 2 lakhs special loan at an interest of 8%. Okay. And you're having some other non-specific loans like 4 lakhs, 5 lakhs, 3 lakhs. 9 plus 3, something like 12 lakhs. And here you are having 2 lakhs loan. So 12 plus 2, totally 14 lakhs loan is available to you. Now check out how much expenditure on construction. 3 plus 2.4 plus 4 plus 3.6. నన్ను చూస్తే రాదు, కౌంట్ చేసి చెప్పండి ఎంతో. How much is that, Amma? 13 lakhs. Your total available amount is 14 lakhs. Your total construction value is 13 lakhs. So not a big problem. Point number 1. Point number 2. In one of the examinations, he had given the construction is actually more amount. Construction is 20 lakhs, but available amount is only 14 lakhs. Clear? In such a case, you have to do on a proportionate basis. Because the same 14 lakhs is used for this construction, say building 1, and also building 2, another 25 lakhs. Building 1 how much? 20 lakhs. Building 2 how much? 25 lakhs. He did not mention in the question for which purpose of building this 14 lakhs is used. Question ardhamautunda? Building 1 20 lakhs, building 2 25 lakhs. Total funds needed are 45 lakhs, but available are 14 lakhs. Is 14 lakhs used for building 1 or building 2? Not provided in the question. So take it on a proportionate basis. 14 lakhs into 20 by 45, 14 lakhs into 25 by 45. This is step number 1. Clear? You have to check out that very carefully. And now, okay, ultimately, for this 3 lakhs, which amount I have used? Is this 3 lakhs includes this 2 lakhs, this 4 lakhs, this 5 lakhs, this 3 lakhs? Hope you have got the logic. Total amount available, 14 lakhs in my hand. First, I have to take 3 lakhs. Hey, out of the loan funds available, you take 3 lakhs, abba. What is the rate of interest? You don't know. If you know, it is very, very simple. 3 lakhs into rate of interest into 1st April kada, very, very happy, into 12 by 12. Next one, 2,40,000, 4 lakhs, 3.6 lakhs into rate of interest into, check out the dates. This is 31st May, ante enni months amma? 10 na? Ante kada? April, May, gone. August 8 by 12, December 3 by 12. So I'm very happy to write like 10 by 12, 8 by 12, 3 by 12. But problem, you don't know this interest rate. So what shall we do? Cancel this interest rate and do only this one. 3 lakhs into 12 by 12, 2.4 into 12 by 12, 4 lakhs into 8 by 12, 3.6 into 3 by 12. This is called as average expenditure on qualifying asset. And after getting that average expenditure on qualifying asset, step number 3, separate this. Specific loan, general loan. Specific loan is 2 lakhs at the rate 8%. Balancing figure you will get kada, that will be treated as general loan multiplied by weighted average rate of borrowings. Understood? This amount has to be capitalized. Logic clear? If you know the rates of interest, it is actually very, very easy. Since you don't know the rate of interest, this much process you have to do. Step number 1, find the rates of interest. General specific loan, weighted average rate of borrowings for general loan. Step number 2, average expenditure on qualifying asset. Delete the rate of interest and find the number of months. Out of the total figure, you separate into specific loan, general loan. Specific loan will be given in the question. General loan, balancing figure multiplied by weighted average rate of borrowings. The total amount has to be capitalized. Clear? In the meantime, you have to be careful with the question whether available funds are enough for the constructions or not. If not, you have to take on a proportionate basis. Understood? This is this model. And next, yeah, I told you one of the examination problems anna kada. This is the same. Check out. Available amount is 15, 30, 18. 30, 30, 63. Check out. 70, 22, 90, 43. How much? How much? 225 lakhs. You need 225 lakhs, but for this 225 lakhs, you have utilized only 63 lakhs. So first of all, you have to proportionately do. And rest of the process is quite common. See here, May 23, 5 marks. Only a 5 marks question, but includes actually lots of procedure to solve it. Yes, it includes lots of procedure. And the next model is all about, I told you, like accounting standard number 11, which is linked with accounting standard number 16. What is this one? Check out very, very carefully. Step number 1. Again, I'll tell this in 3 steps, which is very easy actually. Find the borrowing cost in India. If you have taken loan in India, how much? Dollar something multiplied by spot rate you have to take multiplied by rate of interest. Step number 2. Borrowing cost in foreign country. Ante it has to be done only with dollars multiplied by rate of interest multiplied by closing rate. Say if you have borrowed $10,000. At the time of borrowing, currency rate in India is 30. So $10,000 into 30 into Indian interest rate 14%. Clear? And next one, borrowing cost of foreign currency. Borrowed $10,000 multiplied by rate of interest. You have to pay the interest at the end of the year kada. So you have to use the closing rate here. Okay, logic clear? Now step number 3. Finding the borrowing cost. Listen very, very carefully. This is the important point actually. Sir, this entire concept is applicable only when foreign exchange loss is there, not when foreign exchange gain. This entire concept is applicable only when foreign exchange loss is there. And also this concept is applicable only when borrowing currency in India is greater than borrowing currency in foreign currency borrowings. Say if borrowing currency in India is 1 lakh. Ante step number 1. Borrowing currency in foreign currency is only 80,000. Clear everybody? Step number 3. What you have to do, sir? Find the foreign exchange loss. Sir, if gain is there, what to do? Nothing. If gain is there, this concept is not at all applicable. This concept is applicable only when foreign exchange loss is there. Foreign exchange loss is equal to dollar loan amount multiplied by closing rate minus spot rate. Say this comes to 45,000. Make this 45,000 into 2 parts. Sir, remember 2 things. This concept is applicable only when foreign exchange loss is there, when borrowing currency in India is greater than borrowing currency in foreign exchange borrowings. Clear? Now borrowing currency in India is 1 lakh. His actual borrowings are 80,000. How much difference is there? You pick that 20,000 from foreign exchange loss and treat that portion as interest, borrowing cost. Balancing figure, how much is there? 25,000. Simply charge it to P&L account. Ante. Simply charge it to P&L account. No more discussion at all. Sir, say for example, my foreign exchange loss is only 15,000. Now what to do? You need still an amount of 20,000. But available loss is only? What to do? Only 15,000 will be treated as borrowing cost. Ante. Clear? No, this has to be treated as borrowing cost as per AS 16. Ante, if it is qualifying asset, it will be capitalized. If the asset is not a qualifying asset, it will be charged. This has to be treated as per AS 11. Ante simply charging it to P&L account as foreign exchange loss. Clear? Pakka. To tell you in a simplest way, step number 1, find the borrowing cost in India. Step number 2, find the borrowing cost in foreign currency. Step number 3, foreign exchange loss. Here, step 1 minus step 2, and a borrowing cost in India minus borrowing cost in foreign currency. If it is negative, this concept is not applicable. If this is foreign exchange gain, this concept is not applicable. Because first India kada, Indian borrowings should be more. You are getting a negative figure in the sense Indian borrowings is less. Then this concept is not applicable. If any balancing figure, this has to be treated as per AS level. And if any positive figure is there, this has to be treated as borrowing cost as per AS 16. Yeah, thought of like completing borrowing cost within half an hour or 20 minutes, but it around took 45 minutes. Anyways, that is the end of your borrowing cost. Understood everybody? Just get ready. I'm going to start accounting standard number 18. Related party transactions. And one more thing, AS 20, I'll postpone it for tomorrow. అంటే లాస్ట్లో ఒకవేళ అవ్వకపోతే అట్లీస్ట్ అందులో మీకు ఎక్కువ వచ్చే డౌట్స్ ఏంటంటే రైట్స్ ఇష్యూ ఒకటి, బోనస్ ఇష్యూ ఒకటి, అవి రెండు చెప్పైనా క్లోజ్ చేస్తాం. AS 20 ఈరోజు ఖచ్చితంగా అవ్వదు. ఇట్ ఈస్ అపరెంట్ దట్ ఇట్ విల్ నాట్ కంప్లీట్. సో ఐల్ పోస్ట్పోన్ ఇట్ ఫర్ టుమారో. అందులో మీకు వచ్చే డౌట్స్ ఎక్కువ ఏంటంటే ఫస్ట్ ప్రాబ్లం రైట్సే, బోనస్ కూడా కాదు. ఫస్ట్ రైట్స్. ఐల్ టెల్ యూ రైట్స్ ప్రాబ్లం అండ్ ఐల్ క్లోజ్ ద థింగ్. యా, ఇఫ్ నీడెడ్ డైల్యూటెడ్ EPS డిబెంచర్స్ వచ్చినప్పుడు ఎలా చేయాలి, దట్ వాస్ జస్ట్ ఏ కాంప్యూటేషన్ యాక్చువల్లీ. ఐల్ టెల్ అట్లీస్ట్ దోస్ 3 things and I'll close the issue for AS 20. And just get ready, we are going to start AS 18. Sorry, let me go with accounting standard number 18. Sir, nothing great, it will be completed within 15 minutes hardly 15 minutes, not more than that. Coming to related party, take care, control, significant influence, key managerial personnel and relative. And last and final, you will be having one more relationship also. Take care, first one, holding and subsidiary. I'm not going with the technical terminology because it will take so much of time. I'll simply tell you, remember carefully, A, B, C, D, E are there. Everything is like holding and subsidiary. If you want me to tell the relations, for B, A is the holding company. For C, A is the holding company. For A, B and C are subsidiaries. For D and E, C is the holding. For C, D and E are subsidiaries. Very important. Sir, is there any relation between B and C? Is there any relationship between B and D? Is there any relationship between B and E? Yes, there is a relation. And all the relations are nothing but fellow subsidiaries. Fellow subsidiaries are those subsidiaries which are in common control with the holding company. B is controlled by A. C is controlled by A. So B and C are related. They are called as fellow subsidiaries. Sir, D is controlled by C and ultimately controlled by A. B is ultimately controlled by A. Indirectly D is controlled by A. B is also controlled by A. So they are called as fellow subsidiaries. Clear? Holding company, subsidiary company. Holding company, subsidiary company. Holding company, subsidiary companies. This subsidiary is controlled by this holding and this holding is controlled by this holding, and ultimately this subsidiary is controlled by original holding company. Common control are also relation, and the relation is nothing but fellow subsidiaries. Understood? Say for example, L, M, N, O, P, Q are there. Or Q and M relations or not? Yes, and the relation is nothing but fellow subsidiary, because M is controlled by, Q is controlled by, Pakka. That's it. Conclusion. If a group is having, sir, koncham fast chapta, try to listen. If a group is having only holding and subsidiary companies, each and every company is relative to other company. If a group is having only holding and subsidiary, every company is relative to other company, which can be either holding or subsidiary or fellow subsidiary. Pakka? Now, next one, associate. To become holding, the rating should be, voting power should be more than 50%, or controlling the composition of board of directors. Holding voting power should be more than 50%, or holding company should control board of directors of subsidiary company. Now very important, control, special condition, more than 20% plus power to direct subsidiary companies operating and financial policies. Even this is also control. Take care, more than 20%. Now very important, listen, more than 20% plus power to direct, more than 20% plus power to participate or power to influence. This is called as significant influence. This is called as control. This is the relationship between holding and subsidiary. This is the relationship between investing party and associate. Two things are more than 20 only, but control, power to direct, but under here power to participate. Just it can participate and influence, but it can't control. Clear? Very important thing. More than 20% and no influence. Prove that there is no influence. Less than 20% and telling that I am having influence. Prove how you are having influence. Sir, more than 20%, but another shareholder is holding 60%. He is controlling, sir. Who is holding 60% and controlling the company, and you are already holding 20%, remaining is only 20%. Even though you influence that 20%, your share will become only 40%. What can you do now? Can you do anything? Arthamainda? I am holding 20%. Sir is holding 60%. All you people are holding 20%. I am influencing all you people. And you people had voted in favor of me. But our share is only 40%. Sir, single vote, no. Holding how much percent? Entire thing is changed. If he is controlling, I am unable to influence you. Clear? And another case, less than 20% and telling that there is a significant influence. You are actually holding only 18%. None of the other shareholder is having at least 5%. Highest shareholding after me is only 1.2%. Can you influence that or not? Yes or no? Because you are holding highest shareholding and other than you, he is just 1.8% highest. So you can happily influence. Now the next one. Investing party A Limited is having 20% in K Limited and 30% in T Limited. Clear? Are these two things relatives or not? No. Co-associates are not relatives. If it is joint venture, these people are called as co-venturers. Even co-venturers are not relatives. Understood everybody? Listen very carefully. A is controlling B, B is controlling C. Or A and C relatives or not? Cheppali. A is influencing B, B is influencing C. 20%, 30%. Relatives or not relatives? No, they are not relatives. A is having 80%, B is having 30%. A and C. Cheppali. Relatives. Hey, now listen. A is having 30%, B is having 80%. A and C. Not relatives. Because initially A is not having control at all. A can just influence B, but B can control C. Can A influence C? Trash. It's not possible because B will not do whatever A tells. B is an independent party. Respond clear. So this is what your initial part of holding and subsidiary, investment party and associates, joint venture and venturers. And the next one. Individuals along with their relatives. Who are relatives, sir? for an individual, father, mother, brother, sister, spouse, son and daughter. Clear everybody? Yes, strictly to tell you, the small family is nothing but relative. It will not be like your law and income tax, like father or stepfather. I mean, something nonsense you will be having. I did not exactly remember, but all such concept is not there here. Individual, spouse, mother, father, son, daughter, brother, sister. There ends the matter. Respond clear. Now, an individual along with his relatives, if he can control or significant influence, then automatically these people will become relatives to that entity. Understood? Next one. Key managerial personnel and their relatives are always relatives to the business entity. Because key managerial persons are those persons who are having authority and responsibility towards planning, directing, controlling. Is it clear? Key managerial persons are the persons, sir, all these things should satisfy. Authority, responsibility towards planning, directing, controlling. If all these things are satisfied, only then we can tell that they are KMP. Otherwise, they are not KMP. KMP are always relatives to the entity, and relatives of the KMP are also relatives to the entity. Individuals along with their relatives who are holding either control or significant influence are also relatives. Now listen, the last and final one. A loop is created here. Very carefully. Individuals or KMP or even their relatives, okay, are having significant influence or control in an entity. And they are also having significant influence or control in some other entity. And these two entities are also relatives. Loop created. Mr. A is having 80% in A Limited and he is a KMP in B Limited. Now A and B are also relatives. Because of A can control A Limited with 80%. A can control B Limited with KMP and he can put transactions between these two parties. Clear? And hence these two parties are obviously relatives. Understood everybody? And now next one. A Limited is having 80% in B Limited. I mean Mr. A is having 80% in B Limited. Mrs. A, who is Mr. A's wife, is running a sole proprietor business. Take care. This sole proprietor business and B Limited are also relatives. Because Mrs. A and Mr. A are relatives. Respond clear. So this is the loop created in the last one. And he will be relating the entities and matter. Enterprise over which any person described in C or D ante individuals key managerial personnel is able to exercise significant influence. This includes enterprises owned by directors or major shareholders of the reporting enterprise and enterprises having a member of KMP in common with the reporting enterprise. Ante one is this kind of example. In one thing he is KMP, in another company he is having 80% share. And another example is like Mr. A is KMP in both the companies. A Limited or B Limited. Even these two companies are relatives. Clear? A Mr. A is normal director in A Limited. Mr. A is KMP in B Limited. A and B relatives are not relatives. అర్థం కాలేదా? A Mr. A is KMP in both the companies. Both the companies relatives. Now Mr. A is a normal director in one company, KMP in another company. Relatives or not relatives? Not relatives. Understood? Take more care. Loop created. Simply you can understand individual or KMP along with the relatives having influence or control on one enterprise and having influence or control on another enterprise. These two things are also relatives. Next. Following are not deemed to be related parties. Two companies with a common director. Say A Limited is having Mr. A is the director and also Mr. A is the director for B Limited. A and B relatives or not relatives? Not relatives. Provided if he is KMP in both the companies. Cheppali. They are related parties. Understood? Okay. Next one. Take care. A single customer, single supplier, single franchisor, single distributor. They are not relatives. Single person cannot influence the entire company. Single customer hardly can influence the selling price. Single supplier hardly can influence the purchase price. Can the supplier tell, hey, you don't sell to that debtor, sell only to this debtor, only then I will supply goods to you? You are not supposed to order me. Since you are the single supplier, I am dependent on you. If you want, you control the purchase price, increase the price. I'll bow my head for you. But who are you to order my manufacturing process? Who are you to order my selling pattern? Who are you to order my selling price? Hope you have got the logic. And other parties like providers of finance, lenders can't control me. They are not relatives. Trade unions, workers unions or trade unions, they are not relatives. Public utilities like municipalities providing water facility to me. It is providing roads facility to me. It doesn't mean that they can control me. And government departments, those who are sponsoring for us, like government grants. Hey, can government control me after giving the grant for the entire business? It can control only to that extent which is relating to the grant. It can't control my entire business. Clear? And hence these are not deemed to be related parties. Now one more thing, there is exclusion also. Sorry, listen. Exclusions. I'm sorry. Not deemed to be related parties completed. Applicability completed. Next, non-applicability. Listen very, very carefully. Simple thing. Sir, even though you people are related parties, no need to disclose related party transactions. No need to disclose related party transactions. Hey, applicability. For these 5 entities, AS 18 is applicable. Disclose the related party transactions. Not deemed to be related parties. You all general public, don't confuse. The following are not your related parties at all. Now, even though they are related parties, AS 18 will not deal with it. No disclosure is required for the following things. Who are those, sir? Transactions between state-controlled enterprises. Transactions between state-controlled enterprises. State-controlled enterprises are nothing but government companies. So actually, to tell you, government companies work for many secrets. They can't leak all the secrets at all. They can't issue everything to the public. So transactions between state-controlled enterprises are not needed to be disclosed. Very important. With respect to mutual owings in CFS. Hey, for SFS, it is a related party transaction. Listen, holding company sold goods to subsidiary company. Is it a related party transaction or not? It is a related party transaction for holding company and subsidiary company in standalone financial statements. But the same is not a related party transaction in CFS. Because you will be preparing CFS for both holding and subsidiary as if it is a single company. Understood? And the last and final thing, if it is a matter where to maintain confidentiality. It's a matter where it is required to maintain confidentiality, which is arising through contracts or which is arising through law. Clear? And which is arising among the government entities. For all these things, no need to disclose. Clear, everybody? Something like contracts. your company and the other company are indulging in a very secret manner, very secret transaction, which was actually a project relating to the government. So it's a matter to maintain confidentiality. So you're not supposed to disclose. And already government related matters discussed. Now very important, law or statutes. Listen very carefully. Mr. A is the KMP of SBI, State Bank of India. Is Mr. A relative to SBI or not? Cheppali. Sir, yes, Mr. A is absolutely a relative to SBI, we'll admit. So how much salary is paid to Mr. A? SBI needs to disclose. But how much bank balance Mr. A is having? It is his personal point. So strictly speaking, Mr. A is depositing into his bank account. Is it a transaction with SBI or not? But no need to disclose because it is his personal. As per Banking Regulation Act. In the same way as per Insurance Act, Mr. A is a KMP in an insurance company. He is having 100 policies in that company. Is it required to disclose all the policies? All such kind of things should not be done. Clear everybody? Anyways, that is what your non-applicability. Last and final. Disclosures. Last and final, disclosures. Listen carefully, Amma. Coming to disclosures. Point number 1. If control exists, even though there is no transaction, you have to disclose name of the related party, nature of the relationship. Ante subsidiary, fellow subsidiary, and what is the name of the related party like A Limited or B Limited. Even though there is no transaction. For other than control, if there is no transaction, no need to disclose. For control, even though no transaction, you have to disclose name of the related party and nature of the relationship. For other than control, if no transaction, no need to disclose at all. Respond clear. And coming to the next one, listen very, very carefully. Yes. If transaction exists, you are supposed to disclose the following. Whether it is control or other than control, whatever it is. If transaction is there, you have to disclose. Number 1. What is the name of the related party? Nature of the relationship, nature of the transaction, effect on financial statements like quantification of effect. How much amount is for the transaction? As on the date of transaction, at the end of the year also. Hey, is it clear? Name of the related party, nature of the relationship, nature of the transaction, effect on financial statements. That is amount of the transaction. As on the date of transaction, how much? Year end balance, how much? If you are having doubt on that related party, you have to create a provision. And you have to disclose even that provision also. And if any provision is reversed, even you have to disclose that reversal of provision also. Respond everybody clear. So all these things must be disclosed if transaction is there. Last and final, grouping and clubbing. If transactions are of similar in nature and transactions are large and voluminous in nature, more transactions are there, more similar nature are there. Immediately you can group and you can club all the transactions and you can disclose. Sale of goods, 100 times you have done from subsidiary company. Hey, no need to disclose for 100 times. All the 100 times sales can be clubbed and you can show the gross figure. Respond everybody pakka. And that is the end of accounting standard number 18. So fine, let us start accounting standard number 17. What is A17, Amma? Segment reporting. A17 is nothing but segment reporting. Segment is a division of the enterprise. Segment is a division of the enterprise. So very important thing that you should remember is all about what is segment expense, what is segment income, what is segment asset and what is segment liability. More or less everything is one and the same. More or less everything is one and the same, which includes operating items, assets used for operating purpose, or liabilities arising in operating purpose, or operating expenses and operating incomes, which includes only operating items. Okay, which might be either direct or allocable or intersegment. Direct revenue, allocable revenue, intersegment revenue. Direct expense, allocable expense, intersegment expense. Direct asset, allocable asset, intersegment asset. Direct liability, allocable liability, intersegment liability. What do you mean by direct? Directly from the outsiders. Allocable in the sense the expense or the income is directly relating to the head office. Head office is allocating to the same. Head office is allocating to the segments. And the last and final one, intersegment. One segment to another segment is nothing but intersegment. My dear children, this point is very important. Remember, head office cost reallocated. Head office expense reallocated. You are having in one of the problems also. Head office income reallocated. Reallocated will not become a part of segment item. Reallocation is different from allocation. Only allocable items will become a part of segment items. Reallocation will not become a part of segment items. Remember. Clear? So dash will become a part of segment items. Allocable items. Dash will not become a part of segment items. Reallocable items. Because reallocation in the sense, once again they are allocating the same. You want to allocate, head office needs to allocate directly to the segments. It's not like once again allocation is not considered. Respond everybody, clear? Next, very important thing, it excludes. All the financing items will be excluded. All the investing items will be included. Only ordinary will be included. And hence automatically extraordinary will be excluded. And tax items will be excluded. Yes, tax items. Tax expense, tax income, tax assets, tax liabilities, everything. All the tax items will be excluded. Extraordinary, tax, financing, investing, excluded. And included, operating, ordinary. It will be generally direct, allocable and intersegment. Respond clear? So this is what your segment items are. And very, very important, it is not possible to report all the segments. So reportable segments. The next thing is all about reportable segments. Test number 1, segment revenue test. Segment revenue should be greater than or equal to 10% of total segment revenue. Test 2, segment assets test. Segment assets should be greater than or equal to 10% of total segment assets. Test 3, segment result test. Segment result should be greater than or equal to 10% of total segment result. Then what do you mean by total segment result, sir? Take care, total segment result means total segment profits or total segment losses, whichever is higher. You can't take the net. You can't take the net. Say A, B, C, D, E are there. A 100, B 200, C 200, B 20 loss, D 25 loss, E 5 loss. What is the total segment result? You can't take like 100 minus 20 plus 200 minus 25 minus 5. That's wrong. Total segment profits, that is 300. Total segment losses, 20 plus 30, 50. Whichever is higher, under 30. Now 300. Now directly 300 into 10%, which comes to 30, 30, 30, 30, 30. Clear? So you're supposed to disclose all those things, which are actually more than 30. Say A, disclose. B, less than 30 kada, no need. C, disclose. D, I have modified. D is 30. Loss. Disclose or don't disclose? Disclose. Don't think that, sir, here we have taken only profits kada. only profits are considered. No, nothing like that. At the end of the day, this is just a number. And this is also just a number. Understood? So segment result test is nothing but segment result is greater than or equal to 10% of total segment result, and total segment result is nothing but total segment profits or total segment losses, whichever is higher. Respond clear. This is what test number 3. Now test number 4, management discretion. It's their wish. If they want, they will disclose, otherwise they will ignore. If they want, they will disclose, otherwise they will ignore. That is nothing but test number 4, which is management discretion, their wish. Last and final, okay? Take care, okay? Test number 5, overall revenue test. Strictly speaking, overall external revenue test. Overall external revenue test. What is this one, sir? Take all the reportable segments external revenue. External revenue. External revenue ante direct revenue, allocable revenue, inter-segment revenue. Direct revenue will be considered. Clear? All the external revenue of all the reportable segments up to test 1, test 2, test 3 and test 4. From the above 4 tests, some tests are reported. Check out the external revenue of reportable segments from all the 4 tests, which should be greater than or equal to 75% of total enterprise revenue. Enterprise revenue is nothing but again external revenue. Clear? Take more care, take more care. Test number 1, test number 2, test number 3, test number 4. There are some reportable segments. All these reportable segments, external revenue should be considered. And if the external revenue of the reportable segments is more than or equal to 75% of total enterprise or external revenue, the test is satisfied. If the external revenue of the reportable segment is less than 75%, immediately add some other segments so as that the total enterprise, total reportable segments external revenue should be more than 75%. Say you are having 10 segments, out of which segment 1, segment 4, segment 6, segment 7, segment 8, segment 10 are reportable segments. These 6 segments are reportable segments. Take the external revenue of these 6 segments, which comes to 600. Clear? And check out the total 10 segments external revenue. So total 10 segments external revenue is 1000. Reportable segments external revenue is only 600. But you want a minimum of 75%, ante 750. But how much is reported? So you want to report how much amount? Still shortage, how much is there? For this 150 external revenue, add some more segments. Say you have added segment 3, which is having an external revenue of 200. Now it had become 600 plus 200, totally 800, and the condition is satisfied. Logic clear? Now last and final. You are supposed to disclose, report the segments current year, test 1, test 2, test 3, test 4 and test 5. Current year, all the 5 test segments must be reported, plus last year test 1, test 2 and test 3 also. Is it clear? Not only current year test 1, test 2, test 3, test 4, test 5, but also last year test 1, test 2, test 3 are also to be reported in the current year, even though they did not satisfy the reportable tests in the current year. A logic clear? Even though current year they are not satisfying, you are supposed to disclose, provided if they have satisfied in the last year, with respect to test 1, test 2, test 3. Respond, is it clear? This is reportable segments. Due to time constraint, I'm not speaking about disclosures relating to reportable segments, but remember only one thing, you have to disclose separately for primary segments and secondary segments. Primary segment is also called as dominant segment. Those segments risk and rewards are more dominant, it is considered as primary segments. All other will be considered as secondary segment. Strictly to tell you, as per accounting standard number 17, there are two segments: business segments, geographical segments. Geographical segments, location of assets; geographical segments, location of customers. If at all a business concern is having both the segments, indirectly 3 segments, then that business concern should choose what is primary segment to that. Primary segment, like risk and rewards of products is more dominant than risk and rewards of areas of operations, then this is primary. If risk and rewards of areas of operations is more dominant than product, then this is primary. Again in this, whether is this more dominant or location of customers more dominant, you need to check out and you need to come to one conclusion. Respond pakka. So if at all it is a primary segment, more dominant segment or primary segment, you have to disclose all. Segment asset, segment revenue, segment expense, segment result, segment liabilities, reconciliation statement also. If it is secondary segment, only the respective test has to be disclosed. Ante, if it is business segment, respective test is nothing but segment revenue and segment assets. Location of assets aithe segment assets. Location of customer aithe segment revenue. I am speaking about secondary segment. If my business segment is secondary segment, disclose segment revenue and segment assets. If my geographical segment, location of assets is secondary segment, segment asset. If this is secondary segment, segment revenue has to be disclosed. Again, while disclosing segment revenue, no need to disclose all, disclose only external revenue or direct revenue only, provided these respective tests had satisfied. If the respective test is satisfied, disclose, otherwise no need to disclose. If it is secondary segment, disclose segment revenue if respective test is satisfied. Disclose segment asset if respective test is satisfied. Otherwise don't disclose anything. Clear? You are having one of the problems, like a company is having a sales, something like 25% were affected in USA, 70% were affected in India, and 5% were affected in UK. Okay. Does this company needs to disclose the same if location of customers is a secondary segment? Clear with the question? Sir, USA, India and UK ante, is this geographical segment or not? Cheppali. You are having exports to these particular countries. Ante, is it location of customers or not? Location of asset ante, you need a branch there. Export ante, it is just a customer. Location of customer, if it is secondary segment, disclose segment revenue only if respective test is satisfied. Here how much percent is there? 5% of the total segment revenue. But to satisfy the test minimum, how much you should have? Since 5% not satisfied, no need to disclose UK sales separately. No need to report UK sales separately. Report only USA and India sales. That's one clear. Provided respective test has to be satisfied. And very important, here don't check for segment revenue test. Only external revenue test has to be checked out. Because again under segment revenue, you need to disclose only external revenue. Conclusion for disclosures, okay? Disclosures conclusion. If a business concern is having both business and geographical segment, it needs to choose what is a primary segment and what is a secondary segment. If one is primary, other two will become secondary. If one is primary, other two will become secondary. If one is primary, other two will become secondary. If it is a primary segment, you are supposed to disclose all. If it is a secondary segment, disclose the most important part. Segment revenue, segment assets in case of business, location of asset, segment asset, location of customer, segment revenue provided its respective test is satisfied. And to disclose segment assets test should satisfy. To disclose segment revenue, not total segment revenue test, external segment revenue test should be satisfied. If satisfied, disclose. Otherwise, don't disclose. Respond clear. That is the end of accounting standard number 17. And the next is accounting standard number 24. The hardest part is only the definition. Discontinuing operation is discontinuing through a single or overall formal plan. It must be discontinued through a single or overall formal plan. Don't think that if I have stopped the operation, it was discontinued operation. No. As per AS 24, if you stop an operation, it is not a discontinuing operation. It must be discontinued through a single or overall formal plan. And in that plan, you are actually having three things. Either disposing of substantially in its entirety, which can be again either through sale or demerger or spin off. Sale in the sense I'm selling my business to another person. Demerger in the sense that division was separated. So I'm having many divisions. Reliance Industries Limited is selling only petroleum division, or it is demerging the petroleum division. Did you get my point? Something like Reliance Industries Limited. Previously, whenever it is with Anil Ambani and Mukesh Ambani, RCOM was demerged. Reliance Communication was demerged to Mr. Anil Ambani, and the remaining Reliance Industries Limited is with Mr. Mukesh Ambani. Clear, everybody? Demerger. And the next one is like spin-off. Spin-off is nothing but transferring the ownership to shareholders. And the next, disposing of piecemeal. Piecemeal in the sense sale of assets and sale of liabilities individually. Part things to be sold out. And finally, terminating through abandonment. We are actually not having any intention to sell we are not selling it immediately, but we are having an intention to sell the same. Terminating the operation through abandoning the production. లేదా terminating the production through abandoning the operation. Production is stopped and also operation is stopped. Initially, we are not selling it immediately, but we are having intention to sell. Clear? Now, as per accounting standard number 24, operations are of two types. Either major line of business, ante business segment, or geographical areas of operations, which is geographical segment. What is segment as per AS 20? As per AS 17 is the operation as per AS 24. What is segment as per AS 17 is exactly same operation as per AS 24, but the nomenclature names is different. Very important. Take more care. Examples of the following which are not actually the discontinuing operations. Examples given as the following which are not discontinuing operation. Gradual phasing out of a product line or class of service. Slowly one product was shifted from one line to another line. Something like you are having a question which is very famous question actually. Cold cream, vanishing cream. First quarter production 4 lakhs, 4 lakhs. Next quarter 2 lakhs, 6 lakhs. Next quarter 0, 8 lakhs. And also the next question. the company had shifted from passenger vehicles to commercial vehicles production. And the plan is to shift to 20% gradually over the next 5 years. So gradual phasing of a product line or service. Slowly you are shifting from one product to another product. Hey, you're not selling anything, kada? Are you selling? No, it's not either selling its entirety or not either selling in its piecemeal or not either intention to sell. It's like shifting from one line to another line. And the assets and liabilities of one line is used for the other line of production. Cold cream stopped. Vanishing cream continued. Assets and liabilities of cold cream were now become assets and liabilities of vanishing cream. Logic clear? Next, discontinuing several products even if relatively abruptly. Abruptly and suddenly. Here slowly, gradual phasing out. Here abruptly, all of a sudden. Shifting of some production from one location to another location. You're not selling any location's business. That business was shifted from one place to another place. And finally, yes, you're closing. Yes, you're closing and you're selling also. But wantedly you're not selling. In order to get some cost savings and productivity, you would like to sell it. To get some cost savings. Say for example, you are having a question also. A company is having process 1, process 2, process 3. Process 1 output is introduced as process 2 input. Process 2 input is introduced as process 3 output, and you will get a finished good. Process 2 total cost is 100 rupees for one output. But if you outsource process 1 output, you will be getting the same for 20 rupees. So decided to close process B. And the assets and liabilities of process B were sold. Clear? Answer, is it a discontinuing operation? No. Because you have closed in order to achieve cost savings and productivity efficiency, but you are not selling it wantedly. Respond, is it clear? That is what your examples for not being a discontinuing operation. Clear? Let me ask you a question with this. AS24 is closed. Company has decided to move from location A to location B. Or company had shifted from product A to product B. Okay. But it had identified that all the assets of product A and location A are not at all needed for product B and location B. Okay. And hence decided to sell all the assets. And from that assets, it had also settled all the liabilities. Okay. Can this be treated as a discontinuing operation or not? Company has decided to shift from product A to product B. It is identified what are the assets needed. But bad luck, no asset is actually needed. And hence decided to sell all the assets. And since it has sold all the assets, decided to settle all the liabilities. Okay. Now, is it a discontinuing operation or not? No, it's not a discontinuing operation. Because it is having many other things to discontinue an operation. It is not retrenching the employees. The employees are shifted from location A to location B. Just assets and liabilities were sold and settled. Even if one asset is needed, it will pick and it will take the same. So you have to understand the ideology of the company. Ideology of the company is not to sell product A division. Shift from product A to product B. Since it needs more employees, it is taking from employees from product A. And sold all the assets and settled all the liabilities. But surplus cash is there. That surplus cash is taken for product B and location B only. Logic clear? So this is obviously like not a discontinuing operation, but apparently it is appeared that it's a discontinuing operation. If you got the same question in the exam, you'll actually confuse. But this is not a discontinuing operation. Anyways, clear everybody? Just hold on. Get ready. We are going to start. No, not AS20. Actually, time is running out. Either amalgamation or consolidation. That's your choice. What to start? అది ఒకటి ఇది ఒకటి ఖచ్చితంగా రెండు జరుగుతాయి, జరగకుండా ఉండవు. ఫస్ట్ ఏంటంటున్నా, కన్సాలిడేషన్. How many of you vote for consolidation? Amalgamation? Comparatively less. So let's start with consolidation. Hey, nothing great. After this one, we'll start with amalgamation. Ante. Initial disclosure event is very, very simple. You have to pick what is a date. From that date, you have to start disclosing for all the discontinuing operation, and which is nothing but date of binding sale agreement. Binding sale agreement is mandatory for disposing in its entirety. For piecemeal, binding sale agreement is not mandatory. For disposing in its entirety, binding sale agreement is mandatory. So, date of binding sale agreement or date of confirmation of negotiations, that is date of fixation of terms and conditions of the agreement, whichever is earlier. Date of confirmation of terms and conditions or date of binding sale agreement entered, whichever is earlier, is considered as initial disclosure event. What is the relevance of initial disclosure event, sir? From the point when initial disclosure event has occurred, you have to start disclosing about the discontinuing operations. If IDE falls in the next year, start disclosing only in the next year. You are having formal plan in the current year. Clear? But that was very, very important. But that was formulated, approved and announced. Even that is also to be considered. Let me tell you very clearly. Date of initial disclosure event is nothing but date of formulation, approval and announcement of detailed formal plan or date of binding sale agreement, which is nothing but fixation of terms and conditions, whichever is earlier has to be considered. Again the logic. Agreement entered today, signs done today, but terms and conditions done tomorrow. You have to take only today's date. Clear? Or terms and conditions fixed already, but originally you are signing on the next day. You have to consider today itself. Clear? Sir, understood? In these 2 days, whichever is earlier. For these 2 days, whichever is earlier. For these 3 days, whichever is later. Formulation, approval, announcement. 3 things should complete. So, date of formulation, approval and announcement of detailed formal plan or date of binding sale agreement, whichever is earlier. Now you might get a question. Formulation is done, approval is done, but announcement is not done. Can you take the date? అర్థం కాలేదా? Formulation is done, approval is done, but till announcement is not done. Say formulation is done on 1/1/2011, approval is done on 1/2/2011, announcement is done on 31/3/2011. Date of binding sale agreement, signatures were done on 1/2/2011, but terms and conditions were fixed on 31/2011. These many dates are there. Now what is the initial disclosure event? So now, yes, perfect answer. For this one, you have to consider whichever is later. I don't think whichever is later. Formulation should be done, approval should be done, announcement should be done. All the 3 things completed on 31st March. This one. Date of binding sale agreement and terms and conditions, whichever is earlier. ante 1 2. Now between these two things, whichever is earlier, 1 2. Logic clear? That's initial disclosure event. But in your exam, he don't confuse that much. He actually will give only one date in place of these two dates. Okay, he'll give only one date in place of these 2 days. Take care. So date of formulation, approval, announcement of detailed formal plan, or date of binding sale agreement, or date of terms and conditions, whichever is earlier has to be considered. That is the point where the disclosure has to be started. So as per this question 1 2 kada, so start disclosing from that financial year of 10-11. If IDE falls on 1/5/2011, which falls in the next year kada, start disclosing in the next year. No need to disclose in the current year. Clear? And the next one is all about consolidation. 3 parts of consolidation are there. Even though there are 3 parts, AS 23 and AS 27 are obviously like bacha only. He might test a question maximum from AS 21 itself. If he is testing from 23 and 27, hardly it will be something like a 5 marks question, or it might be either an MCQ. That's it. So let me start with accounting standard number 21, consolidation. Sir, biggest point, if you're listening this marathon, then you will be getting some differences between the classes you have learned and the method that I am teaching. Okay, so just get those differences carefully. And if you have listened this very carefully, you can comfortably follow in this style. Yes, if you have listened this carefully, you can happily follow under this style. It will be very easy also. So consolidation, I'm going to tell it in steps approach. So first part is all about consolidated balance sheet. Step number 1, you're going to get basic data. And under basic data, you're going to get 4 things: date of acquisition, date of consolidation, percentage of holding interest, percentage of minority interest. Sometimes holding interest will not be given directly. In such a case, you have to be very, very careful and you need to find the holding interest. Holding interest is nothing but number of shares acquired by holding company, whole divided by total number of shares of subsidiary company multiplied by 100. You're going to get percentage of holding interest. There is a problem in one problem. And that problem is bonus issue. In that case, if you have taken directly, you will be getting something like 37.5%. But holding interest should be more than 50%. So 37.5 is absolutely wrong. So what to do in such case, sir? Listen very, very carefully. That question has to be broken in these parts. You have to take care. Listen. Say he'll be giving a ratio called 5:3 ratio. Or say 3:5 ratio. For every 5 shares, 3 is the bonus. For every 5 shares, 3 is the bonus. Take like this. Original shares, bonus shares. Original plus bonus is equal to total. Original shares are 5. For every 5 shares, 3 is the bonus. And the total number of shares counts for 8. Now, listen very carefully. He will be giving in the question, holding had acquired 1000 shares on 1/1/2011. Subsidiary had declared and given bonus on somewhere on 1st March 2011. Subsidiary company's balance sheet is given on 31/3/2011. Is it clear? Holding company acquired on 1/1/2011. Subsidiary declared bonus on 1/3/2011. Subsidiary company balance sheet is on 31/3/2011. Clear? If you take subsidiary company, what is available? Subsidiary company shares are available on 31/3. Total bonus original? Total. Because given bonus on 1/3 kada, after 1/3 you will get 31/3, which is nothing but total number of shares. So subsidiary company's total will be kept here and this will become balancing figure. Total number of shares into 3/8. Total number of shares into 5/8. Balancing figure or computations will be giving you the subsidiary company. Hey, but take care, holding interest. Holding company is having how many shares? On which date? 1/1. Before bonus, after bonus? Before or after? Before ante original, bonus, total. So put here and find here. Compute 1000 into 3/5, 1000 into 8/5. Clear? So you will be getting holding things also. Finally, your holding interest is nothing but holding interest number of shares divided by subsidiary original shares into 100, or holding total shares divided by subsidiary total shares multiplied by 100. But previously you are doing 1000 divided by total shares into 100. You will get wrong percentage because there is no uniformity. There is no comparability. Is the logic clear? If you have done like this, it's going to become very easy. Very easy for sure. Take original shares, bonus shares and total shares. Holding, remember this one, if you want you can by heart also. Holding interest is always original. Subsidiary shares is always total. Clear everybody? That's it. Step number 1 is totally completed. Now moving on to step number 2. Heart of consolidation. If step number 2 had gone wrong, 3 will go wrong, 4 will go wrong, 5, 6, 7, 8, everything is wrong. What is step number 2, sir? Segregation or analysis of reserves and surplus. You will have to analyze each and every reserves and surplus of subsidiary company. But we are very lucky because in all our problems we will get only 2 reserves. General reserve, P&L account. But if you have gone to CA final, you will be getting many reserves. Capital reserve you will get, securities premium you will get, CRR you will get. Every reserve has to be separated between pre and post. But let me start now. First one. Say P&L account. Divide it into 2 parts. Number 1 is opening. Number 2 is current year. From opening checkout, sometimes he might be giving pre-acquisition dividend. Sir, what do you mean by dividend? Pre-acquisition and post-acquisition. Very simple. Pre-acquisition dividend is declared out of pre-acquisition profits. Post-acquisition dividend is declared out of post-acquisition profits. Pre-acquisition dividend, take care. Pre-acquisition dividend is declared out of pre-acquisition profits. Post-acquisition dividend is declared out of post-acquisition profits. What is the treatment for pre-acquisition profit? Pre-acquisition dividend, sir. Very, very simple. Pre-acquisition dividend with respect to subsidiary company has to be deducted from step number 2. Pre-acquisition dividend is given out of pre-acquisition profits. Pre-acquisition profits ante opening e kada. That's it. Post-acquisition dividend is declared out of post-acquisition profits. This is not there in any of the problem. If there, what is the treatment? Same, minus step number 2. But this time from current year. Current year post. Clear? Here pre in the sense that's obviously from opening. Clear with point number 1? Point number 2. Since we are dealing the marathon from the examination point of view, I'm not stressing on post, I'm stressing only on pre. Because in all our problems we are having only pre. Total dividend has to be deducted from opening balance of P&L account of which company? Subsidiary company. Now holding interest of the dividend will be there. Am I correct or wrong? Strictly speaking, it has to be deducted from step number 5. That is cost of investment. Clear? If you did not deduct it to cost of investment, and if you have treated as a post, and if you have added it to P&L account, take care. Pre-acquisition dividend, post-acquisition dividend. Pre-acquisition dividend, journal entry, cash or bank account debtor to investment account. Post should be cash or bank account debtor to P&L account. But pre is treated as post. Ante cash or bank to P&L return. In such a case, wrong kada, you have to rectify. What is the rectification journal entry? P&L account debtor to investment account. Ante holding company. All these treatments are given in the books of holding company. Holding company profits should decrease. Ante minus step number 7. Holding company value of investment should decrease. Ante minus step number 5. Minus profits of holding company minus investment, cost of investment. If it is post wrongly treated, it is exactly opposites, but that will not be dealt now. Because in all our problems, we are having pre. Conclusion. And the conclusion is that pre-acquisition dividend declared by subsidiary company has to be deducted from subsidiary company P&L account opening balance. Holding share or holding interest in such dividend has to be strictly deducted from step number 5. Cost of investment. If you have correctly done, no need to give the treatment again. But if you have wrongly done, this has to be deducted from step number 5. And also it has to be deducted from step number 7, which is holding company's profits. Clear? So this is what your pre-acquisition dividend accounting treatment. Remember. Anyways, clear everybody? A is pre-acquisition dividend treatment clear? Now immediately let us start. Take care. P&L account, subsidiary company profits. Take the which balance? Closing balance. Separate it into opening and current year. Opening balance, deduct pre-acquisition dividend. Total holding interest. Subsidiary company profits. Declared dividend. Total holding interest. Total pre-acquisition dividend declared by subsidiary company. Do subsidiary company declare only holding interest? No, it has to declare total dividend kada. Chappandamma. So you have to deduct total dividend from the opening profits. And then current year will become balancing figure. And then again this has to be separated into 2 parts. Clear? That is till the date of acquisition, after the date of acquisition. Till the date of acquisition it is pre. After the date of acquisition it is post. Even the net here is nothing but pre. Clear? So this total profits are nothing but pre. And this is nothing but post. Pre name is nothing but capital profit. Post P&L account kada. Post P&L kada. It is called as revenue profits. Understood? Next B. General reserve. Again same. Take the closing balance. Again same. Opening and current year. Again same. From opening, take care. This time in one of the question he told given bonus issue. In your assignment problem, he is giving bonus issue from the post acquisition profits. Post acquisition balance of general reserve. Clear? It might be either from pre or it might be either from post. So just be careful and go through the question carefully. Okay. And from opening, if you have deducted bonus issue, you will get the figure and this will become balancing figure. And you just need to separate it into again till the date of acquisition, after the date of acquisition. And this is nothing but pre, till the date of acquisition pre, this is nothing but post. Pre is nothing but capital profit. Post general reserve kada, it is called as revenue reserve. Post P&L is only revenue profits and all other post is nothing but revenue reserves. Remember, post P&L is revenue profit, post reserves is nothing but revenue reserves. Moving on to the next thing, not yet over. See, revaluation surplus. Yes, you are supposed to do revaluation here itself. In all our question, it is very clear and it is apparent that revaluation is done at the time of acquisition. Revaluation is done at the time of acquisition. Anyways, take opening balance of PPE. Original balance you have to take. Deduct the depreciation till the date of acquisition, if any. In one of the illustrations, you will be getting this one actually. You have to deduct the depreciation. After deducting depreciation, you will get book value as on date of acquisition. And then you have to compare it with revalued figure. If at all revalued figure is more than the book value, it is capital profit. If revalued figure is less than the book value, it is capital loss. It just depends. You have to look over to the question very carefully. Sir, if you are having two assets, on one asset capital profit, another asset capital loss, not a very big deal. Set off the two things. Two assets, on one asset capital profit, under revaluation upward. On another asset capital loss, under revaluation downward. Not a big problem. Set off the two things and put the net figure directly. Understood? The next one, D. Yeah, one more thing. Like this, deducting depreciation till the date of acquisition is applicable only for one illustration. And for the remaining problem, this is not there. Because opening balance is equal to date of acquisition. I mean, opening date is nothing but date of acquisition. Clear? If opening date is different, date of acquisition is different, then you have to provide depreciation. But if opening date itself is equal to date of acquisition, then no need to do anything. Clear, everybody? And moving on to the next thing, D. Depreciation on revalued figure. Remember, depreciation is always a revenue item. In your material, even in ICA material, in the notes relating to depreciation, he is giving one wrong statement. If depreciation is relating to the previous items, it will become capital. If depreciation is relating to after acquisition, it is revenue. But that concept itself is not there. Depreciation is always revenue because it is provided only after acquisition. Take care. Anyways, how to find the depreciation on revalued figures, sir? Sir, please don't take this capital profit or capital loss and compute directly. That will not get. Ardhamautunda? In that problem, if you have remembered, 37,500 is a capital profit. If you have taken 37,500 into some percentage into 6 by 12, you will get 1825. But that is wrong. 1500 is correct answer. Did you remember that one? One problem you are having, illustration. Anyways, listen. Let me tell you. Don't take capital profit into rate or capital loss into rate and telling that this is additional depreciation on the revalued figure. That is wrong. How to do it, sir? Depreciation on original figure. Depreciation on revalued figure. Compare these two things. If depreciation on revalued figure is less, very happy, it is nothing but revenue profit. If depreciation on revalued figure is more, which is nothing but revenue loss. Is it clear? Because if depreciation on revalued figure is more, you need to provide extra depreciation. That difference is nothing but revenue loss. Again same, sir, you are having two assets. On one asset you got revenue profit, another asset you got revenue loss. Very simple, set off. And one more thing, my dear children, very important, remember. If capital profit is there on revaluation, you will be having revenue loss on depreciation. Because asset value increases, capital profit. Revaluation also, depreciation also increases revenue loss. If capital loss is there on revaluation due to downward, depreciation decreases kada, which is nothing but revenue profit. Understood? This is what with respect to your depreciation. Okay. So take care. First one you have done about P&L account. Next one general reserve. Next one revaluation. Next one depreciation on revaluation. Now the last and final one, upstream sale of goods. Upstream sale of goods. But let me deal it very, very simple. Listen. Sir, holding is always at top. Subsidiary is always at down. You remember that one first. If subsidiary is selling to holding, upstream. If holding is selling to subsidiary, downstream. Hey, who is actually selling? Subsidiary. So profits will be included in subsidiary company kada. So subsidiary company profits have to be eliminated, which are in step number 2. Holding company inventory is more. You have to deduct unrealized profit from the inventory, which is in step number 6. Elimination of intercompany transactions. And if holding is selling to subsidiary, holding is selling kada, so holding profits or more, you have to deduct from holding company profits, which will be in step number 7. And inventory is included in subsidiary company, which will be deducted from step number 6. Now we are speaking about upstream. In step number 2, you are also going to get upstream sale of goods, which is nothing but unsold inventory multiplied by rate by 100 plus rate is going to give you some stock reserve. Respond, is it clear? So that is your step number 2. Actually you are going to get 5 things. Listen very carefully, simply I am going to tell you. P&L account, opening current year. From opening you need to deduct the total dividend declared by subsidiary company, which is a pre-acquisition dividend. Separate into pre and post. General reserve, opening current year. Check out bonus is declared. If it is from pre, deduct from opening. If it is from current year, you have to deduct it from current year. And then immediately find pre and post. Capital profit, revenue reserve. Ade P&L account aithe capital profit, revenue profit. And the next one, revaluation. Take the opening balance, deduct depreciation till the date of acquisition. After that you will be getting one book value as on the date of acquisition. Compare it with revalued figure, upward or downward. Capital profit, capital loss. Depreciation. Take the depreciation on original figure, compare it with depreciation on revalued figure. If depreciation on revalued figure is more, revenue loss. If depreciation on revalued figure is less, revenue profit. Understood everybody? That's it. And finally, upstream will come here, not the downstream. Only upstream. Because step number 2 is relating to dash profits. Subsidiary company profits. Subsidiary company profits in the sense upstream has to be deducted. Respond clear? Now moving on to the next thing. Step number 3. Sir, there are faculty who will be telling no need to deduct pre-acquisition profit there. They will be deducting holding interest while doing holding, minority interest while doing minority. but that is all big headache. If you have already deducted, it will become very simple. Now check out from step number 3, it is actually very easy. Step number 2 is the difficult step. Step number 3, apportionment of profits. Take the 3 divisions, C, P, R, P, R, R. Capital profit, revenue reserve. Remember, whatever you are having in step number 2 should be there in step number 3. So A, P&L account, here and here. B, general reserve, here and here, not at revenue profit. C, revaluation reserve, here. If capital profit, it will be in plus. If capital loss, it will be in minus. If revenue loss, it will be in minus. Clear? Next, depreciation on revalued figure. Now, depreciation on revalued figure is capital or revenue. So, it will be coming here itself. And finally, upstream unrealized profit. Sir, unrealized profit upstream, revenue loss. So, it has to be here. Clear? If loss, it has to be deducted. If profit, it has to be added. If profit, it has to be deducted. If loss, it has to be added. You'll get the total. Only this one. These things. These things. And this total has to be separated between holding interest and minority interest. Remember, very important. Total minority interest has to be transferred to step number 4. Pre-holding interest has to be transferred to step number 5. Post-holding interest has to be transferred to step number 7. Yeah, maybe initially it is typical or difficult to remember these steps. But if you have done 1 or 2 problems, I'm pretty sure this is going to become very easy for you. Shall I proceed further? Now, step number 3 was done. Step number 4. Step number 4 is nothing but aggregate of minority interest. Share in share capital, share in capital profits, share in revenue profits, share in revenue reserves. All these things will come here. And share in share capital. Subsidiary companies share capital multiplied by minority interest. Hey, take care. It might be even before bonus or it might be even after bonus. You have to take including bonus for sure. And then you are going to get total aggregate of minority interest, which has to be transferred to CBS. And the next one is step number 5. Cost of control. Yes, that's divided into 2 parts. Number 1, cost of investment minus pre-acquisition dividend holding interest only. Only holding interest has to be deducted, provided if it is wrongly treated. Yes, in all our questions it will be wrongly treated and hence it has to be deducted. Now compare it with share in share capital and share in capital profits. Hey, only this one. Step number 5. And coming to share in share capital, subsidiary companies share capital into holding interest. Yes, even including bonus. And last, after comparing, if cost of investment is more, capital loss, transfer to goodwill. If at all cost of investment is less, capital profit, transfer to capital reserve. That is what your step number 5. And moving on to step number 6. Very, very simple. Elimination of ICTs or mutual owings. Take care. You take the debtors, creditors, bills receivable, bills payable, stock, etc. Whatever you are having, take all those things. Balance as mentioned in holding company's balance sheet. Balance as mentioned in subsidiary company's balance sheet. From this total, deduct ICT or mutual owings or unrealized profit if it is stock. Yes, we will put stock here only. Upstream, downstream, unrealized profit has to be eliminated from the stock. Did you remember? Somewhere here. Yes, stock. Step number 6. Okay. So after deducting, you will be getting the net figure, which will be taken to CPS. Very important. In one problem relating to this one, if you have remembered, due from black limited, due to white limited, something one problem will be there. Did you remember? In such a case, at liability side, you will be having 30,000 payable, but I'll be showing 36,000 receivable. You are telling 30,000 payable. I'm telling 36,000 receivable. I can set off only to the extent of 30,000. Balance how much is there? Add it to cash in transit. That is cash and cash equivalents. Clear everybody? You're having this kind of thing only in one problem. So take more care. Shall I proceed further? This is what step number 6. Now step number 7. Reserves and surplus for consolidated balance sheet. You are having only 2 reserves. P&L account, general reserve. Take the balance as mentioned in holding company's balance sheet. Very important. Add post holding interest. Don't take total. Somewhere here you have done. See this one. Step number 7. Which is post holding interest. Take only that one. Very important, okay? Minus pre-acquisition dividend holding interest. If it is wrongly treated, will have to be deducted. And also downstream sale of goods unrealized profit has to be deducted. And you will get the total figure. For this total figure, add capital reserve from step number 5 if at all. Because this is total reserves kada. So bring even capital reserve here. And you will be getting the total of step number 7, which will be directly taken to CBS. Respond understood. This is what your consolidated balance sheet. To tell you in a nutshell view, step number 1 is basic data. Be careful with bonus issue in the respective problem. Step number 2, heart of consolidation. Subsidiary company profits will be affected. Be careful with pre-acquisition dividend. Total has to be deducted. Be careful with bonus issue declared. Be careful with revaluation. Be careful with depreciation on revaluation. Be careful with upstream sale of goods. Step number 3, apportionment of profits. Nothing great. This is very, very simple. Separating between holding interest and minority interest. But you have to be careful that minority interest has to be taken to step number 4. Holding capital profits has to be taken to step number 5. Holding revenue profits and revenue reserves has to be taken to step number 7. And next, step number 4, aggregate of minority interest. Nothing great. Including bonus issue, you have to take the subsidiary company's share capital and multiplied it with minority interest. Step number 5, cost of control. Be careful. Cost of investment has to be deducted with the pre-acquisition dividend relating to holding interest only. And share capital has to be considered including bonus issue. Hey, is it clear? The next one. Step number 6. What is step number 6? Elimination of ICTs or mutual owings. Very, very simple. Be careful with stock because you need to deduct unrealized profit. And be careful with that problem. What is it called? Cash in transit. In one problem, you are having this one. Be careful with that item, cash in transit. And finally, step number 7. Reserves and surplus and a holding company profits plus post holding interest will be here. Be careful with what is it called pre-acquisition dividend, holding interest if it is wrongly treated, and downstream sale of goods has to be deducted. And at the end, you just need to add the capital reserve from step number 5. In a nutshell, this is what your steps of consolidation. Finally, while drafting CBS, share capital, note number 1. Reserves and surplus. Straight away, step number 7. No need to open note at all. After these things, you will be getting minority interest. Step number 4. After these things, if at all you are having any creditors, bills payable, etc. in step number 6, put step number 6. If not, line by line addition. Balance of holding company plus balance of subsidiary company. And you can put the net figure. Respond clear. And coming to asset side, very simple again. For all the PPEs, you have to open a note. And for all other debtors, cash and cash equivalents, bills receivable, etc. If needed, you can put step number 6 if it is there. Otherwise, line by line addition. One more important thing you should never forget. Goodwill. Step number 5, if any. For capital reserve, no need to specifically show in balance sheet because you are adding it in step number 7, reserves and surplus. Respond, is it clear? That is the end of consolidated balance sheet. Just wait for 2 minutes. We are going to start consolidated P&L account. Sir, what is happening is actually people and students are concentrating on CBS. Enta cheppina sare, they are concentrating on CBS, and CPL they are taking light year. But in examination, more than CBS, CPL is tested. Even in your recent MTP, CPL is tested. Yeah, since in MTP, CPL is tested, in main exam, CBS is tested. Don't think like that. It might happen in any way. It's not in our hands at all. So take more care. Asli papers enta simple untayante sets untayi kada, like set 1, set 2, set 3, set 4. They'll be releasing in set something. So matter entante, if at all last attempt CPL asked, current attempt CBS is asked, everybody will be thinking, oh, last year CPL, this year CBS. అప్పుడే ఆలోచిస్తారు స్టూడెంట్స్ ని లాక్ చేయడానికి లాస్ట్ ఇయర్ సిపిఎల్ఏ, ఈ ఇయర్ కూడా సిపిఎల్ఏ అడిగారు. ఏదైనా జరగచ్చు. ఎగ్జామినర్ మైండ్ సెట్, క్వశ్చన్ పేపర్ మైండ్ సెట్ ఎలా ఉంటుంది అనేది మన ఎవరికి తెలియదు. సో టేక్ మోర్ కేర్, బీ వెరీ వెరీ కేర్ఫుల్. ఎనీవేస్, సిపిఎల్ ఈజ్ యాక్చువల్లీ సింపుల్. ఐల్ బి టెలింగ్ యూ ద రూల్స్, జస్ట్ ఫాలో దట్ వన్. అగైన్ సేమ్. స్టెప్ నెంబర్ 1, prepare consolidated P&L account. What is consolidated P&L account, sir? Standalone P&L account, which is nothing but expense of holding company plus expense of subsidiary company minus ICT, or incomes of holding company plus incomes of subsidiary company minus ICT, which is nothing but mutual owings. In the problems you will be having subsidiary company sold to holding company, and from sales you need to deduct ICT, from purchases also you need to deduct ICT. Remember, these mutual owings has to be deducted 2 times for sure. In your assignment problem he will be telling sales and other income, administration expenses, selling and distribution expense. Administration expense paid by subsidiary company to holding company towards consultancy fees. Like that he is giving. So you have to deduct it from administration expense, other income. But other income is already included in sales. So you need to deduct from that. Remember, in P&L account, each and every mutual owing has to be deducted twice. One is at expense side, the other is at income side. Remember this rule. Clear? And the next one. Be careful in this context. In CRD problem, you are having other income. Preference dividend received by holding company. Did you remember preference dividend declared by subsidiary company up to 39/2014? That is only up to 6 months. Gurtunda? Total dividend for the year is 28. Total dividend declared, total dividend for the year is 28. Since it is for exactly 6 months, 28 into 6 by 12, 14. 14 is declared by subsidiary company, but 50% is the holding of holding company in preference share capital in subsidiary company. Hey, did you get all the logic? Holding company is having 50% preference share capital holding in subsidiary company. Subsidiary company total dividend is 28 multiplied by 6 by 12, which comes to 14, multiplied by 50%, 7, which comes to holding company. Logic clear? Subsidiary company has declared 14 as preference dividend. Holding company is getting 7 as its income. But this will not be shown. Preference dividend received by holding company will not be shown in CBS because it is nothing but mutual owings. Ante kada? Hey, is it clear? That is step number 1. Take care. Sir, you told each and every mutual owings has to be deducted twice. One is at expense side, the other is at income side. Now, from other income, I have deducted this 7,000. Then when can I deduct this 7,000 at expense side? Actually, it is not to be deducted from expense. It has to be deducted from preference dividend declared, which is an appropriation. Clear? After the completion of entire problem, net profit before appropriation minus preference dividend you will be doing. There you have to deduct that. Hey, is it clear? Fine. Next, that is step number 1. Expense of holding company plus expense of subsidiary company. Income of holding company plus income of subsidiary company minus mutual owings. One time mutual owing has to be deducted in expense side and the other at income side. But coming to preference dividend declared by subsidiary company, it has to be deducted from other income where it will become 7 minus 7 and it is obviously 0. You can check it in that problem. And the same 7, another 7,000 has to be deducted from preference dividend declared from appropriations. Clear? Hey, is it clear? Step number 2. Prepare subsidiary company's P&L account. Alone subsidiary company's P&L account, amma. No ICTs has to be deducted. Clear? And finally, step number 3. Take care. This is very, very important actually. Deduct the following. Sir, you are having consolidated P&L account, which is actually combination of holding company profits plus subsidiary company profits. But what do you want actually? Holding company profits plus post holding interest. Ante kada? So you have to separate subsidiary company profits, minority, holding. Again holding you are having pre and post. What do you want, sir? I want only holding company profits and post holding interest. So I have to eliminate these two things. Clear? I have to eliminate these two things. So step number 3, deduct the following. Point number 1, you have to find net profit after appropriation from step number 1. Net profit after appropriation from step number 1. So you need to deduct the following. Point number 1. Take care. Minority interest. If profits, it has to be deducted. If losses, it has to be add back. Ante kada. Next, pre-holding interest. Again same. If profit, it has to be deducted. If losses, it has to be added back. Along with these two things, there are two more things. Okay. What are those? Unrealized profit, whether upstream or downstream, has to be deducted here. But take care. In your ICA solutions, they will be deducting unrealized profit from change in inventories, or they will be deducting it from cost of raw materials purchased. But don't put that confusion. You can comfortably deduct at the end. Either upstream or downstream will be deducted here. And last and final, pre-acquisition dividend, if any, will also to be deducted. Remember these four things. Minority interest, profit has to be deducted, loss has to be added. Pre-holding interest, profit has to be deducted, loss has to be added. Unrealized profit, upstream or downstream, this has to be deducted. Pre-acquisition dividend has to be deducted. And at last, you are going to get the final figure. Clear? And last and final, while preparing subsidiary company's P&L account, deduct total preference dividend. That is 114 already declared, another 14 will be declared. But while preparing consolidated P&L account, deduct only after eliminating mutual owings. Ante 14 minus 7, 7, 14 minus 7, 7. I told you total dividend is 28. So for the first half year it is 14. Second half year it is 14. Subsidiary company share is 50%. That is 7 and 7. You need to deduct the same. Respond, is it clear? Wantedly did not deal with the concept uniformity in accounting policies. That's actually very easy. You can just revise the same. And also wantedly did not dealt with negative minority interest. Only one rule for that. If negative minority interest is there, it has to be adjusted against the reserves and surplus of holding company. Don't show minority interest as a negative figure. Don't show minority interest as negative. At that time, minority will become 0. That negative minority interest has to be adjusted against the reserves and surplus of holding company. Respond everybody, pakka. That is the end of accounting standard number 21. Okay. Remember, I'm speaking about accounting standard number 23. Investments in associates. Everything is common. Ante compare cost of investment. If any pre-acquisition dividend is there, you need to deduct that. And share in share capital, share in capital profits, everything is common. Compare these things and find either goodwill or capital reserve. Up to this is okay. If it is AS21 subsidiary, then enough of showing goodwill or capital reserve directly. But now you are not supposed to show goodwill or capital reserve directly, and you are supposed to show like this. Ante how, sir? You are supposed to show cost of investment in your CBS. Okay. And also you are supposed to show goodwill or capital reserve for share in net assets. So you have to take the share in net assets, and if it is goodwill, it has to be added. If it is capital reserve, it has to be deducted, and then you are going to get cost of investment. Very important. For this cost of investment, you just need to add revenue profits. If losses, you just need to deduct, and that will become the net cost of investment or net value of investment as at the balance sheet date. There itself associate is closed. In all the problem you are having same lines. All the problems you are having the same things also. But only one thing is that in one or two problems he will be asking prepare for 2 to 3 years. So from every year you need to start from here. Again add revenue profit or deduct revenue loss. Clear? But one thing which is important, take more care. Take more care. Point number 1. If at all you are incurring continuous losses and the net figure had become negative, then ignore that. Say your cost of investment is 1 lakh. Continuous revenue losses 1,20,000. Don't show your cost of investment as negative 20,000. Show it just as 0. Understood? This is point number 1. So take care. Sir, in consolidation, do cost of investment be shown in CBS or not? In consolidation as per AS 21, is cost of investment shown in consolidated balance sheet? No. Instead of that, goodwill or capital reserve is shown. But in accounting standard number 23, you need to show cost of investment and also you need to show goodwill or capital reserve separately. And so you have to show like this. Share in net assets, add goodwill, deduct capital reserve, and you will be getting cost of investment. And if revenue profits is there, it has to be added. If revenue losses is there, it has to be deducted. If the overall figure had become negative, then just ignore that and take it as 0. Next, whether it is associate or not. Yesterday we have discussed AS 18. Did you remember? It should be more than 20%. Even if less than 20% and significant influence is there, and more than 20% and no significant influence is not there, or it must be proved. It must be proved. Clear everybody? Next. Very important. Listen. Very important. Say for example, A is having 90% in B. Did you get my point? And A is having 30% in C. A is having 90% in B and 30% in C. A is going to prepare consolidation. But for B it has to follow AS 21. For C it has to follow AS 23. Sir, if this is not there, only this is there, no need to prepare consolidation. Because consolidated financial statements is nothing but combination of holding company plus subsidiary company. Only then associate and joint venture will be included. If no CFS, no need to include associate and joint venture in consolidated financial statements. Is it clear? Now very important. If A is having 90% in B and B is having 30% in C and A is directly having A is directly having 5% in C. Okay. Is C an associate to A or not? Cheppali. Is C an associate to A or not? Yes. How, sir? A is directly having 5% plus A is having 30% through B. Totally it is having 35%, which is more than 20%. But take care. For the purpose of preparation of CFS, the percentage is not 35%. Percentage will become, yes, perfect, 90% of 30% plus 5%. Hey, deciding associate or not is this one. But for computation, this is like this. In such a case, 27 plus 5 on a whole 32%. Hey, logic clear? Take care. For checking whether it is my associate or not, percentage plus percentage. But for preparation of CFS, that is for all the computations, it is percentage of percentage plus percentage. Take care, that's actually important. Respond everybody, Papa. And that is the end of your associate. Number 23, associates was totally completed. Clear everybody? Now coming to the next one, accounting standard number 27. In AS 27, you are actually having 3 parts. JCE, JCO, JCA. Jointly controlled entity, jointly controlled operation, jointly controlled asset. First of all, you need to check out the question very carefully, whether it is JCE, JCO or JCA. If all the venturers had formed a new entity for doing their joint venture, if all the venturers had joined together to form a new entity, then that is called as JCE. Under jointly controlled entity, you will be having a separate joint venture account also. You will be having separate joint venture account, and also you are having all the venturers account separately. Whereas if it is JCO and JCA, what is the difference between JCO and JCA, sir? JCA, jointly they will be indulging in construction of one particular asset, and they will use it simultaneously. JCO, jointly they will do the business. No separate entity is formed. Clear, everybody? In these two cases, separate joint venture account will not be maintained. Whatever the account that is maintained itself is called as joint venture account. And separate accounts for separate entities will not be there. Each and every venturer will be maintaining their respective accounts. Logic clear? Each and every venturer will be maintaining the accounts. But finally, to consolidate all the venturers' data, one venturer will be sending to the other venturer. And they will be preparing the consolidated, pooled data. Clear? Let me show you the problematic which will help you better. So see here, proportionate consolidation method, which is actually applicable only for JCE. For JCO and JCA, there is no separate entities at all. Proportionate consolidation method is applicable only for JCE. What do you mean by this one, sir? Listen very, very carefully. Sir, three types: JCO, JCA, JCE. Jointly controlled entity. Separate entity is there. Proportionate consolidation method is followed. Only for JCE, a holding company can take in consolidation. JCO and JCA will not be taken in consolidation at all. Did you get my point? Sir, is it understood? A company is doing jointly controlled operation with another company. No need to prepare consolidation financial statements for that. A company had jointly controlled an asset with another entity in order to use the same. No need to prepare consolidated financial statements. But a company with another company formed a new company called JCE, jointly controlled entity. Clear? And it has prepared. It has followed proportionate consolidation method in order to prepare CFS. What do you mean by this one, sir? Holding company data plus subsidiary company data plus percentage of holding in joint control entity. Say holding company is having 1 lakh. Okay, sir. Subsidiary company asset is 1 lakh. Okay, sir. Jointly controlled entity asset is also 1 lakh. But my share is only 30%. Then 30% of 1 lakh is considered. Respond, is it clearer? This is what you will be following in jointly controlled entity. Let me show you the problematic part actually. The first one. See the question and you decide. Mr. A, B and C entered into a joint venture to purchase a land, construct and sell flats. Did they form any new entity? Answer, Amma. Did they form any new entity? No. They are just constructing, selling, which is nothing but JCO. Clear? For which they are maintaining it. If you observe, draft consolidated P&L account. What is that, Amma? Draft consolidated P&L account, which is also called as draft joint venture account. All the expenses will be clubbed by all the venturers. All the incomes will be clubbed by all the venturers. All the introductions will be at debit side. All the withdrawals will be at credit side. And finally, you are going to get profit or loss. And I told you each and every venturer will be maintaining their own books of accounts. So in the books of Mr. A, he will be maintaining joint venture with B. In the books of Mr. B, he will be maintaining joint venture with A. Joint venture with B plus joint venture with A is nothing but, even joint venture with C is nothing but draft consolidated P&L account. Here there are three parties kada, A, B, C. A is maintaining joint venture with B and C account. B is maintaining joint venture with A and C account. C is maintaining joint venture with A and B account. This account plus this account plus this account is equal to draft consolidated P&L account. Hey, this is just named consolidated P&L account. This is not originally consolidation as per AS 21, okay? This is not original consolidation as per AS 21. Because consolidation is reserved only for holding and subsidiary companies. Draft consolidated P&L account, rough. No double entry system. Or it is also called as draft joint venture account. And the next thing. See, ABC decided jointly to construct a pipeline. This is nothing but JCA, jointly controlled asset. Because that pipeline is used by all the three parties which was manufactured by them. Clear? Expenditure is equally bearing. Expenditure is equally bearing. And for the purpose, following expenditures were there. Building 12 lakhs, pipeline 60 lakhs, computers and electronics 3 lakhs and various vehicles 9 lakh. And even the expenditure whatever is there, it was equally borne, which is like 6 lakhs each year. He is asking to prepare consolidated balance sheet and extract of statement of P&L account. Amma, here consolidated balance sheet does not mean that the CBS as per AS 21. Here CBS meaning A's data plus B's data plus C's data. Ante. In this question, surprisingly, share capital will not be there. So if you prepare balance sheet, you will be having all the assets. The assets total is nothing but share capital. Check out. Share capital. Only one is at liability side, 71,40,000, which is nothing but the total of assets, which is 71,40,000. Is it clear? Total of assets will be given and balancing figure is nothing but share capital, 71,40,000. And the next, you observe this one. A Limited UK based company entered into a joint venture with B Limited in India. What is their work? B Limited will import the goods manufactured by A Limited on account of joint venture and sell them in India. A Limited and B Limited agreed to share the expenses and revenues in the ratio 5:4. Profits equally. A Limited invested 49% and equally liable for all the liabilities of joint venture and having equal share in all the assets. Clear? Hey, this is also not JCE. Not JCE. It is JCO. Because they have entered into one operation. You know the greatness of this problem? For revenue, it is 1 ratio. 5:4 kada annadu. For expense, it is 1 ratio. 5:4. But for profit, it is equal. 1:1. Share capital, 49% A, 51% the other party. And all the other liabilities equal. all the other assets equal. That is how you have to present in notes to accounts. Check out 5:4, 5:4. Revenue expenses 5:4. Closing inventory is asset kada 1:1, 50-50. Next, share capital. Total share capital is there 49% A, 51% B. Reserves and surplus is nothing but profits kada. Profits is equal 1:1. And all other loans 1:1. All other assets 1:1. The highness of this problem is there in breaking each and every item separately. Revenue 1 ratio, expense 1 ratio, profit 1 ratio, assets 1 ratio, liabilities 1 ratio, capital another ratio. And last and final part of consolidation, JCE. A Limited entered into a joint venture with B Limited on 1:1 basis and formed a new company, C Limited. So each and every part of C, A is having 50% share, B is having 50% share. As simple as such, A's loan plus 50% of C's loan. B's loan plus 50% of B's loan, which is nothing but proportionate consolidation method. Current assets of A plus 50% of current assets of C. Current assets of B plus 50% of current assets of C, which is nothing but your consolidated financial statements. Check out. A Limited, total. C Limited, only the share. A Limited, total. C Limited, only the share. What is the long-term borrowings of C Limited? Long-term borrowings of C Limited. Loans, 2 lakhs. 1 lakh to A, 1 lakh to B. 50,000 to A, 50,000 to B. 50,000, 25,000 to A, 25,000 to B. 12 lakhs reserves kada. 6 lakh to A and 6 lakh to B. Respond, is the logic clear? That's it. Nothing great. Very, very simple. Respond, is the whole logic clear to each and everyone? So that is what your accounting standard number 27. Proportionate consolidation method is applicable only for JCE. You have to read the question to identify whether it is JCO, JCE or JCA. Clear everybody? That is the end of your consolidation. And get ready. Let's go with a standard. Okay, just let's break. After that, let's go with amalgamation again. Still target is the 25, 28, 29, 20 above. Even above. Let me start with 28 and 25 and let me complete. Only one provision. 28, only one provision. 28, you might have these many things, but your problem is having only one provision. Entire problem is having only one provision. And actually, to tell you, there is a theory concept, bottom up test, top down test, but that is actually not needed. If I've started explaining top down and bottom up test, it will take itself 1/2 an hour will go away for the same. మీకు గుర్తుందా, క్లాస్లో కూడా అరౌండ్ 1.5 hours చేసాం. బాటమ్ అప్ టెస్ట్, టాప్ డౌన్ టెస్ట్, అరౌండ్ 1.5 hours 2 hours మొత్తం అవన్నీ కూడా చేసి మళ్ళీ ఒక ఎగ్జాంపుల్ ఇచ్చి చేసాం. సో అంత పెద్దగా అక్కర్లేదు. Accounting standard number 28, which is nothing but impairment of assets. The impairment might be applicable either for tangible assets or even for intangible asset. Factors for impairment might be either external factors or internal factors. Very important thing that you have to remember is all about only one rule. Take the book value of take the book value of asset before impairment of loss. Ante something like original cost price minus accumulated depreciation, or opening balance minus depreciation. You'll get some figure. You have to compare this figure with the recoverable amount. What is recoverable amount, sir? Value in use or net selling price, whichever is higher. Value in use is nothing but present value of inflows of future economic benefits. Net selling price is nothing but selling price minus selling expense. Again for selling price, in standard you are having lots and lots of explanation. If active market is there, no active market is there, no active market to no binding sale agreement, then you have to take it on the best estimate. If active market is there, you have to take the fair value. So all those things are actually not needed, simply like selling price minus selling expense. Conclusion: if your book value before impairment of loss is greater than recoverable amount, bring down this value to the recoverable amount, which is nothing but impairment of loss. If your book value is less than recoverable amount, no need to do anything. If it is greater than recoverable amount, then bring down book value to recoverable amount, which is nothing but impairment of loss. Ante. Sir, can impairment of loss be reversed? Of course, yes, it can be reversed. Provided, had if there is no impairment of loss in the previous year, you find the book value and this loss can be reversed only to such extent. Had if there is no impairment of loss, you need to check out only book value minus depreciation. You'll get one figure. Find out how much reversal of impairment of loss is there. Say current book value with impairment of loss is 80,000. Without impairment of loss is equal to 1,20,000. You would like to reverse the impairment of loss to the extent of 50,000. Can you reverse? Question clear, huh? Is the question clear? How much amount I can reverse? Find book value without impairment of loss. Until only cost price minus depreciation. Say it comes to 1,20,000. Book value with impairment of loss comes only to 80,000. Your reversal proposal is 50,000. Can you reverse this one? Rule ento ippudu chepta vinandi. You can reverse to such extent, had if there is no impairment of loss, how much value is there? Only to that extent. Ante had if there is no impairment of loss, your asset value should be 1,20,000. Your book value with impairment of loss is 80,000. Now you can reverse only up to 1,20,000. Ante 80 should become 1,20,000 after adding 40,000. But you want to reverse 50. And if you reverse 50, 80 plus 50, it will become 1,30,000. But no. Maximum is only 1,20,000. That is had if there is no impairment of loss. Logic clear? Huh? I am telling this one because even though there is no question, you might get a bit on this. On top down test and bottom up test, 99.999% you will not get a question. But on this you might get a bit. How to do it, sir? Very simple. Find book value with impairment of loss, book value without impairment of loss. With impairment of loss, maximum should become only with impairment of loss. Clear? Ante with impairment of loss should maximum become without impairment of loss. How much ever the value that you need to reverse, only that is the maximum amount. Say for example, book value with impairment of loss is equal to 1 lakh. Book value without impairment of loss is equal to 1,50,000. Reversal proposal is equal to 25,000. Possible or not possible? Separately. Because 1 plus 25 comes to, which is within 1,50,000 itself. Maximum reversal is only maximum reversal 50,000. Say for example, if the reversal proposal is 65,000, only up to 50,000. I hope you have got the logic, and that is the actual end for accounting standard number 28, impairment of loss. Only two provisions: providing impairment of loss, reversing impairment of loss. While providing impairment of loss, book value, yes, even everybody can confine only up to this one, unless and until you are expecting for a rank. For pass guarantee AS 28, these two provisions are highly enough. Exam unda? You follow this provision and go to the exam, you will get full marks for impairment of loss. Yeah, sir, if it is theory, you have to read for sure. You will get one MCQs from the theory. Sir, anyways, check the book value, deduct the depreciation, you will get one figure. Compare it with recoverable amount. Recoverable amount is nothing but value in use or net selling price, whichever is higher. Present value of inflows of future economic benefits, selling price minus selling expense. If this is more than recoverable amount, bring down to recoverable amount, that is nothing but impairment of loss. How much to be reversed, sir? Providing is okay. How much maximum you can reverse? Up to the value which is arrived had if there is no impairment of loss. Only to that value you can reverse. More than that you cannot reverse. Clear? And as you have requested CGU, I am telling. Sometimes net selling price finding is not possible. Sometimes value in use finding individually is not possible. If individually for those assets where finding net selling price and value in use is not possible, then you include that asset in a respective block of CGU. Respective block is nothing but group of assets. Smallest group of assets collectively generating the revenue to the business. This AC alone cannot generate net selling price. This AC alone cannot generate value in use. Can I sell AC or not? Can I sell AC or not? This AC I cannot sell because this is not my property. But can I sell AC or not? Of course, yes. So I can find net selling price. But value in use possible. From AC, tell me how much future economic benefits you will get. Every year bring it to the present value. That's not possible. So if either of the things finding is not possible, don't take it as an individual asset. You have to include in such smallest group of assets which is generating revenue. Clear? Which is nothing but CGU. So now AC has to be included with such machinery which is actually generating the revenue. Say for example, in that room of factory, there is one machinery which is producing goods. Producing goods in the sense, present value of inflows of future economic benefits is possible to find. So even AC block will also be included here. So now you have to find total book value of CGU and compare it with total recoverable amount of CGU, which is nothing but again same, total value in use or total net selling price, whichever is higher. Ante. Clear everybody? Anyways, that is the end of accounting standard number 28. Get ready, we are going to start accounting standard number 25. Interim financial reporting. Sir, actually for interim financial reporting, there are two sets of interim financial statements. Whichever type needed for the business concern, they can choose that type. Number one is complete set of information. Number two is condensed set of information. complete set of information ante you have to give each and every asset, each and every liability, each and every expense, each and every income. However, you will be preparing the original financial statements. In the same style, you have to prepare the interim financial statements also, which is called as complete set of financial statements. Now, condensed set of financial statements ante no need to show each and everything. Only some portion is enough. But how much is that some portion, sir? Whatever are there in the last year, show it in the current year. Whatever items, whatever line items that are there in the last year, show it in the current year. That is highly enough. Clear, everybody? So no need to show each and everything. But very important thing is that whatever are there in the last year. See here, headings and subheadings which were included in the most recent annual financial statements. Last year one line item is there, debtor. So today even in current year also trade receivables should be there. Sir, last year trade payable is not there. You can ignore that. No need to disclose. So whatever line item is there in the last year, you have to disclose the same line item. If that is not there in the last year, no need to disclose. That is condensed set of financial information. Now, next, comparisons. Actually important, take more care. And you might get in bits. Current year, previous year. Sir, for each and everything you will be preparing for 2 years. Am I correct or wrong? Ante kada? So, how this has to be working out, sir? Take care, Amma. If it is balance sheet, you have to prepare balance sheet as on a particular date. Am I correct or wrong? So you have to follow YTD. What is YTD, Amma? Year 2 date. End of the current interim period. And say for example, if you are preparing the balance sheet for the second quarter, you can't take only the data relating to the second quarter. Balance sheet of last year plus all the transactions up to second year quarter. Hey, logic clear? Interim financial period balance sheet date is balance sheet date of last year plus all the transactions up to second quarter, which is nothing but YTD. And at the comparisons, you have to give the previous year balance sheet. Previous year total balance sheet you have to give. Next, coming to statement of P&L account. 2 things you have to give. Number 1, current interim period YTD. Current interim period ante only second quarter. For second quarter of the last year comparison has to be given. For YTD ante both quarter 1 plus quarter 2. Even in the previous comparison, you have to give the quarter 1 plus quarter 2. Logic clear? And the last and final one, cash flow statement. Only YTD is enough. Only YTD. Respond, is it clear? So, to tell you in a simplest word, if it is balance sheet, you have to prepare last year balance sheet plus YTD. And you have to prepare only one balance sheet. And comparative information, previous year balance sheet you have to give. If it is P&L account, respective interim period of previous year, and cumulation, that is YTD, year to date, both quarter 1 plus quarter 2, the same of previous year. And coming to cash flow statement, only YTD, that is cumulation. And here also only YTD of previous year. Respond clear? That's it. And that's it, nothing great. And on all remaining are just 4 problems you will be having, which are actually very, very simple. Okay. That is the end of accounting standard number 25. Be careful with CRD number 3. Be careful with CRD number 3. And the next thing, be careful and get the difference between CRD number 2 and CRD number 4. 2 things are actually relating to tax itself. But the overall viewpoints is different. While finding the average tax, you be very, very careful. Don't find the average tax by adding percentage and divided by 2 or 3. Total tax divided by total income into 100 is the average tax percent. But you people are doing like 30 plus 40% divided by 2. No, that is wrong. Don't take the percentage directly. Total tax divided by total income multiplied by 100. Clear everybody? And be careful with CRD number 3. And you are having some adjustments which are to be taken off, which are to be added back. That's it. And that is the end of accounting standard number 25. Sir, coming to AS 25, whatever the theory I taught, that is highly enough. Only those two things are absolutely enough. But be careful, while going with the problematic, you have to practice all the problems. CRD 1, 2, 3, 4. But coming to AS 28, theory is highly enough. And basing on that theory, you are having all the problems. Clear? Even AS 23. AS 23, whatever I taught you the format, that is highly enough for solving all the problems. And coming to AS 27, once you have to go through that. And AS 27, I couldn't cover in an enormous way. I just have given you the model of each and every problem, but you have to do it once. Okay, that's it. And what shall we do? Shall we go for break? Okay, sorry. After break, first we are going to start amalgamation. And after amalgamation, buyback and AS 20. Amalgamation might take around 45 minutes to 1 hour for sure. Buyback might take only 15 minutes because I'll be dealing only with the tests. AS 20 I'll deal only with the rights issue problem. Dilute EPS I'll tell you how to compute. And a formula I won't tie kada. I'll tell you the logic behind that and I'll leave it. Okay. And if time is there, I will be going with dependent branches. And what are the different points in each and every problem. Okay. That's it. We'll be meeting you after 35 minutes. That is, 30 minutes. That is exactly by 11:45. Okay. So from 11:45 to 1 or 1:30. Amalgamation. So normally there are 3 types actually. One is like merger, purchase and absorption. And strictly speaking, like generally speaking, we'll be having merger. We'll be having, purchase. These two as per AS 14. But we'll be speaking about absorption, merger and external reconstruction. External reconstruction. New company is formed in external reconstruction by the same management. Without forming a new company, if you are reconstructing, it is called as internal reconstruction. Merger is nothing but 2 or more companies joining together as if it is a single company. Absorption is nothing but one company acquiring another company. This is general language, but not AS 14 language. Sir, majority, coming to amalgamation, I'm not going to tell you the concept because concept is very small. I'm going to deal the different aspects of each and every problem. Likewise, how we have done with cash flow statement. Consolidation, I did not open the material, but I have covered each and every different problem of each and every problem. Each and every different point of each and every problem. Anyways, now let me start. Sir, there are 3 aspects in amalgamation. Closing the books of accounts of transferor company. Opening the books of accounts of transferee company. And the transferor company is transferring its business to transferee company. And transferee company has to pay PC, which is nothing but purchase consideration. PC is dealt as per AS 14. Opening the books of accounts is dealt as per AS 14. Closing the books of accounts of transferor company is not dealt as per AS 14 and something like IGAAPs. Indian generally accepted accounting principles. Again under IGAAPs, liquidation proceedings are applicable. Not each and everything. Under IGAAP's liquidation proceedings are applicable for closing the books of accounts of transferor company. Shall I proceed further? Shall I? So now listen very, very carefully. First, let me speak about PC. Because PC is common for both transferor and transferee company. Listen very, very carefully, everybody. PC. Check out the question. Sir, there is something called lump sum method, but that is not there in any of the problematics, and hence I am not discussing with it at all. Net assets method, net payments method, intrinsic value method. Point number 1. If intrinsic value method is given in the question, he will be giving the intrinsic value also. Given exchange is to be based on intrinsic value, but intrinsic value is not given, then you have to follow net assets method only. Take care. Rule number 1. If he is asking you to exchange on the basis of intrinsic value, and intrinsic value is given in the question, then exchange must be based on that value only. Given, follow intrinsic value, but intrinsic value is not given. Then you have to follow net assets method. Logic clear? Now listen very carefully. Say for example, intrinsic value of A limited is 30 and B limited is 25. Number of shares of A limited are 1 lakh and B limited are 85,000. Now B is acquired by A. Who is acquired by whom? B is acquired by A. PC on the basis of intrinsic value is equal to number of shares of transferor company multiplied by intrinsic value of transferor company divided by intrinsic value of transferee company. But don't by heart it like a formula. It's something like total value of transferor company divided by intrinsic value of transferee company. In other words, number of shares of transferor company multiplied by intrinsic value of transferor company divided by intrinsic value of transferee company. Clear everybody? This is what your intrinsic value exchange. And after that you will be getting one number. 85 into 20 by 30. How much? 70,000. Okay, let us take 70,800. Now listen very carefully, very carefully. You are issuing something like 70,000. At what price, sir? If the price is not given, issue price is 30, of which 10 is face value, 20 is securities premium. If given separately, computation will be done on the basis of this thing and say issued at 20 rupees. Then 10 rupees will become face value, 10 rupees only will become securities premium. Or given simply like issue is made at par, then no securities premium, 70,000 into 10. Respond logic clear? It depends on the questioning pattern. Check it out. Check it out. Whether is it given something like intrinsic value is okay. Issue price, if nothing is given, intrinsic value of transferee company is nothing but issue price. If something is given, follow the same something. Respond clear. This is totally intrinsic value. But given intrinsic value, given under intrinsic value method, but take care my dear children, intrinsic value is not given in the question now. So you have to follow net assets method. Respond everybody clear? You have to follow which method, Amma? Net assets method. Now moving on to the next thing. When to follow net assets method and when to follow net payments method. If the whole PC is given, net payments. If something is missing in the question, he'll be telling necessary cash, necessary number of equity shares. Like this he will be telling. In such a case, you have to follow net assets method. Under net assets method, first of all, you have to compute net assets. That is assets minus outside liabilities at agreed values or takeover values or revalues or fair values. You have to compute net assets at agreed values or takeover values or revalues or fair value. And net assets is nothing but assets minus outside liabilities. After computing this one, you are going to get the total share of net assets. Hey, to find this, you have done assets minus outside liabilities only. Am I correct or wrong? So in this, there is share for both preference and equity. Clear? Yes, for both preference and equity, share is there in net assets. From share of net assets minus PC to preference shareholders. Already PC might be given for preference shareholders. And then you will be getting PC to equity shareholders. Check out. Say for example, if some portion is equity shares, already found out. Balancing figure will become cash. Clear? Preference shares were given, preference shares. Equity shares were given, number of equity shares and balance in cash. Necessary cash. Then that cash will become balancing figure. Respond clear? This is net assets method. Net assets dash minus dash. Assets minus outside liabilities at takeover values or agreed values. And then you will be getting total net assets. That is having share for both preference and equity. So you have to deduct PC to preference share. Hey, take care, not face value. You have to deduct PC to preference shareholders. Then you are getting PC to equity shareholders. If equity shares is given, that will become cash. If cash is given, that will become equity shares. If nothing is given, this is the total PC. Respond understood. Now coming to the next method, net payments method. He will be giving in the question everything. For preference shareholders, this much. For equity shareholders, this much, this many shares, this much cash. Everything is given very, 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 very clearly, which is called as net payments method. And this is the end of PC. I'm challenging you, while going with amalgamation, do each and every problem with PC only. All the remaining is not needed because it is just like copy and paste. Now let me tell you, after the completion of PC, now we have to go with closing the books of accounts of transferor company. See, open all the three accounts simultaneously. Realization account, equity shareholders account, preference shareholders account. Remember, liabilities will be at credit side, assets will be at debit side. Equity shareholders. What are belonging to equity shareholders, Amma? Equity share capital, reserves and surplus. And also some miscellaneous assets like preliminary expenses, cost on issue of debentures, heavy advertisement expenses, discount on issue of debentures, those will come here. Miscellaneous or fictitious assets will come there. If it is preference share capital, very, very simple. By preference share capital. Ante. If it is preference shareholder, only one thing will be there. Now, very important. Each and every asset which was taken over and each and liability which was taken over, only taken over, will come under realization account. To assets by liabilities. Items which are taken over at book values. Hey, take care. Net assets at agreed values. Net assets at agreed values. Realization account at book values. Realization account at book values. Clear, everybody? So this is what your first thing. Sir, if at all there are any items which were not taken over by the transferee company, items which are not taken over. Did you get my point? Sir, what are the items which were not taken over, sir? In one of the assignment problems you will be having, debtors and creditors were not taken over by the transferee company and the same were settled by liquidator. And liquidator's commission is 10%. I'm sorry, 3% or 2% on receipts and payments. Like that, you are having one problem. Say, if debtor was not taken by the transferee company, don't transfer debtor to realization. Open a separate account. If any liability was not taken over by the transferee company, don't transfer it to realization. Open a separate account. Take the opening balance and check out how much is received. Check out how much is paid. The balancing figure you will be getting is nothing but profit or loss. Clear, everybody? Profit or loss. And ultimately remember, this profit or loss will have to be transferred to equity shareholders account. If you want, you can also transfer to realization. Again, from realization, it will be transferred here, kada, equity shareholders. So straight away, you can transfer to equity shareholders account. Respond, is it clear? That all assets which are taken over and liabilities which are taken over will be posted in realization account. At which values? Book values. Items which are not taken over, open separate accounts. Show the sale of assets and show the settlement of liabilities. Balancing figure will become profit or loss, which has to be transferred to equity shareholders account. Respond, everybody, pakha. One part is over. Next important thing is PC. Very simple. PC will have to be posted in realization account credit side, shareholders account debit side. PC will be posted in realization account credit side, shareholders account debit side. In realization account, it will be posted like by transferee company. In shareholders account debit side, it will be posted like to how the PC is given. Equity shares are, not equity share capital. Equity shares or preference shares or debentures or bonds or cash in transferee company, like that. Is it clear? And finally, last step, you have to find profit or loss. Remember, always close shareholders account first. It is highly recommended to close preference shareholder account first, because only by preference share capital it is there, kada. Clear? Say you have to pay 4 lakhs, but you have only paid 3,80,000. For preference shareholders, profit or loss? Profit or loss? Loss. That loss has to be transferred to realization account. Realization account is similar to P&L account. If profit, it will be at debit side. If loss, it will be at credit side. So find profit or loss on equity shareholders and preference shareholders separately and transfer the same to realization account, with which your realization account will get closed. Respond, understood? That's the end of closing the books of accounts of transfer or company. What you have to accounts that were to be opened, Amma? Realization account, equity shareholders account, preference shareholders account. Assets will be at debit side. Liabilities will be at PC will have to be posted at which account, which side? Realization account credit side, shareholders account debit side. Is it clear? And finally, find profit or loss. And you have to transfer the profit or loss to realization account. Automatically, realization account will get closed. Profit will be at which side? Debit side of realization account. Loss will be at credit side of realization account. Clear, everybody? And realization account assets and liabilities will be carried on at which values? Which values? Book values. Clear? That's it. And last and final, realization expenses or liquidation expenses. If the expenses were borne by transfer or company and paid by transfer or company, and if you are bearing our expense, very simple, realization account debtor to cash or bank account. Clear, everybody? Realization account debtor to cash or bank account. Next one, very important again. If listen carefully, borne by transferee company and paid by transferee company, other party, related or not related for us, and hence don't write anything. Is it clear? Next one, initially paid by transfer or company, later on reimbursed by transferee company. very simple. First I am paying kada to cash or bank. To be reimbursed kada, so transferee company account debtor to cash or bank. When they had given cash or bank account debtor to transferee company account, and ultimately there will be no journal entry again. Respond logic clear, huh? This is the rules. These are the rules for closing the books of accounts of transferor company. Only one thing that you have to be careful is that realization account has to be closed with book values. Has to be booked with book values. And those items, assets and liabilities which are not taken over by the new company, you have to open a separate account. Sale of asset, settlement of liability, and profit or loss again has to be transferred to equity shareholders account is the best option. Yeah, if you want, you can transfer it to realization also. Clear. But if you transfer it to realization account, you have to close from realization account to equity shareholders account. Clear? Fine. Anyways, while closing, first of all, you have to close which account? Shareholders account, and then transfer profit or loss to realization account. Respond clear? Next, opening the books of accounts of transferee company. He'll be asking only journal entries and balance sheet, not accounts here. On first entry, 3 main entries you will be having, 3 sub entries you will be having. First, I'm speaking about amalgamation in the nature of purchase. Sir, PC is dealt as per AS 14. Closing the books of accounts of transferor companies dealt as per IGAAPs. Now opening the books of accounts of transferee companies again dealt as per. So before writing the journal entries, you have to apply what is the nature or the type of amalgamation. The type of amalgamation is nothing but amalgamation in the nature of merger, amalgamation in the nature of purchase. There are faculty or there are teachers who will be telling that these are not called as types, these are forms of amalgamation, nature of amalgamation, methods of amalgamation and edo cheptaru. But this is logically types. That was very clearly given in the standard. Yes, types of amalgamation. Amalgamation in the nature of merger, amalgamation in the nature of purchase. 5 conditions will be there. What are the 5 conditions, sir? Assets and liabilities of transferor company should become assets and liabilities of transferee company. And everything must be transferred at book values. And 90% of equity shareholding should accept for amalgamation. And PC must be given to equity shareholders only in equity shares. And finally, the business has to be continued, or at least they should have intention to continue. If all these 5 conditions are satisfied, it is called as amalgamation in the nature of merger. Otherwise, it is called as amalgamation in the nature of purchase. Respond everybody clear? Amalgamation in the nature of purchase. If any of the conditions is not satisfied. If all the conditions are satisfied, it is called as amalgamation in the nature of merger. Now let me start with amalgamation in the nature of purchase. 3 main entries and 3 sub entries. Main entries. First main entry. Business purchase. You are purchasing the business, correct or wrong? So business purchase account debtor to liquidator of transferor company account. Clear? Next one. You are purchasing the business, right? So assets account debtor to liabilities account to business purchase account. This has to be debited and credited with PC. This has to be credited with PC. Very important. Agreed values or takeover values or revalues or fair values. Clear? Now, sir, asset minus liability is nothing but net assets. This is nothing but PC. So you have to compare PC versus net assets. If PC is more, it is capital loss. You have to debit to goodwill or to equity share capital, preference share capital, or if you have given debentures, bonds, etc. Or if you have given cash, cash. If issued at premium, to securities premium. If issued at discount, discount on issue of debentures, account debtor. These are the 3 main entries. Now 3 sub-journal entries. Sub-journal entry number 1. Settlement to the debenture holders. Okay. Sir, these 3 entries are common for every amalgamation. These are actually common for every amalgamation. But the following 3 sub-journal entries are not common. That depends. Clear? Now, the first one. What is the first one, sir? Settlement to the debenture holders. Percentage debentures of transferor company account debtor to percentage debentures account. It may be issued at premium or it might be issued at discount. That is what? Sub-journal entry number 1. Sub-journal entry number 2. Elimination of ICTs or elimination of mutual owings. What would be the journal entry, sir? Very, very simple. Creditors account debtor to debtors account. Bills payable to bills receivable. Loan liability to loan asset. In a single word, liability account debtor to asset account. And my dear children, if at all, it is in the nature of elimination of unrealized profit, then to stock account, because stock value should reduce and you have to debit goodwill. But if already you are having capital reserve, you can use capital reserve. If you are already having capital reserve, you can also use capital reserve instead of goodwill. Respond clear? And last and final, third sub-journal entry, realization expenses. Borne by transferor company, paid by transferor company. Not needed for us. Borne by transferee company, paid by transferee company. Needed. To cash or bank. And debit goodwill. Or if you want, you can also debit capital reserve if you are already having that capital reserve. Clear? Next. That's it. But very important. Assets and liabilities alone have to be transferred under amalgamation in the nature of purchase, which is nothing but purchase method. No single reserves and surplus of transferor company will be taken over. But if it is a statutory reserve, you are having only 3 statutory reserves for your chapter, which is, anybody? Investment allowance reserve, export profit reserve, foreign project reserve. These are the 3 reserves. Investment allowance reserve, export profit reserve, foreign project reserve. These are the 3 reserves that are there. Very important, take care. These are statutory reserves. Statutory reserves of transferor company. Statutory reserves of transferor company have to be maintained by transferee company. Have to be maintained by transferee company. While maintaining the same by transferee company, it has to acquire statutory reserves with a special account called Amalgamation Adjustment Reserve Account debtor to Statutory Reserve Account. What is it? Amalgamation Adjustment Reserve Account debtor to Statutory Reserve Account. Take care. How this will be presented, sir? In note 2, reserves and surplus. Listen very, very carefully. General reserve, P&L account, securities premium, etc. and etc. Only transferee company. Statutory reserves and surplus. Transferee company plus transferor company also. You will get the total. From this total reserves, you need to deduct amalgamation adjustment reserve. And finally, net figure will be transferred to balance sheet. Respond everybody, clear? That is the end of amalgamation in the nature of purchase. Now moving on to the next thing, amalgamation in the nature of merger. Coming to merger, you have to follow pooling of interest method. Pooling of interest method. Under pooling of interest method, you have to take assets, liabilities, and also reserves and surplus, including statutory reserves. Sir, why reserves and surplus is taken in the amalgamation in the nature of merger? Very simple. You see all the conditions, all the assets, liabilities, same. Book values. 90% of the shareholders, same. Even they were issued with an equity share. And finally, same business and same business. Even though it was acquired by the new company, is it seeming that it is like a new company or more like old company? More like old company. So if it is more like old company, you need to record like old company only. That is along with all the reserves and surplus. Clear? First entry same, no difference. Third entry same, no difference. Settlement of PC. Second entry will be different. Take care how. Assets account that are book values. To liabilities account, book values. To statutory reserves, book values. To reserves and surplus. Has to be adjusted. Has to be adjusted. How I'll tell you. Clear everybody? Of course, finally to business purchase with PC. How this will be adjusted? Sir, normally you have compared PC versus net assets under amalgamation in the nature of purchase. If it is amalgamation in the nature of merger, you have to compare PC versus net assets. But here net assets is only assets minus outside liabilities. Here net assets logically assets minus outside liabilities minus reserves and surplus also. In a single word, you will get share capital. So under amalgamation in the nature of merger, compare PC versus share capital. If PC is equal to share capital, no problem. If PC is less than share capital, if PC is less than share capital, profit or loss? Profit. Ante kada? If profit, it has to be credited to. Listen, I'll tell you. If profit, it has to be credited to P&L account as per accounting standard number 14. It has to be credited to capital reserve as per export advisory committee of ICAI. Under amalgamation in the nature of merger, when PC is equal to share capital, no problem. If PC is less than share capital, that is called as profit. That profit will be credited to P&L account as per accounting standard number 14. It has to be credited to capital reserve as per export advisory committee of ICAI. So now what to follow, sir? In your study material, they have followed this one. Not capital reserve. Not capital reserve. In study material, they followed credit to P&L account. Don't take risk. You write to P&L account and write a note. Even though in ICAI study material or as per accounting standard number 14, when PC is less than share capital, the difference has to be credited to P&L account. But as per export advisory committee of ICAI, it has to be credited to capital reserve. Give that clear-cut clarification. Understood everybody? So take care. This is one of the important points. And most awaiting part. PC is greater than share capital. It has to be adjusted against the reserves and surplus. First, it has to be adjusted against the free reserves. Free reserves of transferor company. If free reserves of transferor company were totally completed, then they have to be adjusted to the free reserves of transferee company by debiting in the journal entry. Even if free reserves of transferee company were also completed, simply debit P&L account. Ante, listen carefully, assets with book values, to liabilities with book values, to specific reserves with book values, to statutory reserves with book values to business purchase with PC. If PC is equal to share capital, your entry will get automatically tally. If PC is less than share capital, then it will be your profit and it has to be credited to P&L account as per AS 14 or capital reserve as per expert advisory committee. If PC is greater than share capital, it is loss. Now what to do, sir? Your free reserves has to be adjusted to that extent. Sir, my free reserves is 100. Excess PC is 200. Adjust to the extent of 100. It will become 0. Still how much excess PC is there? 100. Check out the reserves and surplus of transferee company. Debit the same. Free reserves of transferee company. Sir, it's only 20. Okay, debit 20. What about remaining 80? Debit P&L account. Hey, respond everybody clear, huh? That's it. That is the end of your second journal entry, which is actually very important. And the next one, again same, settlement to debenture holders, same. Elimination of mutual owings, liabilities to assets. But take care. For unrealized profit elimination, previously you have written goodwill or capital reserve to stock. But this time you have to debit only to P&L account. And in the same way, realization expenses borne by transferee company and paid by transferee company, P&L account debt or to cash or bank. Simple. Wherever goodwill or capital reserve is used in purchase method, you have to use P&L account under merger. Genuine pooling. Genuine pooling. Ante assets of transferee company plus assets of transferor company, liabilities of transferor company plus liabilities of transferee company, reserves of transferor company plus reserves of transferee company, but only free reserves will be adjusted. Respond everybody, pakka. That's it. This problem? See the PC, it's very different for point number 2. And one more thing I've forgotten to tell. Whatever transferee company paid to the shareholders of transferor company, it counts for PC. Which implies that debentures given to shareholders is PC. Clear? But equity shares given to debenture holders is not PC. Because who are the owners of the company? Shareholders. Whatever you give to shareholders, it is PC. But whatever you give to debenture holders, lenders, etc. will not count for PC at all. Clear? So take care. 15% is debentures in a company at par to provide an income equivalent to 8% return on capital employed. Capital employed is nothing but net assets. PC is satisfied by issuing following shares, following debentures. So this is the point relating to debentures. This is typical. Give 15% debentures. How much, sir? So as to provide income equivalent to 8% on the capital assets. Let me decode it. How much you have to give? 15% of debentures. How many? To provide an income. Yeah, because 15% on debentures is nothing but interest to them. Ante kada? Equivalent to equal. 8% is on capital employed is nothing but net assets. This is the decoding. 15% of debentures is equal to 8% on net assets. Now what can you find? Net assets. So 8% is on net assets. You want debentures, right? So divided by 15% will give you debentures. Respond clear? No need to buy hard, no need to think more. What divided by what, confusion, nothing is needed. Decode the rule. 15% of debentures is equal to 8% of net assets. So debentures is equal to 8% of net assets divided by 15%. That's it. Assignment, no. Yeah, check out this one. CRD number. Yeah, check out this one. CRD number 1. Okay. This is actually a very important point. Issue of such amount of fully paid 6% debentures in LK Limited so as to sufficient to discharge 5% debentures in K Limited at a discount of 5% after takeover. 5% debentures in K Limited. K Limited 5% debentures is 2 lakhs. Check out. So 2 lakhs. You have to issue 6% debentures for this 2 lakhs at a discount of 5% after takeover. Clear? What is the agreed value? Two lakhs or 2 lakhs minus 5%. Why it is 2 lakhs? After takeover is actually, what is it called? Mattering a lot and lot. Because what happens? 2 lakhs. You take entire 2 lakhs. After that, give it 5% discount. Method number 1. Method number 2. You take directly at 5% discount and you settle only 1,95,000. This is method 2. But in that problem, method 1 is given. That is, you take the total amount and then settle at 5% discount. Respond clearer. So, the wordings after takeover is very, very important. One more thing. If you check out this one, inventory and trade receivables were to be taken at provisions at 2% and 2.5%. Okay. Sir, for inventory, do you ever see provision for inventory? Cheppali? No. Then what is the meaning of creating a provision of 2%? Deduct the value. Whereas for trade receivables, you have to create provision for bad debts at 2.5%. Respond, is it clear? For inventory, creating provision ante reducing the value. For debtors, creating a provision ante create a provision. Listen, the next one. For inventory, reduce the value ante reduce the value. For debtors, reduce the value ante creating a provision. So, conclusion. For debtors, if the value is reduced, it is always creating a provision only. Respond clearer. So, take care, that's important. Next. Check out this one. 12% debentures of Q Limited are to be paid at 8% premium. By is the separating preposition. By is the separating preposition, remember. Before by, it is relating to the old company, that is transferor company. After by, it is relating to the transferee company. So 12% debentures of Q Limited. Q Limited 12% debentures, 1,50,000. Are to be paid at 8% premium plus 8% divided by issue at a discount of 10% by 90. Ante. Clear? If nothing is given and given like this, issue 12% debentures in P Limited, then divided by 100. If given issued at a premium of 2%, divided by 102. If given 12% debentures of Q Limited are to be discharged by issuing 12% at a discount of 10%, then 1.5 lakh divided by 90. Clear, everybody? So please read the sentence properly so that it will become easy for you. Otherwise you have to confuse. See here, inventory has to be taken over at 5% lesser value. Deduct the value. Debtors has to be taken over at 5% lesser value. Create a provision. Clear, everybody? Next, CRD number 3. Take care, it's actually important. If you observe point number 1, 10% preference shareholders are to be paid at 10% premium by the issue of 9% preference shares of X Limited. 10% preference shareholders 3 lakhs are to be paid at 10% premium ante 3 lakhs plus 10%. Issue 9% ante divided by 100 ante you will get 3,300 9% preference shares. Clear? Now come to point number 7. Equity shareholders of Y Limited 9 lakhs are to be discharged issued at 5% premium ante 9 lakhs plus 5% divided by, no, then tell me the correct thing. Equity shareholders of Y Limited will be issued at 5% premium. 9 lakhs divided by 105. Logically speaking, this is correct. Logically speaking, this is 100% correct. But answering wise, this is wrong. Because you have to follow net assets for the same, not net payments. For preference share capital, if number amount not given, you take the existing number, existing amount. See here, preference share. How many number? How much amount? Not given. Take the existing value, whatever is given in the question. Whereas coming to this one, it is not like that. For equity shareholders, if number and value is absent, you have to follow net assets method. That is very important. Take care. So in this question, for equity shareholders, it is net assets method only, not net payments. And be careful with goodwill. I'll tell you 3 rules for the goodwill. Rule number 1, consider normal items but not abnormal items. Consider trading items but not non-trading items. In one of the illustrations, you are having non-trading items. In these questions, you are having abnormal items. So you should not consider these 2 items. Clear? And the next one, you have to rectify all the errors. Rectification of errors. You have to rectify all the errors before computing the goodwill. Clear? Remember these rules. That's it. Next, CRD number 4. Yeah, CRD number 4 is one small logic. They are taking over at 1st July, but the balance sheet is given at 31st March. So some data will be missing. So you have to prepare the balance sheet as on 1st July and you have to start. Clear? And for this question, actually you will be having net profit after charging depreciation. To find cash for net profit, you have to add back non-cash expense called depreciation. Then you are going to get the cash. Hey, did you get my point? Net profit after charging depreciation is given in the question. But you want to find cash. If you want to find cash, you just need to do that. Net profit plus non-cash expenses. That is the point. Next. There will be one problem called Akasha Ganga Limited. Never solve that problem, okay? Because that problem, they will be having negative net assets. And there is no PC to equity shares actually. Their PC is given only to preference shareholders. Negative net assets. So better don't solve that problem. And I need to show one more thing. Yeah, let me tell you, I was not exactly very sure where the things are now. But remember, somewhere you will be finding. In one of the illustrations, you will be finding non-trading income. So to compute the goodwill, you have to consider only trading income. You should not consider non-trading items. Likewise, non-trading investment, income from non-trade investment will be there. That has to be eliminated while computing the goodwill. And very important, listen, very important. While eliminating unrealized profit, if transferee company sold to transferor company, let me tell you the easiest thing first. Transferor company sold to transferee company. So it is something like 10,000 is the value of the stock. And profit made by transferor company is 2,000 on this 10,000 stock. Well, transferee company is taking over the transferor company stock, unrealized profit 2000 is there kada? Yes or no? So transferee company has to eliminate 2000 unrealized profit. Goodwill or capital reserve if it is purchase, or P&L account if it is merger, to stock account 2000. Clear? Hey, is it clear? Now take care. If transferee company sold to transferor company, say for example 20,000 stock is sold for 25,000. So now in transferor company stock is at 25,000. How much is unrealized profit? 5,000 is the unrealized profit. Now transferee company is acquiring the assets of transferor company at 10% lesser than the book value. Clear? Ante this inventory was taken over at 25,000 minus 10%, which comes to 22,500. How much is my unrealized profit? I have to eliminate 5,000. But since already my asset was taken over at 10% less than book value, 2,500 was eliminated. Clear? I have to eliminate 5,000. Already 2,500 was eliminated. Still I have to eliminate 2,500. Is the logic clear? Ante after learning entire amalgamation, there will be some points which will be the deciding factor for solving. You will be finding this kind of question in not in assignment, it is in illustrations. Yeah, this one. Illustration number 1. You see it later, you will understand. Unrealized profit is 25,000. But already 1 lakh inventory was taken over at 10% less than the value, that is 10,000. You have to eliminate 25, but already 10,000 is eliminated. Still you have to eliminate 15,000. Clear? That is this point. And next one. Listen, listen. మీకు గుర్తున్నట్లయితే while doing CRD problems, for finding provisions, he will not deduct mutual owings to find the provision. But in one of the assignment problems, he will be deducting mutual owings to find the provision for bad debt. Gurtunda? In assignment problem, he will be deducting mutual owings to find the provision. In CRD problem, he will not deduct. Moreover, teachers will be telling, don't eliminate mutual owings while solving net assets. Don't eliminate mutual owings while acquiring the net assets. Eliminate mutual owings only after acquiring with a new entry. Even at the time of writing the journal entry, assets account or to liabilities account, don't eliminate mutual owings even there also. You have to eliminate only after takeover. Then why in that problem he had deducted mutual owings? To find provision. There were students who thought that that is wrong. No, that was actually correct. Students who will be concluding that was wrong and CRD problems are told that is correct. No. CRD is correct. Assignment is also correct. You have to deduct mutual owings in one situation. What is that? Listen very carefully. Transferee company, transferor company. Very carefully you have to listen. Debtors, creditors. Say 1,80,000, 40,000, 60,000. Sir, very carefully. Transferor company has to receive from transferee company 10,000. Who has to receive? Cheppali, who has to receive? Transferor company has to receive from transferee company. How much amma? 10,000. Clear everybody? So transferor company, I have to receive from transferee company. Ante for transferor company, transferee company is the debtor. For transferee company, transferor company is the creditor. Logic clear? Pakka. Sir, now who is acquiring whom, amma? Transferee company is acquiring transferor company. Debtors were taken over at a provision of 5%. How much debtors are there? 1 lakh. 1 lakh was taken over at a provision of 5%. 1 lakh minus 5%, 95,000 is wrong. Because in this 1 lakh, even I am a debtor. I am a debtor. I am not having doubt on myself. Why will I create provision on my amount? My amount is how much? So on 1 lakh, I will be deducting 10,000 and on 90,000, I will be creating a provision of 5%. Logic clear? This is what happened in your assignment problem. Ante transferor company receivable from transferee company. If it is reverse, transferee company has to receive it from transferor company. There is no problem of debtors at all. Directly 1 lakh into 5%, 5,000 will become provision for bad debts. I hope you have got clarity. If I am debtor to that company, I should not create provision on my amount. That has to be deducted and then I have to compute the net thing. Respond pakka. That is what that point which is very important. Take care. And last and final. There is one problem wherein you will be having cost on issue of debentures. He will be telling in the question that it is amalgamation in the nature of merger. But cost on issue of debentures is not to be taken over by transferor company. Logically speaking, if it is amalgamation in the nature of merger, each and every asset of transferor company has to be taken by transferee company. Given in the question it is amalgamation in the nature of merger, but cost on issue of debentures is not to be taken by transferee company. Then how it will become merger? Merger or not a merger? Cheppali. No, it's not a merger. But given in the question that it is merger, then what to do, sir? Before acquisition, eliminate cost on issue of debentures from balance sheet by writing it off to P&L account. So now cost on issue of debentures is not there in your balance sheet. Now transfer all the assets and transfer all the liabilities to the new company. That is the logic behind that. Respond, is it clear? That's it. And in one of the problems, assignment problems itself, I told you one thing, did you remember? Assets and liabilities which are not taken over by the transferee company. You have to open separate accounts for the same. Gurtunda? That point will be there, ma. See here. Liquidator of Glory Limited is appointed for collection from trade receivables and payment to trade creditors. So trade receivables and trade creditors were not taken over by the new company, and hence you have to open separate accounts for debtors and creditors, and liquidator is getting 5% commission on collection and 2.5% collection on payments, and balance cash will be taken over by the new company. So you have to open debtors account, you have to open creditors account, you have to open cash account. Debtors profit or loss, creditors profit or loss will be transferred to realization or equity shareholders account. Cash account, opening balance, amount collected from debtors, amount paid to creditors. Whatever balance is there, it has to be transferred to realization account. Okay, that's it. And that is the end of your amalgamation. Exactly 1 hour it took. Yeah, it will take for sure. Ninna manam anukunde consolidation and amalgamation will take 1 hour for sure. And I don't know whether you have got the benefits from these 2 chapters or not, because I have covered almost each and everything, even by showing amalgamation problematic part. Consolidation, I did not open the material but covered each and every different point. And that is what your amalgamation and consolidation. Without wasting time, immediately would like to start buyback. Buyback only test number 3 I have to tell you. That's it. And remaining all is quite okay. So straight away we'll be starting with test number 3. But before starting test number 3, one more point is there. In your questions, if you observe carefully, if I was not wrong, CRD number 1 anukunta, he will be telling the company has decided to buy back at a 20% of paid up share capital. Normally paid up share capital in the sense, both paid up equity share capital plus paid up preference share capital. This is provision. This is provision. But in the problem, buyback 20% of paid up share capital ante, understand the logic. You can't buy back preference share capital kada. So which implies that only equity share capital has to be taken for computation. మీకు ఆ డౌట్ ఇప్పుడు రాదు అస్సలు. నిజంగా ఆ డౌట్ ఇప్పుడు మీకు రాదు. యూ విల్ బి గెట్టింగ్ దట్ డౌట్ ఇన్ ద ఎగ్జామ్. పేడ్ అప్ షేర్ క్యాపిటల్, అరే పేడ్ అప్ షేర్ క్యాపిటల్ అంటే బోత్ ఈక్విటీ ప్లస్ ప్రిఫరెన్స్ కదా, దట్ ఈస్ ఫర్ ప్రొవిజన్. బట్ ఫర్ ప్రాబ్లమెటిక్స్ పేడ్ అప్ షేర్ క్యాపిటల్ ఇంప్లైస్ దట్ పేడ్ అప్ equity share capital only, remember. And for all the purposes of section 68, if I was not wrong, that is for the purpose of buyback. Free reserves also includes securities. Don't forget this one. Now test number 3, debt equity test, which has to be in the ratio 2:1. I told you 2 methods like shortcut method and simultaneous equation method. Even though you have done shortcut method in your main exam, it is correct, but you will be deducted with 0.5 mark for sure, because you will be writing only one equation. No, if at all in your internal valuation, if you have deducted 2 marks, that's not correct, but they will be deducting for 1 mark for sure. ఏంటమ్మా నాకు అర్థం కాలే. 2 మెథడ్స్ రాస్తే they don't allot any extra marks. Don't allot any extra marks, they'll allot full marks. Anyways, listen. And the simultaneous equations are very, very simple, but you have to logically understand each and everything. Sir, point number 1, how many number of shares to be bought back? Number of equity shares to be bought back is equal to, take care, say for example, your total debt is 1000. Your total equity is 2000. Maximum debt is to equity should be 2:1 after buyback, which implies that debt by equity is equal to 2/1, which implies that equity is equal to half of the debt. That implies equity is equal to half of debt, that is half of 1000. You have to maintain a minimum of 500. Clear? Your existing equity is 2000. Ante kada. Your minimum equity to be maintained is 500. So 2000 minus 500. You can utilize 1500 absolutely. Clear everybody? So maximum amount that can utilize is 1500 divided by simple face value plus buyback price is going to give you the answer. Clear everybody? Number of equity shares to be bought back is equal to maximum available equity. Maximum available equity is nothing but existing equity minus minimum equity to be maintained, whole divided by face value plus buyback price. This is what your shortcut method. But if you want simultaneous equation method, yeah, it is actually lengthy. You have to listen very carefully. How many number of shares that you have to what is it called, buyback? You treat something as X or Y. Very simple. Number of equity shares that are to be bought back is equal to, first of all, take maximum funds that can be utilized. Maximum funds that can be utilized is nothing but existing equity minus minimum equity to be maintained divided by buyback price. The next one. How much amount has to be transferred to CRR, sir? Which is nothing but face value of equity shares multiplied by number of equity shares that are to be bought back. And treat it as X and treat it as Y. Clear, everybody? If you substitute, you are going to get your answer. Clear? Something like buyback. See here, equation number 1. Maximum permissible buyback is equal to present equity minus nominal value of buyback to be transferred to CRR minus minimum equity to be maintained. We have done it directly actually, maximum permissible funds anesam, but maximum permissible funds is nothing but this one. What is that? Present equity minus minimum equity to be maintained minus amount to be transferred to CRR. Ante this will be, maximum funds will be existing equity minus minimum equity to be maintained minus CRR to be transferred. CRR is nothing but Y. Number of equity shares is nothing but X. By crossing these two equations, you are going to get the final answer. Number of equity shares to be bought back. See here, maximum buyback of equity divided by buyback price. This is another equation. So by solving these two things, you are going to get the answer. But if at all you lack time in your examination, of course you will lack time in your examination for sure. Provided if you aim for attempt entire 100 marks or at least 85 or 90 marks, you compromise and do only the shortcut method, you will be allotted with the marks. Maximum full marks allot chester. Can't but situation, if the evaluator is very strict, he will be deducting 1 mark. It's not 2 mark, it's 1 mark because you are writing one equation here. You can compromise if you would like to attempt at least 80 marks in your exam. 80 రాయాలి అంటే ఆ ఒక్క మార్క్ కోసం నువ్వు తర్జన పడక్కర్లా. సార్ మరి ఆ ఒక్క మార్క్ పోతే నాకు 39 వస్తుంది కదా సార్, అప్పుడు నువ్వు 80 మార్క్స్కి ఎందుకు రాయడం నీ పేపర్? అంతే కదా. సో ఎనీవేస్ the shortcut method is nothing but number of equity shares to be bought back is equal to maximum funds that can be used. Ante present equity minus minimum equity to be maintained whole divided by face value plus buyback price. This is the shortcut method. You are going to get the answer from this method. Respond everybody, clear? That is the end. And let me straight away go with accounting standard number 20 by not wasting any time. As I have promised you that I will be telling the solution for entire rights issue. For rights issue problem. But before that, let me go with dilutive EPS, which is actually very simple. Dilutive EPS, you have to check out if debentures are there. Then earnings available to equity shareholders plus interest after tax divided by existing weighted average number of equity shares plus convertible equity shares, potential equity shares. That is how much debentures will be converted into future equity shares. And if it is preference shares, earnings available to equity shareholders plus preference dividend divided by Vains plus convertible potential equity shares. And if it is options, earnings available to equity shareholders divided by Vains plus convertible potential equity shares. This is very easy to find convertible potential equity shares. He will be giving in the question, each debenture is converted into 10 equity shares or 10 debentures are converted into 1 equity share. But here he don't give anything, you have to find it. Okay. How you have to find it? If 1 lakh options are issued at a price of 25 when the market price is 30. Okay. You have to take only the free part. You have to take only the free part, not the resources part. Free part in the sense 1 lakh into 30 minus 25 whole divided by 30. In other words, listen. 1 lakh options were issued at 25. Then how many number of options were issued at a price of 30? Then that number of options is nothing but 1 lakh into 25 by 30. How much you will get? 16,000? Now listen very carefully. 1 lakh issued at 25 anna, 83,333 issued at 30 anna, one and the same. What is the market price? 30. So you need to take this one. But out of 1 lakh, if these were issued for full consideration, free will be 16,667, which is nothing but 1 lakh into 30 minus 25 divided by 30. How to find it, sir? Number of options multiplied by fair value minus issue price divided by fair value will be giving the answer. Is it clearer? On the last and final part, which is nothing but AS 20 rights issue. Listen very carefully. I don't know how you have learned, but if you learn in this style, again I tell that it is actually easy. For the last part, let me take the existing question itself. Check out this one. Net profit for the previous year is 30 lakhs. Net profit for the current year is 50 lakhs. Outstanding shares prior to rights issue is 20 lakhs. And rights issue price is 20. Last date for exercising the rights is 1st June. Rights issue is 1 for every 5. That is 20 lakhs into 1 by 5, which comes to 4 lakh shares. Fair value of one share before the exercising of the rights is 26. To start the right issue, first of all, you have to find theoretical X rights price. Don't think that theoretical X rights price is the hardest formula. It is logically like average price. Original shares are 20 lakhs multiplied by original price is 26. New right shares are 4 lakhs multiplied by new price is 20. Whole divided by 20 lakhs plus 4 lakhs. Why formula is actually needed to find this one? This is simply like average price, which is number of original shares into fair value prior to the rights issue plus number of right shares into rights price divided by total number of shares including the right shares. Anyways, how much you will get? 25. And the next thing is called as bonus factor, or it is also called as rights factor. Okay, bonus factor or rights factor, which is, listen, first of all, forget the formula. Marchipayam anuko. You are having theoretical X right price emo 25. You are having fair value emo 26. Always remember, this should be greater than 1 only. See, if you take 25 by 26, how much you will get? 0 point something. So this is wrong. So do the reverse in your exam. Did you get my point? Always it should be greater than 1. Remember, freeze it in your brain. It should be more than 1. So if this is not working out, reverse will work out. fair value divided by theoretical X rights price. చిన్నదేమో ఎక్కువ ఉంటుంది, పెద్దదేమో తక్కువ ఉంటుంది, which is ultimately 26/25, which comes to 1.04. Sir, everybody will be telling up to here the same, but my explanation from here will be a bit different. I'll actually make it into two parts. Number 1 is 0.04, number 2 is 1. Sir, first of all 1.04 ante it's 1.04 by 1 ani ardham. Is it clear? 1.04 is nothing but 1.04 by 1, which implies that if the price is 1.04, you are offering it 1. So 0.04 is like free. Logic understood? If the price is 1, you are offering it, I'm sorry, if the price is 1.04, you are offering it 1. So 0.04 is free. So I'll make this into two parts. 1 okati, 0.04 okati. 0.04 into original shares. Because you are giving right shares only on original shares kada. Ledu, just you write like this. This is free part, remember. Now how many number of right shares are there? 4 lakhs. Ante kada. Make the 4 lakhs into two parts. Sir, this 4 lakhs is computed on original shares, that is 20 lakhs. So 20 lakhs into 0.04. Enta? Sure? 80,000. This is to be treated as bonus shares. 4 lakhs minus 80,000. 3,20,000 is to be treated as shares with full consideration. But ఈ మెథడ్లో ఒకే ఒక మిస్టేక్ మీరు ఏం చేస్తారంటే 0.04 into 4 lakhs వేసేస్తారు. కంగారులో వేసేటప్పుడు విల్ బి డూయింగ్ దట్ విచ్ ఈస్ రాంగ్. సో టు అవాయిడ్ దట్ వాట్ ఈస్ ద బెస్ట్ థింగ్ సార్? యూ హ్యావ్ గాట్ రైట్స్ ఫ్యాక్టర్ 1.04 కదా, మేక్ ఇట్ ఇంటూ టూ పార్ట్స్. 0.04 into original shares, that is 20 lakhs, which comes to 80,000. Now these are bonus shares. Bonus aithe meeku telusu kada, time weighing factor you have to consider right from the issue of the previous year beginning of the previous year. Clear? And next one, right shares 4 lakhs minus 80,000 bonus, then you will be getting 3,20,000 issued at full price on 1st June or July? 1st July 1/7. 1st June, duff of love. 1st June. Hey, is it clear everybody? Understood? Hey, is this bifurcation understood? Now finding EPS is actually very easy. Listen. Last year EPS is equal to last year earnings, that is 30 lakhs, divided by last year shares 20 lakhs. 1.5. Take care. Current year low, current year EPS, current year earnings divided by 20 lakhs into 12/12 plus full consideration shares or 3,20,000 issued on 1/6. Ante 3,20,000 into 1/6 ante April May 10/12 plus 80,000 or bonus shares ante into 12/12. No need to do like 1.05 into 12/12, deducting that, adding this, nothing is needed. If you do this step properly, you will get everything. 1.04 separated into two parts, 0.04 and balancing figure. 0.04 into original shares will be the bonus shares. That whatever balancing figure is there, it is given for full consideration on 1/6. Clear? Now, current year lo last year EPS ante restated EPS. Last year earnings divided by 20 lakhs into 12 by 12 plus bonus shares has to be considered right from the previous year kada. So in plus 80,000 into 12 by 12. Clear everybody? Yes, you're going to get. Yeah, whatever. If you observe here, he'll be solving it in a different style, like taking 1.04 into 2 by 12, 10 by 12, again 1.04, 20 lakhs into 1.04. I don't think all those things will be working out, because you have to remember many things if you're doing like this. But if you have bifurcated like this, it will become the easiest part. Only one thing, 1.04 la. If 1.08, 0.08 into original shares will be the bonus. Balancing figure, total right shares minus free shares is nothing but right shares issued at full consideration. Respond clear? That is the end of your rights issue. అయిపోయింది. ఏమైనా చెప్పమంటారా ఇంకా? చెప్పేయమంటే I'm ready to tell. If you want, I'm ready to tell. Yeah, sir. Is 28, as you said that you are having exam ఎప్పుడు? రేపేనా? సరే. I told one point. With this point you can solve all the problems, but there is one more point in that, like revaluation surplus. Listen, sir, normally for creation of impairment of loss, what is a journal entry? P&L account debtor to impairment of assets account or impairment of loss account. Am I correct or wrong? But take care. If the asset is already having upward revaluation, instead of P&L account, you can use revaluation surplus. Revaluation surplus account debtor to impairment of loss account. Respond, is it clear? Pakka. But biggest point, how much it has to be considered is the question. Okay. Take care. For that, you have to check out the policy of revaluation surplus. In CRD number 3, you will be provided with a policy like company has decided to write off revaluation surplus for every year. Say if your revaluation surplus is 1 lakh today, upward revaluation, and the remaining life of the asset is 5 years. Every year you will be writing off 20,000. Say like that 2 years completed. 1 lakh is the revaluation surplus, 40,000 is the written off balance, and you were provided with 80,000. Sorry, 60,000. Now, if your downward revaluation, your impairment of loss is 1,20,000, then no need to write P&L account debtor to asset account. Clear? No need to write 1,20,000. Debit revaluation surplus to the extent of 60. Remaining 60 can be debited to P&L account. Clear? One more thing, don't confuse here. My intention of writing this entry is not exactly like impairment of asset or impairment of loss. It is like asset only. So, conclusion. So tell me the journal entry for impairment of loss, sir. P&L account debtor to asset account. Here P&L account is nothing but accumulated impairment of loss account debtor to asset account. Now accumulated impairment of loss, it can be closed either by debiting to revaluation surplus if you are having revaluation surplus. If you are not having revaluation surplus, then debit it to P&L account. Respond everybody, pakka. Sure. Now the biggest point you need to understand, how much is the balance of revaluation surplus? It depends on the policy that the company is following. 1 lakh upward revaluation. Remaining life is 5 years. Every year write off 20,000. Like that 2 years completed. So automatically you will be getting 40,000. So balance is 1 lakh minus 40. You will get 60,000. Balance in revaluation surplus. A respond clear. Now say for example, if you would like to provide impairment of loss to the extent of 80,000, how much balance you are having in revaluation surplus? So use 60,000 and remaining 20,000 will be debited to P&L account. Clear? My dear children, if at all company is not having this policy at all, how much revaluation surplus that company is having? 1 lakh. How much impairment of loss you would like to provide? Entire 80,000 you can provide it from revaluation surplus. Respond everybody clear. That is the end. So check out the policy of writing of revaluation surplus and hence you decide accordingly. And please cancel assignment number 3 in this context. Please cancel assignment number 3. Accounting standard number 28. Yeah. See, strictly speaking, the entries will be like this. P&L account debtor to asset account. Ledu. If you would like to show this separately, P&L account debtor to accumulated impairment of loss account. Clear? But take care, if you are already having revaluation surplus, you can debit to revaluation surplus. And normally hope you know the entry for depreciation. Depreciation account debtor to accumulated depreciation account. Same logic is extended here also. Journal entry. I have written directly like P&L to asset. Or I have written here one more type of thing like P&L to impairment of loss or impairment of assets. Every entry is correct only. Nothing is wrong. Okay. But logically if you want exact entry as per the standard, then it is something like impairment of loss account debtor to accumulated impairment of loss account. P&L account debtor to impairment of loss account. If revaluation surplus is there, debit that one. So ultimately your entry will become P&L or revaluation surplus to accumulated impairment of loss. Respond everybody clear? That is the end of accounting standard number 28. Sorry. To tell you accounting standard number 29, nothing great. I'll tell you some rules ante. Provision. First of all, it should be a liability. What is a liability? First of all, it should be a present obligation. What is an obligation? Duty or responsibility, which can arise either through law or which can arise either through contracts or no law, no contract, just to maintain good relations. You are having one of the problems, if you have remembered, the company is not having any policy of providing warranty at all. But company would like to replace the goods. It did not provide warranty. So no contract, no law. But just to maintain good relations with the customer, it can create provision for warranty. Logic clear? Now, what do you mean by present obligation? More likely than not to occur. What do you mean by possible obligation? Equally likely to occur or less likely to occur. So, if at all there is any contingent liability also, check out whether outflow of resources is probable, possible, remote. Probable in the sense more chances of occurring than not to occur. Immediately create a provision. Possible, equal chances for occurring or not occurring, or less chances for occurring, more chances for not occurring. Disclose it as a contingent liability. If it is remote, very less chances to occur a liability. Ignore that. Respond clear? This is contingent liability. And coming to provision, very important. Provision should be a liability. Provision for bad debts, provision for diminution in the value of inventory, provision for what is it called? Diminution in the value of investments, provision for loss as per accounting standard number 7. All these provisions will not be dealt as per S29. Provision should be a liability. It should not be reduction in asset. And provision should be a present obligation. It should not become a future obligation. Did you remember there will be one question for you? Likewise, you have purchased some airplanes. Aircraft. As per law, you are supposed to overhaul the aircraft for once in every 5 years. As per law, you are supposed to overhaul the aircraft for once in every 5 years. You are at year 1. You need to conduct the overhaul at year 5. Do you need to create any provision now? No, not required. Because it is a future obligation. Who knows what happens in future? An aircraft might crash in an accident. Or you might have sold the aircraft. Or aircraft life is over. Or you don't like to aircraft and you would like to replace the aircraft with a new one. Then no need to do overhaul ga. Santi, is it present obligation or future obligation? Future obligation. But take care. You have sold a good. And you have provided 1 year warranty. Immediately you need to create a provision. Because by the moment when you sell the good, your obligation arises to provide a service to the customer at free of cost. So this is a present obligation. Hey, don't think that in future I have to provide warranty kada. Let the customer come, then I will create provision. No. This is different, this is different. You know one thing? Even though the company is closed, they are supposed to provide warranty. But if I sold the aircraft, no need to provide overhaul expense. Until there is a present obligation in sale of good, but there is no present obligation in aircraft example. Respond, is it clearer? And one more thing, like provision should not be discounted. Only provision for decommissioning and restoration has to be discounted. Unwinding of discount. Ante provision for decommissioning and restoration. Yesterday, if you have remembered, year 10 is the provision, but you have brought it to the present value for year 1. And you have created the provision for with present value. This present value should become future value kada. And every year interest must be added to the provision, which is called as unwinding of discount. The topic is called as unwinding of discount, which has to be transferred to P&L account. And also which has to be credited to provision for decommissioning and restoration expense. Respond, is it clear? Hey, is it clear? That's it. Ante it is something like your expense. Interest account debtor to provision for decommissioning and restoration expense, P&L account debtor to interest account, so that your provision value will increase. And you will be transferring interest to P&L account also. This concept is called as unwinding of discount. You can't discount any other provision. And provision always has to be measured before tax. And you can't create provision for future losses. You can't create provision for future losses. Tagline. Contingent liability can be disclosed in notes to accounts, but contingent asset should never be disclosed in notes to account. Clear, everybody? That's it. So yeah, that's the end. Let me tell you some things. Don't fear for your exam. Especially accounts is your first examination, advanced accounting. I do admit that this syllabus is very huge now. This time advanced accounting syllabus is actually very huge, undoubted in that, no doubt at all in that. 2 things were missed and you are having all the accounting standards along with some chapters. And one more thing to tell you, don't fear even for case scenario based MCQs. It's my humble request, you first read the question, not the paragraph. Don't read the case scenario immediately. For accounts, if you read the case scenario, it is waste of time. I'll tell you how to do. Question number 1, question number 2, question number 3 is given. Read question number 1. Pick for which standard it is belonging to. Now go into the case scenario and find the paragraph for which the standard is relating to. Because I have seen 2 to 3 questions, AS2 given, 4 given, 7 given, 9 given. But question did not ask on AS4. Then it is obviously waste of time to read the entire question. So check the question number 1, check the standard. Identify the relevant part in the question and read that and put the answer. That is a better choice. And Remember, very important. 30 minutes MCQs. Ante. You can't spare more than 1 minute for that. And you're supposed to write 5 questions into 30 minutes where you're going to get 2.5 hours. But the happiest part is that question number 1 and question number 6, first question and last question, can be completed just within a span of 40 to 45 minutes. So 15 minutes spare will be available here. All these things will be working out only when you practice, not when you see. Especially in your revision exams, put the time limit. You may ask the invigilator, you may ask your in-charge sir, please give 5 minutes extra. They'll give you 10 minutes extra. Yes, that will happen, I know that. There are people who will be writing the answer sheet even for more than half an hour, even after the completion of the time. But when will you get the real worth for you? Even though you are writing for extra time, first you set in your mind, oh, if I have answered within time, I would have answered only one question. And how much speed you have to increase? How much speed you have to multiply? So concentrate on that one, which is actually very, very important. And last but not least, I hope this marathon class had helped you to the maximum extent. Yes, thank you. Your marathon class completed. And I hope you have actually got benefited from this. So thank you, class completed. All the best for your examinations, and hope all you people should be blessed with the destiny, and God should bless you to the maximum extent. Very important thing, at any cost, you have to pass in your attempt. In the very coming attempt, you should pass. May God bless you all, and all the best for your examinations.